A very warm welcome to the Ultimate XXL Crypto Trading Video Course 2025. This is therefore the most elaborate video and probably also the one with the most added value ever on this YouTube channel. Today, it's definitely worth taking the time to consciously watch everything carefully and work through it thoroughly from A to Z. I put a lot of effort into this. A tremendous amount of work has gone into this video. And as I said, everything here is completely free. So just so you know right from the start, before we get into everything, I won't be selling you anything in today's video course. I don't have any coaching, I don't have a product, I don't have an extra video course, I don't have a group. Really, I have nothing at all. Yes, at this point, I just want to share my knowledge with you 100% that I've gathered over the past 6 years in the crypto market, both in the spot sector, meaning general crypto trading, and also in the trading sector, showing how I'm taking advantage of the current bull market to really get the absolute maximum out of it. And I personally still remember exactly how it was back when I started in the crypto market, when I personally had absolutely no idea about anything. Personally, I listened to the wrong people, lost a lot of money, and that's why I want to offer my community something here, that I will really go through everything from A to Z, explaining how to truly navigate the crypto market profitably, because most of the time you only see some random posts on Twitter. Maybe you watch other news YouTubers who keep claiming, hey, here's what I'm doing with Bitcoin, here I'm going long, and here I'm going short. But many people don't have any foundation at all to be able to handle this information. And that's why I want to go through everything from A to Z here, so that you are truly prepared, so that by the end of the day, you have all the tools you need to really become successful in the crypto market. Or at the very least, so that you have an incredibly strong foundation, enabling you to act independently. You will no longer have to rely on any signal groups, nor will you have to depend on YouTubers or anything like that. Of course, you can still watch YouTubers for news updates and so on, but what I really want to do here is give you all the tools from A to Z so that you can truly get the absolute most out of this crypto bull run in 2025 and 2026. So that's all I wanted to say about that for now. As I said, just a quick note, I also wrote it down. The complete knowledge originally comes from my trading academy. During the last bull run in 2021, 2022, I had my own trading academy with video courses and learning materials, and in some cases, I've reworked all that content. That's why I thought it would be a real shame not to share all this knowledge with you here again, because, as I said, this trading academy no longer exists. I had it back then, 2 or 3 years ago, during the last bull run, but now I don't have any product, coaching, or anything else that I want to sell. Instead, I really want to prepare you as best as possible for this bull run. That's why it's definitely worth taking the time to watch this. If you'd like to support me, feel free to leave a like, of course subscribe, and maybe even write a comment. It would definitely mean a lot to me, and of course, it would also help push this video a bit in the algorithm. I would really appreciate it if I could reach as many people as possible with this video. That's all I wanted to say about that for now. Now, just briefly at this point, I know it's a bit annoying, but we have to quickly go through the disclaimer before we get to the actual content. As I said, this is just a kind of safeguard for myself. This is not investment advice as defined by the WPHG. All content is solely for informational and entertainment purposes and reflects only my personal opinion. This is not financial advice. There is always a risk of loss when trading cryptocurrencies. Just because you're given the tools doesn't mean you won't incur losses. Losses, and in general, the risks involved are always part of the crypto market. Yes, even past performance and the results presented in this video are based on historical data and of course are no guarantee of future results. Personal responsibility is also important. At the end of the day, I'm giving you the tools. But you have to build the house yourself. So I explained the whole thing a bit as a metaphor so you can picture it more clearly. At the end of the day, you still have to make your own investment decisions. I definitely do not assume any liability here, nor do I guarantee accuracy. As I said, this is just a form of protection from my side. It's important. Take your time to read through everything carefully so that you are definitely well informed. Now we can definitely get started with the very first slide, namely, what is the goal of this course? What was I personally thinking when I created it? What will you walk away with after this video if you really pay close attention from A to Z and later put it all into practice? Specifically, you will be able to trade independently and confidently. That, I would say, is the goal. Of course, it's not a guarantee, because as I already mentioned, I'm giving you the tools you need. But later, you have to build the house yourself. And anyone out there who claims otherwise is definitely lying to you, because you have to realize no matter what it is, whether you want to start playing tennis, skiing, or anything else, it obviously helps a lot if you have someone who gives you direct tips, who tells you exactly what to do, like how to hold the racket or whatever. It doesn't matter what it's about. This applies generally to any skill you want to learn. At the end of the day, you can only get the tools. You can, let's say, gather information, but in the end, you have to put it into practice yourself. Yeah, that's definitely something that needs to be said. Not that you go into this with completely the wrong expectations, but still, if you really apply all the tools, you'll be able to act independently and take responsibility for yourself. You won't have to rely on any crypto YouTubers anymore. You won't have to depend on any influencers on X who change their opinions 10 times in a row or anything like that. You'll be able to conduct your own analyses. That's also the goal I want to share with you. You will definitely understand markets better than the majority of traders, better than most of the general public in this bull run. You will also be able to develop your own strategies instead of blindly following signals. Yes, and that also includes the topic of signal groups. Of course, it can help at the beginning, especially if you have no idea at all, but the goal should always be to be able to trade independently, completely free from any signal groups, completely independent of any YouTubers or influencers. Of course, there's nothing wrong with being in one or two signal groups and taking a look. Okay, hey, how do others trade? But still, it's important to me that at the end of the day, you are independent and able to trade on your own. That's definitely the goal of this video course. Otherwise, you will consciously use psychology instead of falling victim to your emotions. You will be able to avoid losses, which is also a very important point. On the one hand, of course, you want to build up capital. On the other hand, it's also extremely important to protect your account. Because once you've lost money, it's much harder to rebuild it than if you simply have clear strategies and rules that allow you to clearly avoid losses, so that you don't end up like others who are completely clueless and don't know what they're doing. So it's also important to me that you pay attention to this point. Otherwise, you'll be able to approach the market with confidence and structure. And of course, the ultimate goal should be to build up a potential side income. And with this video course, you'll definitely have the foundation for that. I'm not going to claim here that you'll instantly become a top trader or immediately make 10,000 euros a month. I'm definitely not claiming that with this video course, but you will absolutely be given all the tools you need so that later on you'll be fully equipped to independently conduct your own analyses. So, as I said, what's most important to me is that you have a complete foundation at this point. Now let's move on to a slide about who I actually am, or rather why you should listen to me. I could theoretically go into each point individually now. I could tell you everything I've done, how profitable I am. I've written my own book on cryptocurrencies. I've already helped an incredible number of people become successful in the crypto market, and I've helped countless others as well, etc., blah, blah, blah. But I don't actually want to go into too much detail about that here. You can feel free to read through all of this here. But at the end of the day, one thing matters. No matter how much experience someone has, you have to be able to form your own judgment in the end. You need to be independent, and that's why I specifically wrote, you don't have to trust me blindly. Just take a look at this course and judge for yourself whether you have a clearer understanding afterwards or not. So at the end of the day, that's the ultimate judgment. Even if I was sitting here now, or even if someone else came along with 10 or 20 years of experience, it doesn't matter if you don't get any value out of it in the end. That's why you should form your own judgment. Of course, you're also welcome to leave feedback in the comments or anything else. But as I said, I have been actively involved in the crypto market for 6 years and have done nothing else since then. And that's why it's especially important to me to share these 6 years of experience with you in a condensed form so that you have a solid foundation to build on. And as I said, the ultimate judgment isn't about what I have achieved, but rather you determine the ultimate judgment yourselves. In the end, you decide for yourselves. Did Vincent help me? Did this video provide value to me? Yes or no? So at the end of the day, that's 100% up to you. That's why there's no point in claiming what I can do or what I've already achieved. I always find that kind of thing annoying myself when I see it with other YouTubers or in other videos. At the end of the day, you'll figure out for yourselves whether it helped you or not. That's all I have to say about that for now. Now, let's move on a bit to the next slide, which is a very, very important one. I'll briefly explain again, what can you expect? What does the overall structure of this video look like at the end of the day so you don't lose track and so there's a clear structure here? We'll definitely start with point number 1, the setup, which is the basic trading equipment. So what tools do you need? Which platforms? Which exchanges? How do you set everything up? So really, from A to Z, starting with point number 1, I'll show you what's important. Then, in point number 2, we'll dive into market understanding and basic knowledge. How do markets work? Liquidity, dynamics, movement logic, and especially the market makers. How does the whole game work here? Also very, very important. Then we move on to candlestick formations. Point number 4, chart patterns. Then we get into technical analysis. We'll look at indicators and tools and how you can use the right indicators to eventually build your own strategy. Then point number 6, psychology and mindset. Also very important. Point number 7, trading styles and strategies. Here we will dive in very specifically. What strategies are there in the market? What makes sense? Point number 8, risk management and planning. We will definitely take a look at that. Also a very important point. Plus, at the end of the day, live trading and implementation. I will show you specifically how I execute my own trades, when I find entries, when I find exits, and how I get the absolute maximum out of this crypto bull run in 2025 and 2026. This chapter in particular will be extremely important and especially relevant in practice. It's definitely worth tuning in because there you can watch over my shoulder directly and see exactly how I operate in the crypto market. And I think with this table of contents, you definitely have a very, very good overview and are well prepared, and now you also have a clear roadmap in mind of what to expect. That's it for the overall overview. Now let's jump right into chapter 1, setup and the basic trading equipment you'll need here. So let's begin with the very first chapter, which is the setup and the basic trading equipment. What do you actually need? Which tools, which platforms, which exchanges do I use? The initial setup, I'll guide you from A to Z, covering what you need to pay attention to, which settings you need to make so you don't make any structural mistakes, because there can definitely be some errors, especially if you use the wrong tools. There are also people out there who claim, first, spend 500 euros on tool XY, buy something here, and get a membership there. But at the end of the day, I can tell you one thing, most of it is usually completely unnecessary, and I'll make it very clear what you actually don't need. We'll focus strictly on the basics here, what's absolutely essential, so you get a clear overview, what's relevant, what's less relevant. And as I said, I'll show you everything from A to Z, how to use everything, how to set everything up, and so on. Now let's definitely start with point number 1, choosing the right crypto exchange. As a beginner, this can definitely be extremely confusing. There are now hundreds of exchanges, and one thing I can tell you, in my 6 years of crypto experience, hard to believe, I know, but if I look at this whole list here, I probably have an account or have traded on every other exchange at some point in the past. So I have quite a lot of experience with different exchanges. There are very clear advantages and disadvantages. Obviously, it has to be said clearly, there is no ultimate best exchange that clearly beats all the others. So anyone who claims something like that is definitely lying to you. There are definitely several options. There are several things that are perfectly fine. One thing I would definitely pay attention to, make sure that the exchange you use has enough trading volume, because then you'll definitely get better spreads. Otherwise, you'll end up paying too much due to the difference between your entry price and the price at which your trade is executed. It's definitely an important factor to have low spreads. So there needs to be a certain amount of volume. That's why I would recommend that you avoid anything ranked 50th or lower. I definitely don't want to speak badly about any exchange here. There are certainly some really good startups that do a lot of things right, but an important parameter is definitely that there is enough trading volume. Point number 2, which is important, is the right fees. At the end of the day, you definitely don't want to pay a fortune in trading fees. There are definitely also some hidden costs sometimes, so make sure that the fee structure really fits so you don't end up paying way too much. Then, the next point you can look at, as shown here, and anyone can check this at home on CoinMarketCap. These are the top crypto exchanges at the current time. Number of markets is also important in my opinion, especially if you want to trade some altcoins later on. It's definitely helpful to choose an exchange that has at least, let's say, 100 different markets. Of course, it depends on what you want to trade. There are clear advantages and disadvantages here as well. If you only want to trade Bitcoin, it doesn't really matter to you, but personally, I also like to trade a few altcoins from time to time. Otherwise, you can take a look at how long the exchange has been around. There are clear advantages and disadvantages to that as well. Of course, you can also go with the old hands. They're always fine. I've tried everything from 1st to 5th place myself. It's definitely legitimate to choose an exchange this way. The only disadvantage I see with the bigger ones is that you have to go through verification everywhere. And it's usually super annoying because sometimes it doesn't go through or there are other issues. Personally, I prefer an account where I just need an email and password without having to provide documents or anything else, because that can sometimes be a huge headache. Especially with this MyCA regulation, it can sometimes also lead to problems. As I said, at the end of the day, the decision is yours. There is definitely no ultimate best or anything like that. Personally, just so you know how I go about choosing the right exchange. Personally, I want good fees, low spreads, and I don't want to pay through the nose. I want to have enough trading volume. I definitely want to have a clean interface. I want to be able to find my way around easily, and at the end of the day, I don't want to have headaches with any documents or anything else that need to be submitted again where an account gets blocked or something like that. That has actually happened to me quite often. As I said, I've tried so many exchanges, but for me personally, in my opinion, in the year 2025, after having tried countless exchanges, there is, in my view, a clear winner when it comes to trading. And in my opinion, that is Bitunix. We really gave it our all there. We have an extremely high trading volume, which means incredibly low spreads. We have very good fees, which is a given. We definitely have other parameters that are right. We have an incredible number of markets available. We can trade a number of altcoins. And the big advantage, in my opinion, we have a new exchange. Most of the time, it's the case with exchanges that are a bit newer that aren't completely old and established like the old veterans. That's often the case. You get the best bonuses, the best sign-up bonuses, so to speak, when you create a new account. Exactly, these exchanges still have to prove themselves at first, and that's why they're usually the best when you have a nice middle ground. Let's say an exchange that's already well established, that has a lot to show for itself, where at the end of the day there are no problems, where you don't have to submit unnecessary documents, where you can simply create an account with email and password and get top fees. In my opinion, that's Bitunix. As I said, at the end of the day, it's your decision, but at this point, I've clearly chosen Bitunix, and all the live trades will be executed there later on, just so you're aware. So especially in Chapter 9, I'll show you everything on this platform. I'll explain everything to you. Where are the individual parameters? What makes sense? How can you open positions? How can you scale up trades, and so on? That's why it obviously makes sense if you're watching this video course to also use Bitunix. Logically, that would also support me and my channel. So one thing should be said about this. I want to be 100% transparent with you. Of course, if you use the link in my video description, I earn a portion of the fees, which would obviously support my work here, because otherwise I don't get paid. Of course, I earn a little bit from, let's say, the YouTube views, but that's really just a few euros. So if you want to support me, you are more than welcome to use the link in my video description, and by doing so, you will definitely be supporting me as well. A big thank you goes out to you, and to give something back, I have set up an exclusive campaign just for this video course, together with Bitunix. As I mentioned, I negotiated quite a bit for you and made sure to follow up so that you get the maximum benefits when you sign up as a new user. So the first 300 people will each receive $10 completely free as a gift. That's the first point, which is pretty nice. Plus, depending on how much you deposit, you'll also get a completely free futures bonus, which you can use later to make trades. It's incredibly convenient, an absolute no-brainer, so it's definitely worth it. On one hand, it would support me, and on the other hand, you'll also save on fees by using my link. The fees are already low anyway, but you'll get an additional discount on fees, plus, as I said, a substantial deposit bonus. So it's definitely worth it to grab this opportunity, because there's really a lot being offered here, and as I mentioned, I'll be executing all live trades there later. And now I'll briefly transition to the point that you can easily find your way around the platform, so you know exactly where to do what and what you need to pay attention to. And later, I'll also show you directly how to execute trades in the futures section, so you'll get a clear step-by-step guide from A to Z, using Bitunix as an example. And as I said, I've already executed many trades here myself, and in my opinion, this is the top exchange you should be using. That's why I'm going to give you a complete setup guide here. So let's start at the top left. There you can theoretically buy crypto if you want to make a deposit. If you already have crypto, you can go to this wallet here, then click on spot account, and later, once everything has loaded, when you're in your spot account, in your wallet, as I said, all at the top right, you can click on deposit here, and when you click on deposit, you can basically load cryptocurrencies here. As I mentioned, if you did it using the link from my video description, so in case you're wondering, you'll definitely get a notification up here at the top right in the bell icon, and that's where you'll receive your full bonus. Basically, if you use the link here, you'll receive the bonus according to what you deposit, and as soon as you have the bonus, you just click here. Then you can also go to My Rewards, and once you see the rewards, you'll have a complete overview here. That way, you'll be able to see all your rewards and always have a clear overview. If you have any kind of problem at this point, feel free to write to me on Telegram in case there's any issue, like if the bonus doesn't arrive or anything else. But that's never happened before. But as I said, just in case of emergency, you're welcome to contact me on Telegram here as well. I'm always happy to help you out if you have any questions here. Otherwise, as I said, you go to your spot account, click here, then you can make a deposit, and at that point, it should also be displayed here in your asset overview. You'll basically have a complete overview here. Where are your assets located? In my case, I've loaded $790 onto the spot account, the regular account, and $5,000 are loaded onto the futures account here as well. So you know how everything works, and if you want to execute all your trades, as I said, the spot account is for regular buying and selling, and your trading account is the futures account. What you can basically do is go up here to transfer, click on it, and then you can transfer USDT from your spot account to your futures account. Here, you simply enter the amount, for example, $500, and then you can click on submit, and the whole amount will be transferred to the futures account, and then you can later trade directly with the USDT. In my case, I went ahead and loaded $5,000 directly onto the futures account. Once that's done, you're basically ready and set to go for all the trades later on. Otherwise, here you have an overall overview of your wallet. At the top, you now have the option to click on either futures or spot. Just a quick explanation, we'll go over this briefly. Spot simply means buying and selling as usual. For example, if you want to buy Bitcoin without leverage, without trading or anything else, here you can use the gear icon to set how much Bitcoin you want to buy. In this case, maybe 50%, or for example, for I don't know, 500 USDT, then at the end of the day, you can click on buy Bitcoin down here on the bottom right. I'll move the face cam to the left on purpose so you can see here that you could theoretically buy Bitcoin. But in our case right now, that's secondary. Because of course we want to execute all the trades, and if we want to trade, we go here to the futures button right up here. We click on it here, and now we basically have an overall view, including the Bitcoin chart. So we basically have a nice overview here. By the way, later on we can draw in all sorts of things here. So here we can draw all the lines, we can add indicators, and so on. It's definitely quite convenient. Just so you know, the chart here is actually sponsored by TradingView. So basically, a TradingView chart is integrated here. We'll talk about how to use TradingView in just a moment. But still, it's really, really nice that we basically have a kind of partnership with TradingView here, because in my opinion, and as I said, it's not just my opinion in this case, TradingView is the best charting platform out there. Pretty much everyone uses it, really about 95%. I don't know anyone who uses anything other than TradingView. That's why it's definitely very convenient here that you can immediately find your way around with all the futures and, let's say, everything else you need. But we'll get to that in more detail later. Don't let that confuse you. All of that will be covered in the other chapters. For now, I'll just give you a quick overview. At first, it looks very, very complicated. You might be wondering what's going on here. What do I need to pay attention to? What are all these numbers? What do I actually need and what don't I need? So now let's talk about each of these points. Here, we have an order book. What we can see are the sales, the purchases coming in, and the current price. That's quite interesting. It's kind of nice, but honestly, it's not really that relevant for trading. You can theoretically also make the whole thing smaller here. It's also very, very interesting because in this case, you can basically configure your entire trading interface yourself, depending on what you need and what you don't. We can also go into the settings here, click on layout, and then arrange everything the way we want it. We can basically change and arrange the individual elements here. In this case, I moved it to the left, but in this case, I want to move it back to the right. That's actually the default setting. Down here on the right, you can also see what you want to have displayed and what not. I'll just turn the order book back on now. As I said, the order book is rather secondary, but still, it keeps things consistent, so to speak. Otherwise, we now have all the settings here. Now it's getting a bit more practical, a bit more specific. So how do you actually execute all these trades? As I said, you've created an account, you've deposited funds here, and you've transferred everything to your futures account. That's why in this case, we see 5,000 US dollars loaded here. Now we come to the very first setting, which is very important to address. You can choose between cross and isolated. So very briefly, what's the difference? With cross, it's like this. Cross is actually a bit riskier. You have to be careful. Because for example, I now have 5,000 US dollars in my trading account. Let's say I enter a Bitcoin trade with 1,000 US dollars. If the Bitcoin trade then gets liquidated, meaning all $1,000 are eaten up, with cross it actually works like this. The remaining 4,000 US dollars are still used to basically add more margin to keep the trade open. With isolated, only what I put in is actually used for the trade. And especially for beginners, and actually this doesn't really have anything to do with being a beginner or advanced. So it's not like there's a pro mode and a beginner mode, but in general, it's much better. And I personally almost always trade using isolated because then I can only lose what I actually put in. Otherwise, it can get dangerous. Otherwise, you might think, okay, I'll just open a relaxed trade with, say, 50 US dollars, and suddenly the trade goes the other way and your entire trading account gets wiped out. And that's why it's so important to use isolated mode. It should be noted that with cross margin, if you set a stop loss, it doesn't really matter because you already have protection through the stop loss. But it can happen, especially as a beginner, that you make a careless mistake, so definitely use isolated mode. It's by far the better mode, and personally I almost exclusively trade using isolated mode. So confirm it here, then you'll see everything displayed up here on the top right. In this case, you've now set it to isolated. Now let's take another look here. What can you set here? This is the leverage. So basically, what level of leverage are you applying to your trade? For example, if you want to use 1,000 US dollars in a trade here with 10x leverage, then your position isn't just 1,000 US dollars, but 10,000 US dollars. It's a relatively simple calculation. It's basically a kind of multiplier. At this point, it's important to clearly mention that leverage carries a certain risk, because you have to imagine if you use leverage and, for example, Bitcoin pumps 10%, then with 10x leverage, you haven't just made 10%, but logically 10 times 10, so 100%. So you've basically doubled your position, even though Bitcoin has only gone up by 10%. But of course, now comes the tricky or dangerous part. It works exactly the same way in the other direction. As soon as Bitcoin loses 10% in value, and logically you multiply that by a 10x leverage, then as soon as Bitcoin drops 10%, your entire position is gone. So really, everything you invested is lost in that case because it's been multiplied by a factor of 10 with the 10x leverage. It's really important to understand this. It's pretty self-explanatory. It's not something super complex or rocket science, but it is important to understand how leverage mechanics work here. So definitely be careful with this. Please don't use 100x leverage in this case. It's really not recommended. Anything above 50x leverage is basically just gambling at the end of the day, and I really don't want you to end up gambling away your trading account or anything like that. Take it slow and ease into it. Start with low leverage. Try out 5x or 10x leverage first. Be careful, always use a stop loss, but I'll talk more about that later during the live trading. I'll go into more detail about that later, how to use leverage properly, and how you might even use higher leverage if your position is already in profit. That way, you can basically scale up your trades. We'll also cover that point, but more on that later. That's all for now on that topic. Here, you can set the leverage for your long position. For example, how high do you want the leverage to be? At this point, I'll just set a leverage of 10. It's a simple calculation. I'll also set a leverage of 10 for the short position, then click confirm here, and everything is nicely set up. Now we have the option to open or close positions. In our case, we obviously don't have any active positions running, so we want to open positions. That's clear here. Now there's another very important difference. The difference between a limit order and a market order. On one hand, we have the option to place a limit order. With a limit order, we can set when our trade should be opened. Let's say, for example, Bitcoin crashes overnight to 111,000 US dollars while we're asleep. In that case, of course, if we're asleep, we can't open a position, or maybe we're out and about or something else. That's when it's especially convenient to place a limit order. For example, I can set it so that I want to buy more Bitcoin at exactly 111,000 US dollars, and then I can basically open the position, click on open long, and the position is then essentially set up. And as soon as Bitcoin drops to 111,000 US dollars, the position is executed and carried out, and that's when the long position is opened. That's how the whole thing works with a limit order. I can also show you how to do it if you'd like. At this point, I always recommend that you set it to specify the amount in USDT. Yes, just confirm the normal cost value, because that way you'll have, so to speak, the best overview, since everything will always be calculated in USDT. In this case, I'll just use $100. I now want to open a Bitcoin long position for $100 with 10 times leverage. Now in this case, I can click on open long here. What do we see here? Current price, the amount in Bitcoin, the margin is the $100 we're using. And in this case, we can see here that the opening price will only be triggered when Bitcoin reaches 111,000 US dollars. And that's why we can confirm everything here. So what happened? In this case, we haven't opened an active order, but what we can already see quite clearly here is that for the sake of clarity, we can remove it in this case. What we see here now shown in green is our limit order. Yes, and in this case, it's not displayed under active positions, but rather under open orders. So let's go in there. What do we see here? Open orders. It's basically still pending, as we can see here. Bitcoin, isolated, 10x leverage, a long position will be opened at 111,000 US dollars. And only when Bitcoin drops to 111,000 US dollars will the long position actually be opened. What we can also do, if we change our mind, is move the long position within this interface. We can now move it up to 113,000 US dollars. Then we'll get another notification, edit order. Let's process another info order, and then we can simply click confirm here. Boom, and immediately we're at 113. Working like this is incredibly pleasant. It works unbelievably smoothly. Yeah, and that's why I like Bitunix so much, because it's just so easy to make changes here, I have to say. It's not complicated at all, and I have to say very, very intuitive. That's why, as you can see here, we can also just quickly click the cross here, cancel the order, very easy, boom, and the position is gone and no longer exists. We can see it here, open orders 0. I'll show you the whole thing again really quickly. Yeah, for that, I'll move the face cam up a bit here. And now, I want to show you how to open a position instantly. This is done using a market order. We just click here on market, and then we can set the amount we want to enter the trade with under cost value. So in this case, again, I want to put $100 into the trade. As mentioned, keep in mind that we have the 10x leverage activated. This means the position will later be $1,000 in size. Yes, in this case, you also have the option to set everything using the gear icon, but I actually recommend that you specify directly in USDT how much you want to enter the trade with. In this case, 100 US dollars. What we definitely still need to cover at this point, which is a very important point, is this button here. It's very, very inconspicuous, but it will become very important later. Here it says TPSL, which stands for take profit. So when will our trade be closed in profit, and when is our stop loss, our safety net? In this case, we click on it once, which basically activates it, and now we can set when our trade should be closed. Currently, the Bitcoin price is at 118,000 US dollars. Maybe I'll say, okay, hey, I assume Bitcoin will go up to 125,000 US dollars. Set that up here. In the same way, we can also protect ourselves here. When should the position be closed? Yeah, maybe I'm afraid that Bitcoin might, I don't know, drop to, in this case, 115,000 US dollars. As soon as Bitcoin dips here and maybe breaks below this last low in this case, I want to exit the trade. As I said, this is just an example. Then I enter 115,000 US dollars here, and now I've basically set my take profit here and my stop loss here. Yes, and that's very, very important. Theoretically, you could also do it afterwards, but most of the time it's recommended to think about your setup right from the start. When do I enter? Yes. When do I exit? And where is my stop loss? And that's why we can go ahead and open a long position here. Now we have a nice overview here again. We're basically entering directly at 118,000 US dollars. Theoretically, yes, as I said, we've set a 10x leverage. Then, theoretically, we would be liquidated at an estimated liquidation price of 106,000 US dollars. As I mentioned, we've set a 10x leverage, but one thing, in this case, we've set a stop loss. This means we won't be liquidated here, but rather, due to the protection from the stop loss, we'll actually be liquidated a bit earlier at 115,000 US dollars. By the way, you can also see here the estimated fee deduction from the bonus. As I said, if you use my link, you'll definitely see that the bonus is active. That definitely saves you quite a bit, and that's why we can go ahead and click confirm here. And what just happened now, you might have heard it briefly, the position is now actually open. We can take a look at the whole thing here in this case. I'll move the face cam up, and then you can see right away at the bottom left that the position is running. Here we can see the position size, just under 1,000 US dollars, the reference price, the estimated liquidation price, basically everything as we set it up. Now we can see our trade here. It's currently moving into the positive. We're now, let's say, a few cents in profit. As I said, it's rather minor. Of course, you have to be patient now and wait. And here, based on this, you can see how much are you in profit or in the red. In this case, we're now 50 US cents in profit. Now it's definitely getting interesting. Now we can take another look at the whole thing here. And that's why I love Bitunix so much, because everything is so clearly marked out in the chart. Here, for example, we can see our liquidation price. When, basically, is it game over? When is our trade completely at zero, in the red? In this case, that's at 106,000 US dollars. As soon as Bitcoin dips to that level, our trade is completely gone. Then we've basically thrown away our entire $100. But of course, one thing, if you've been paying attention, and you can already see it here, in this case, we've set a stop loss. The stop loss is our safety net. This means that as soon as the Bitcoin price drops to 115,000 US dollars, our stop loss will be triggered. That means the position will be closed at that point. So in this case, the stop loss is set at 115,000 US dollars. Therefore, the maximum we can currently lose on this trade due to the stop loss is in this case minus 23 US dollars. So, as I said, the worst that can happen now is that we lose 23 US dollars if Bitcoin drops to 115,000 US dollars. As mentioned, it is set up that way. Yes, here we can see our current position, $1 in profit. And up here, if we scroll up, we can see our take profit at 125,000 US dollars. Let's click on it. If Bitcoin reaches 125,000 US dollars, we will have taken a profit of 54 US dollars. So that's basically the current state of things. This is basically a projection of what we can expect once Bitcoin reaches that price, which by the way could happen at any time. You can always change your take profit or stop loss afterwards, super easy, super smooth, right here in this chart. You just click on it, click, 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 and you can move it up or down as you like. We can now move it up to 130. It's accepted immediately, moved instantly. It's very convenient on Bitunix. In this case, we can also set the stop loss even lower. In this case, we can also see success here. Yes, everything worked, and you can see right away how you can change everything super easily in the chart, how you can move the stop loss and take profit up and down very, very smoothly at any time. What I want to show now, how do you close the position? So let's say you don't feel like it anymore, you want to get out for whatever reason, and this is completely independent of stop loss and take profit. Basically, the trade is set. In theory, you don't have to look at it anymore, you can go to sleep. Of course, you still need to do trade management. We'll talk about that later. How you adjust your stop loss afterwards, adjust your take profit, etc. That will become very, very important later on. But just briefly, if you say, okay, you don't feel like it anymore, you theoretically have the option to click directly on the X here, which is close instantly. Then the trade is really closed immediately. You can theoretically do that. But what you can also do is take partial profits, so to speak, or reduce part of your position. To do that, you can look at the amount in the bottom left corner. For example, you click on 50% and now you can close only half of the trade. And then you basically click here, as I said, 50% in this case, go to close, and then only half of the position will actually be closed. Then you click on confirm, and now your trade is only half as large. In this case, the margin is only 46 US dollars. If you remember, as I said, a few minutes ago it was still at 100 US dollars, and in this case, the entire trade has changed, and this way you can gradually reduce your position step by step. you can take out another 50%, and then the margin is only $23 US. And of course, you can scale the trade down or up in this way. That's obviously very important. If you really don't feel like being in the trade anymore, you can either click the X here or select 100% here and then click close. The difference between close and quick close is actually minimal. With quick close, it's executed immediately, while with close, it can take a few seconds. In that case, you save a small amount on fees because the system doesn't execute instantly at market price, but instead tries to find a good counterparty for you. That's why it usually makes sense to use close here. You can also see here that thanks to these bonuses, you save quite a bit on fees. Click here on confirm, boom, and then you'll see in the top right, here in the face cam, if you caught it for a moment, the position was successfully closed, and now you can see here, in this case, no data is available. Currently, there is no open position running, and I think this has given you a good insight into how to open positions, close positions, and execute trades individually. And I think based on this, you've now got a good overview of how to open positions, how to close positions, and what you need to pay attention to. Yes, and with that, I think you've definitely understood the basics. There are still some subtleties that can be made, I would say, but at least you know, how do I open a trade? How do I scale up? Yes, which lever can I use? Etc. So that is definitely very important too. By the way, you can also adjust the leverage later if you add more capital. Yes, in itself, it's also important to have shown that briefly. That's why I'm going to explain it again here briefly. I'll show you again how you can do something. In this case, we'll do it again using the example of opening a long position with $100. As I said, I'm going to do it quickly now without a stop loss or take profit, because you can actually set those up afterwards as well. So after the position is open, you can just click here on position, then take profit or stop loss. So you can easily set all of that up afterwards. So don't worry about that. That works too. Yes, and as I said, what you can also do is click here afterwards, and then you can even scale up the leverage retroactively. That can, of course, be a strategy. If your trade goes into profit, you don't necessarily take a lot of profits, but instead, you reduce the margin and scale up the leverage. That's possible too. You can set it to 25x leverage. Then it's important to understand that your position hasn't automatically been switched to 25x leverage. Yes, so that's really important to mention. The whole thing always has to be done manually. So there are several ways to do it, but in theory, you can reduce the margin on one side and then add more margin again. That works too. For example, we can now add another $100 here, but this time with, say, 20x leverage. Then we can click on confirm. You can open a long position here again, because what just happened is actually very interesting. Namely, we now basically have double the margin in there. Yes, we've basically put in $100 twice now, or just under $100 each time. And now, in this case, we've increased the leverage by adding more margin, so to speak. And of course, there are several options. You can first reduce your margin, then reinvest the margin you took out at a higher leverage. That's possible, of course. Or of course, you might have fresh capital and can scale up the leverage afterwards that way. We now have a position size of $2,700 simply because a 20x leverage is now active. We can also do it here again, and this is the maximum by which you can reduce the margin, so to speak. We click on confirm, and then you can see here as well, the margin has been reduced. What I just wanted to explain, we can add margin afterwards. This way the leverage is increased afterwards. It was important for me to explain that. We can also reduce margin afterwards. Yes, but that only works up to a certain point. It's important to mention this because otherwise the entire trade would basically implode, and here we can take partial profits or close partial positions. Here we can reduce half of this trade, so to speak, click on confirm, and see success here. What happened in this case? We see close Bitcoin long at the top right, and now half of the margin has also been reduced here. Yes, in this case, half of the trade has been reduced. Now we're only in with half the position. This way, you can basically reduce the entire trade in this case. You can increase the margin here, basically add more margin, or decrease the margin. Just so you're aware, I could also add another $100 here at this point. Done. Then you'll see here, you just have to wait a moment, and it's successful. Then you'll get the confirmation right away as well. We can see here that there are $169 in the margin, and accordingly, everything has increased here again. So, depending on how you set everything up and how you increase the margin, but I always recommend adding more to the margin as well. As I said, it can sometimes be complicated because there are several options, but theoretically you can also use this interface here, which is usually easier to add more capital. So, for example, open another long position with $100 at 20 times leverage, and then you'll see it gets added here. So, open a long position, confirm, and then you'll see right here that the order has been placed. Then you just have to wait a moment, 1, 2, 3 seconds. Then you'll see here that the Bitcoin long position has been opened. The margin has been increased, and accordingly, the total position size has been recalculated based on the leverage that was set. Yeah, so I think you've definitely gotten some information here now. We can now click on 100% again here and close 100%. Here, you have a nice overview again, confirm it, and then everything is done at this point, or rather, right, it always takes a second or two. That's, let's say, the difference between closing normally and using the quick close. If you click on quick close, of course it's closed immediately, but you pay slightly higher fees because the spreads are also a bit higher. I wouldn't necessarily recommend it unless it's really, well, an emergency or something, then that's a different story. So at this point, you've definitely gotten a detailed overview from A to Z. I really talked for a very, very long time, but it's really important to me to show you everything. There are some people who just briefly show, open, long, and short here, but it's also important to understand how you can add margin. How can you increase the leverage afterwards? How can you add more capital here? This is so incredibly important. How can you take partial profits, etc. So it's really fundamental for trading later on that you understand everything from A to Z. I think it was definitely clear. And as I said, you should definitely have no problems with Bitunix. Everything runs very smoothly, very cleanly. The spreads are also extremely low because there is sufficient liquidity, and especially if you're just starting out, if you're feeling a bit unsure, definitely use the link and take advantage of this bonus first, because then you have nothing to lose, since the bonus will be used up before your own capital is touched. That's why it's definitely worth it until the 30th of September. That's all for the topic of Bitunix. But now, at this point, I want to wrap up this topic. You definitely know, so to speak, how to set everything up and how everything works. Now we'll continue with the TradingView tutorial. Here as well, I'll give you some important pointers on what you need to pay attention to. At this point, you can simply search for tradingview.com in your browser as usual. It's relatively simple, and then you'll have an overview right away. I can also go straight to the homepage so you can really see what it looks like when I'm on TradingView for the very, very first time. As I said, in this case, tradingview.com. In this case, you go to products and then here to super charts, click on it once, and then you'll be taken directly to a chart. If you don't see Bitcoin here, you can simply type in which trading pair you want. In this case, I've entered Bitcoin to US dollar here. You can also, for example, look up Ethereum at this point. That's always important, especially with altcoins. Don't type in Ethereum, but instead enter ETH and then US dollar. Yes, and then you'll see all the trading pairs listed here. There are different providers like Binance, Coinbase, and Bitstamp. It doesn't really matter which one you choose, but what I recommend is to always choose the indexed one. That way, you have all the data from all exchanges included, because it's indexed and not just from a single provider. Because sometimes, well, I wouldn't call them minor errors, but there are occasional outliers that only occur on Bitstamp or only on Binance, but not on other exchanges. That's why it's always advisable to use the indexed option here. And as I said, the same applies to Bitcoin, specifically Bitcoin to US dollar, and here, choosing the index makes the most sense. Then you're in here. Of course, at the end of the day, you can set everything up however you want on TradingView. You just right-click, go to settings, and then you can theoretically set up how everything should look for you. Yes, we can also make the green candles green if you like, so you have them basically green and red or blue and red. Yes, ultimately it's all a matter of personal preference. By the way, you can also adjust all of this here. You can either have bars here, this is what it looks like then. I clearly recommend that you select the candles. This is, let's say, the standard settings panel for trading later on. You can also see all of this, for example, on Bitunix. It's exactly the same. So the default setting is always a standard candlestick chart, just so you're aware. That's why we'll go right back here. And this is basically the normal setting. You can sometimes set it to line, but it doesn't really make sense. When it comes to trading, no one trades with a line chart because you really need to understand these individual candles in practice. Just a quick explanation on that, but I don't want to go too much into detail about the chart itself right now. If you're still having trouble with that, there will be a brief explanation later in the chapter about how a chart actually works. But just for clarification, each individual candlestick body here represents, in this case, 4 hours. You can also display it, for example, on a daily basis. In that case, one candlestick body represents 1 day, or if you set it to 10 minutes, then one candlestick body represents 10 minutes. But as I said, I'll go into more detail on that later. That's basically the default, so to speak. The very first thing we always do is get an overview, so to speak. Yes, in this case, you can also briefly look at it on a weekly basis, but the overview is always done on a daily basis. We take a look at what Bitcoin is doing on a daily basis. And then you work your way down step by step, looking at what happens on a 4-hour basis, what happens on an hourly basis. And the more closely you want to observe the chart, the smaller the time frame becomes, also called, basically, the time unit in which the chart is displayed. That's pretty much all there is to say about that for now. Yes, I think that's, so to speak, the most important area up here. Then you can add indicators here. Of course, you have certain favorites here. Indicators that you might want to use more frequently. For example, I have an RSI in there. That's a very typical one, but the topic of indicators in general will all be explained in more detail later. I'll go over it again. So please don't worry about how everything works just yet. It might look complicated, but later on I'll go into more detail about how to use the indicators. But here you can basically set up indicators. You can also add a MACD, just click on it. Boom, and then everything is added right here. And if you want to remove it, just click on the trash can and it disappears immediately. That's all for now on the topic of indicators. Next, there's the alarm section. You can set alarms if, for example, you want to receive a notification when Bitcoin reaches a certain price range. In my opinion, this is rather irrelevant, because later you'll also get notifications from Bitunix about what your trade is doing, so you're always up to date anyway, since everything there is specifically tailored to your trade. But I'll put it this way, in TradingView, you could theoretically do it as well. Otherwise, there's a kind of playback mode. With that, you can, so to speak, simulate the past. It's quite nice, but irrelevant for you, especially if you're actively trading. It's mostly used for YouTube videos and explanations. That's all there is to say about that in any case. Up here on the top right, you have your layouts, meaning the different charts you've saved. You can navigate through them quite easily. For example, here I have the Ethereum chart relative to Bitcoin. Then I have everything listed here directly. You can also create watch lists up here on the top right, for example, for individual altcoins in Ondo. Then you can quickly click through the different altcoins here. You can take a look at everything here pretty quickly. It's really, really convenient if you've saved things here, so to speak. You can do that, but you can also do it using all the layouts here. Now in this case, let's go back to Bitcoin, and down here on the bottom right, you can also minimize everything, making it all nice and clear again. That's all for the points up here for now. The rest is irrelevant. Of course, you can take screenshots here for public use, but I personally don't use that, and I want to keep things as compact as possible here. There's no point in explaining any weird features to you here. But now, things are about to get important again. So stay focused for just a moment longer. I know it's very, very dry when it comes to trading tools, but TradingView is incredibly important and you need to know how to use it. So here's a quick rundown again. What do you actually need from the left side? There are definitely some important tools there that you'll need. At the very top here, we have your crosshair tool. I think that's self-explanatory. The first important point here is the trend lines that you can draw. With these, you can basically draw support lines here, or for example, upward and downward trend lines. That's relevant. You can also edit them at any time here, adjusting the opacity, the color, and even the thickness as needed. Yes, the next thing we have here are different types of lines. A ray, info line, trend angle, which is rather irrelevant. Support lines, of course, are very relevant. You can always draw them in again for a better overview, so you can roughly see where the individual levels are intended to be. That's definitely relevant as well. So, to summarize the section above, the trend line is important, as is the support line, those 2 points. Then, of course, a trend channel can also be interesting. If you identify a downtrend here, it's relatively clear and can definitely be helpful, and I think a lot of it is self-explanatory. Some things are also unnecessary. For example, something like the pitchfork, I personally have never used that. There are a few things I wouldn't necessarily include. It always depends on your trading style. But please don't let yourself get confused by any strange tools here. There are also things here that I, as a trader, have never used in my life. Yes, a lot of it is really unnecessary to some extent, but there are a few things that are actually fundamental and important. What is very, very important, in my opinion, is a Fibonacci retracement. It sounds complicated, and might also look complicated at first glance. But I will go into more detail about this later in the indicators chapter. What is it all about? How do you use it correctly? This is very, very relevant, but as I said, you'll have a separate chapter on that, so it's worth sticking around for the full video. That's all for now on the topic of Fibonacci. Then, of course, there are different Fibonacci tools. There's also a Fibonacci channel, which you can use from time to time, but it's actually rather irrelevant. The most important thing is really just this basic Fibonacci level, the standard one. Other than that, I've personally never used something like a Fibonacci circle either. I'm being completely honest with you about that. The only important thing from category number 2 is just the Fibonacci retracement level. Then the next category is also somewhat useful. Of course, in this case, there are also things like Elliott wave analyses. They could be interesting depending on your trading style. For me, they're rather irrelevant. Yes, Elliott waves, simply because I have a different trading style, but of course, they're still valid. So here, you're definitely informed as well in case someone trades with Elliott waves, but it's not my style, and in my opinion, Elliott waves are also not the optimal style for crypto trading. We'll talk about that later, especially when it comes to liquidity heat maps and the topic of market making. It's much more relevant to understand the background. It's much more relevant to understand market making itself and to grasp the distinction, the differentiation between retailers and market makers, rather than focusing heavily on Elliott waves. Still, I don't want to talk down Elliott waves. There is definitely a justification for their existence. Otherwise, you can simulate long and short positions here. That can be quite convenient. But honestly, I would always do that within an exchange. I would always check here to see how things look with long and short positions, so you can calculate it for yourself. Honestly, I wouldn't necessarily do that in TradingView. You actually have them here as well on Bitunix. At the top right, I also sometimes use this calculator, the calculator icon, to calculate and work out the details for each individual trade. So you can do this in TradingView, but you don't have to. Then of course, there are various other features here that you can use from time to time. Sometimes I use it in the videos to make predictions, but it's actually rather irrelevant. You don't really need it for trading. The next things are actually more tools as well, mainly for giving explanations in YouTube videos. You can draw things here. All of this is really intended more for YouTube videos, for visualizations, the whole set of tools, including the individual arrows. Of course, it can be helpful sometimes, but it's mostly unnecessary, not really relevant for being able to execute trades or even for something like a rectangle. It gives you a nice overview of where supports might be, but it's not really essential. You can play around with it a bit, just like with text. You can type things in here, but in this case, it's also rather irrelevant for you. And apart from that, there's really nothing else here you need to pay attention to, any emojis or anything like that. As you can see, there are actually only a very few tools that you really need on a daily basis. The only other thing that's very important is the ruler here. With it, you can easily measure how many percent Bitcoin has moved here, how many bars are given, over how many days, how much volume, and in this case also the price range. That's definitely very convenient. I also use it very often to measure small things. For example, you can measure the move here, 1.2%, and you immediately have an overview, but that's basically it. So as I said, a quick summary, you need trend lines, you need support lines, and you absolutely need Fibonacci levels here. They are very important. We'll talk about those later. Everything else here is irrelevant. Also here, if you don't trade with Elliott waves, it's pretty much irrelevant as well. For pattern trading like head and shoulders. Those are just small exceptions you can use, but even then, you don't really need them. So really focus only on the relevant points. Use the measuring tool, use Fibonacci levels from time to time, use the trend lines, and you really don't need anything else. Don't let yourself get overwhelmed here, and the rest will be explained again anyway. All the indicators, don't let them drive you crazy either. I'll go over the most important indicators later on, how to use them, how to set them up, and so on. As I said, you can set all of that up here as well, but you'll get more detailed information on that later. That's all for now on the topic of TradingView. So we can definitely wrap up the topic of TradingView here. Of course, there's also CoinMarketCap. Earlier, I showed you an overview of that. There you can see all the cryptocurrencies listed. This is the #1 tool, in my opinion, to get an overview of all the cryptocurrencies out there and to see what's currently trending. There you also have the Fear and Greed Index that you can check out. Is it currently altcoin season or Bitcoin season? Well, it depends on how you trade. If you trade on a daily basis, you might not necessarily need CoinMarketCap. It's more specific for individual projects, but still it's the #1 tool and it's very basic. Yes, so really, everyone should have this, even if it doesn't have anything to do directly with trading. Yes, so I definitely wouldn't do any analyses in CoinMarketCap either. No professional, experienced trader does that. All of that is done in TradingView, but for a quick overview, CoinMarketCap is always very convenient. There you can also see the daily winners, daily losers, and especially if you want to trade altcoins later, it's definitely interesting to check, okay, hey, what's going on? Where are the trends? What's currently trending, so to speak? You can always take a look at it from time to time. If I see here, oh, okay, Dogecoin is trending, it's probably because a huge amount of volume has come in recently. You can see here, plus 85% in daily volume. And that can, of course, be very exciting for nice trade setups. For example, if you see here, okay, hey, a lot of people are talking about Dogecoin, there's a lot of volume right now, then it can sometimes be easier to catch these trades when, let's say, there's a lot of hype, when price jumps can happen relatively quickly, and when there's a lot of volatility. You can also see it here, based on the trading volume. There's quite a lot going on. This is basically where the party is happening right now, so it's quite interesting and nice to take a look here, but it's definitely something everyone should have seen and heard about at least once. CoinMarketCap, then the next tool. This one is already a bit more specific, so to speak. You have to think twice about whether it's worth it. Personally, I definitely paid for a subscription to it. For me, it's worth it because of the YouTube videos. For you, I would actually say it's more of a secondary thing. It's only optional because in this case, we're talking about the tool Into the Cryptoverse. In my opinion, this is the best tool for on-chain data, especially for logarithmic regression. You can take a look at it here. There, Bitcoin is nicely displayed over a longer period of time. Well, in this case, it's Ethereum. You can switch to Bitcoin here, and then you can see how Bitcoin has behaved since 2012. Or for example, you also have the well-known rainbow chart here. So you really get a lot of features with this. There is a lot of very interesting information. But this is more, I would say, geared towards spot trading. Yeah, so if it's purely about trading, I would clearly say you don't need it. It's definitely secondary. But if it's about cycle trading, spot positions, or buy and hold strategies, then it's definitely worth checking in here from time to time. There are also a few charts available with the free version, but if you want to go into more detail or act more professionally, then it can definitely be worth it to get a subscription here. But as I said, let me be clear, you don't need it to be able to trade really well. It's optional, and there are also some charts available for free. That's all I have to say about that, but it's still a very good tool. So that's all I wanted to say about that. Now, let's move on to the next tool. And actually, it's not really a tool, but rather a website, Coineng. And at this point, I should mention you don't have to use Coineng. There are several providers when it comes to liquidity heat maps, but this one is still one of the nicest and most user-friendly. Here too, I use the Magma version. You can also switch to a different display mode here, but I think you might have already seen this in other YouTube videos from other YouTubers. This is actually the most popular and the best one. Here you get a nice overview. Where is the current liquidity located? If you're completely lost here and thinking, hey Vincent, how does this work? What's going on? What am I looking at here? All of this will be discussed in detail now in Chapter 2. So don't worry about it here. I don't want to go into detail at this point about everything you can do here, because that's going to be thoroughly covered in a moment, since it's really important to understand what's going on here. That's all for the topic of the liquidity map. As I said, coining, that's what it's called. And finally, of course, Twitter and X are also tools you can use, the platform. I think probably all of you already have it. I don't want to explain anything about Twitter here either. In any case, you'll find the best news here. Let me just add a quick closing remark from my side. Please don't use TikTok or even Instagram for any information. There are a few exceptions where you can really say, okay, hey, maybe on Instagram. There might be some influencers there who actually provide real value, but I can tell you one thing, 99% of everything happens on Twitter first. All the news, all the information, Twitter is always the primary source. And then YouTube comes afterwards. Then after that comes Instagram and all the other platforms. Everything happens on Twitter first. There, you'll definitely always be up to date. Of course, there are several accounts in this space. I did list my own account. If you want, you can of course drop a follow, Vincent Crypto. I also post very regularly there, especially important and relevant charts. It's definitely worth leaving a follow there. Otherwise, I can recommend this to you. Watcher Guru is very important. There, you'll always have the latest news when it comes to crypto. It can be quite interesting for certain news, I would say. But at the end of the day, I would never place a trade just because of a piece of news. It's usually more the exception that you see a piece of news and immediately open a long position. Often, by then it's already too late, but it's still definitely worth following here. In theory, you can also follow on Telegram, just so you're aware. But let me put it this way, that's the only account I would recommend, apart from my own account, of course. Otherwise, you'll also be able to navigate the homepage here and see what gets recommended to you accordingly. That's all I have to say about that for now, but please be careful as well. There really is a lot of junk out there on Twitter. You really have to be a bit careful there. So definitely be cautious about who you listen to and where you get your information from. That's all I wanted to say about that for now. I've talked for a really long time. That was definitely chapter number 1. Now you've gotten a complete overview. What do you need to pay attention to? Which platform makes sense? As I said, I've linked everything for you in the video description. So don't worry about that. There you'll find, so to speak, a nice overview of all the tools. And now we're definitely moving on to chapter 2, which covers the fundamental and basic knowledge about market making. Also a very relevant chapter. Enjoy! Now we're definitely moving on to chapter 2, market understanding and basic knowledge. This is also extremely fundamental. Later, everything will be built upon this chapter. That's why you should definitely pay close attention here, because this is, so to speak, the ABCs of the crypto market. It's crucial to really understand these mechanics. Just by understanding these mechanics alone, I promise you, with just this chapter, you'll already be ahead of 90% of other market participants. So, let's dive right in. This chapter forms the foundation for everything that follows. As I just mentioned, before you even start thinking about strategies or anything like that, it's important to first establish the basics. And at the end of the day, once you understand this, you'll stop guessing and start reading the market. And that's extremely important. We'll go into more detail on that point in just a moment. Now let's take a look at the next slide. What is a market, really? As I said, I'm going to start again from the very beginning, just to quickly bring everyone up to speed. The market is not a game of chance. The market is a place where intentions meet, always buyers and sellers. At the end of the day, the price never comes about by chance, but rather through the interplay of buyers, sellers, emotions, strategy, panic, and patience. Every single candlestick is the result of millions of small decisions. The market is not an opponent, it is a mirror of human behavior. It's very important to understand this because a lot of beginners get caught up in it. They think the market is against them, or that retailers or the general public are always punished and shaken out. Only those who can truly read the market can actually use it to their own advantage later on. The price is not a value, it is a result. Markets move due to psychological triggers. Large movements are created by collective reactions. Your goal is not to guess, but to understand who wants what. And at the end of the day, once you understand this principle and can read who wants what, you will definitely make much better decisions. But we'll talk about that in just a moment. In more detail, I've also prepared this again in a similar way on the next slide, because it's so important to understand that price never moves randomly. Yes, and I think that's pretty self-explanatory. Everything is shaped by buyers and sellers, intentions and emotions, and reactions to liquidity. And now we're moving into a new, extremely important area. You can already see it in the graphic at the top right. We'll talk about that in more detail in a moment. Specifically, the price rises when more people are buying than selling. Of course, that's logical, but most importantly, and here's the key point, when big players, also known as market makers, siphon off liquidity. And later, this will become one of the most important principles, and a principle on which the entire trading strategy will be built. Because at the end of the day, everyone has different approaches when it comes to trading itself. But there is a fundamental mechanism that you have to understand, and that's the principle of the market makers. And we'll talk about what that looks like in detail in just a moment. But here, an entry is often not a bullish signal, but simply a means to trigger stop-loss orders. Yes, so this topic of siphoning off liquidity, this is explained here once again. So don't learn where the price is moving, but why. And it's absolutely fundamental to recognize the difference. I've also written this down here again very briefly. Where many get stopped out, that's where the pros enter. Those who understand liquidity realize movements don't follow logic but intention. And we'll definitely dive deeper into this on the next slide. Now we're getting to the important point. Who actually moves the market? Well, there are, let's say, two major camps out there. Smart money versus retail. At the end of the day, these are two completely different approaches to the game, and you definitely have to distinguish between them. Just a quick explanation here before we get into the details. For those of you who don't know what smart money means, smart money is the intelligent money. These are large investors, big players, major institutions. So basically not small investors, but actual market makers who intentionally push the price in certain directions versus retail. Retail is, so to speak, the general public. At the end of the day, we are also retail. Yes, even if someone has, say, 500,000 and trades with it, at the end of the day, there's still a retail trader, right? So when I talk about market makers or smart money later, I'm referring to the really, really big players who have a significant influence on the price behavior of Bitcoin and all cryptocurrencies. That's why it's important to understand not all market participants react the same way. Retail traders react. They buy after pumps, they sell in panic, and they set stop losses exactly at obvious spots. That's what I mean by the general public. Then we have smart money, the market makers. They act very strategically, provoke movements, hunt for liquidity, and quietly build up positions in the background. And the crucial thing is, smart money doesn't think in terms of direction, but rather in terms of liquidity, structure, and timing. And at the end of the day, you can either ignore this difference or use it to your own advantage. I've also illustrated here once again what the concrete difference is. And now it becomes very important, especially regarding chapter 2. We're going to take a look at all of this in practice now, because I think everyone has understood the principle. It's relatively straightforward. It's pretty logical once you've heard it and understood it. But now the question arises, what does the whole principle of market makers and retailers actually look like in reality? So really, how can you read all this behavior from the chart? And at the end of the day, of course, the goal is, how can we as traders take advantage of all this so that we can, so to speak, go with the flow with the big market makers so that we're on the right side? And that's extremely important. At the end of the day, there are several tools you can use for this. In this case, I've broken it down in a rather simple way. At this point, this is probably the most important and relevant chart here from Coineng. As I said, there are several providers. And no, I'm not in any kind of partnership or anything like that, but here it's illustrated very, very well how the whole principle works. I think some of you have probably seen an overview like this before, and now I'm going to go into more detail about what it all means, and later on, how you can even read this directly from the chart. So if you really develop a trained eye later on, you might not even need this liquidity map anymore. Of course, I know it's very helpful. Many people also use this liquidity heat map, and it's always very, very important to check it from time to time to see, okay, where is something building up? But one thing I can tell you, and I'm speaking from experience, at a certain point, even this liquidity map will become unnecessary for you. Yes, later on, just by looking at the price action, just by looking at this chart, you'll be able to recognize where liquidity is building up and where it isn't. But we'll talk about that in a moment, how you can read all of this from the chart, so to speak, or use it for your own trades. Now, as I said, at first it makes the most sense to do all of this here on Coineng.com. Personally, I always use the Magma visualization here. There is another visualization option as well, but I find Magma a bit clearer and more pleasant. And what you can do here, so to speak, is quickly go through the individual points. For example, here we have the option to select the trading pair. In this case, I have set it to Bitcoin US dollar, and then on the right side, you can select which time frame you want to use. Basically, you can choose higher time frames, like weekly, bi-weekly, or monthly. That way you can see in the longer term where liquidity is building up. As I said, we'll discuss what all of this means in a moment. But here you can basically choose whether you want it on a bi-weekly, weekly, or daily basis. And this will only become relevant later, depending on which time frame you want to trade on. Of course, there are different types of trading. There's swing trading, position trading, day trading, scalping. There are all sorts of different types. And depending on which time frame you're on, whether it's a 10-minute chart, 15-minute, hourly, or 4-hour chart, you'll naturally also look at where the liquidity is. But I think this will become self-explanatory later on anyway, regarding what's happening here and what you can read from it. For now, let's switch to the weekly basis and take a look at everything. This way we get an overall view of what's currently happening with Bitcoin. Here we can see the price action displayed in the usual way as a candlestick chart. And now we're getting to the point. What does this heat map actually mean? So what are these individual points here? Why is it lighting up here? Why is there nothing lighting up here at all? And what does all of this mean later on for our trading decisions? And that's actually quite easy to explain. Everywhere it lights up brightly, which is also represented here by the numbers. And if you pay attention here in this case, down at the bottom right, you can see 600 million in leverage positions. Or in this case, it says liquidation leverage. 560 million, 600 million, 500 million. And at the end of the day, these are all positions and orders that have been built up there. And the reason for all of this is at the end of the day, nothing other than stop loss orders. So basically, you can imagine it like this. There are certain traders who went long down here, who built up a long position here, essentially betting on rising prices, and they placed their protection, their stop loss, at the level of 115,000 US dollars. So basically right here, where it lights up brightly, there are an extremely large number of stop loss orders. And of course, you can also ask yourself, why do so many market participants place their stop loss orders right here in the first place? So why does it light up here and not maybe further down? The whole thing is actually pretty simple to explain because the majority, especially the general public, sets their stop loss. So for example, they go long here at a low point and then place their stop loss level below the last low. And that's very, very, very typical, yes, that a position is basically opened. Now let's just assume, I'll give you a quick example right away. So here at this point, we have an intermediate low in Bitcoin, and what's quite common is Bitcoin comes back and forms a kind of double bottom here. Yes, and what a lot of people do is as soon as they enter a long position here, they place their stop loss orders here, here, and here. Yes, and that's very typical. And then a lot of liquidity builds up in that area. And now it gets especially exciting and interesting because I can use this to explain the principle of market making quite simply. That is, how the big players deliberately push the price in the direction where the most liquidity is available. Because you have to imagine, you could also ask yourself, why do market makers, basically the smart money, even want to push the price in certain directions? So what is the advantage, or rather, what is the core intention of market makers in pushing the price in certain directions? And this is very, very, very important to understand. The crypto market, in terms of total liquidity and overall size, is still relatively small. So compared to, for example, Forex, currency pairs like Euro, US dollar, there is significantly more liquidity. Or even in the stock market, we have more liquidity. That's a different game. Yes, there are also market makers and so on there, but it works a little differently there because in the crypto market, it's like this. The crypto market is relatively small, and even now, when Bitcoin is already at 120,000 US dollars, you have to look at it this way. The crypto market as a whole is still relatively small, and for large whales with a lot of capital, it's relatively easy to push the price in a certain direction with large amounts of money. And now I want to explain this principle in more detail because it's really extremely fundamental that you truly understand this point. On one side, we have the market makers. Yes, these are, let's say, big whales who have an incredible amount of cash, an incredible amount of capital, and of course they want to push the price in a certain direction. They basically want to participate in the market in general. And on the other side, if you draw a line here, we have the general public, so to speak. Yes, these are, let's say, individual small investors who represent the opposite side. And what you have to understand, especially if you paid close attention in chapter 2, is that for a price to form, you need buyers on one side and sellers on the other. So for a price to even exist, it's always a balance between buyers and sellers. And somewhere in the middle, it settles. And that's basically how the Bitcoin price is determined at the end of the day, depending on how many buyers and sellers there are on each side. And now we come to a major core problem. And this problem is faced by the market makers. Because when you act as a market maker, as a big whale, as smart money with an incredible amount of capital, it can actually be quite difficult at times to find a counterparty. So especially for large whales, it's definitely difficult to put several million in capital into the market at once because the other side, the sellers, are simply missing. So for example, if a whale wants to buy an enormous amount of Bitcoin or take on a huge position, it can sometimes be difficult to find the counterparties, the people willing to take the other side of the trade. And then, of course, if this problem exists, the whale basically has two options. Option number one, the whale buys Bitcoin in stages. So, on the one hand, the whale has an enormous amount of capital that he wants to invest in the market, where he basically wants to build a long position. He is betting on rising prices and is buying on one side. And now, of course, there's the option to split this large amount of capital into several tranches. He buys once, he buys a second time, a third time, a fourth time, a fifth time, a sixth time, a seventh time. But what happens when he keeps buying over and over again? Of course, the price goes up. This means the whale has to buy at increasingly higher prices with each tranche he puts into the market. And of course, that's absolutely suboptimal for large market makers, because it means they have to keep buying at higher and higher prices. And that's obviously, let's say, unnecessary or not exactly what a market maker is aiming for. That's why this is usually an option that market makers often try to avoid. And that's why it's especially important and relevant for market makers to look at, okay, hey, where are the price levels? Where are the areas in Bitcoin where we can suddenly inject an incredible amount of capital into the market all at once? And these are usually exactly the price levels where there are a lot of stop-loss orders placed. Because now we're getting to the next point, which is fundamentally important to understand. All the stop-loss orders that are placed here are nothing more than sell positions. Many beginners don't understand this principle either, that a stop-loss order, when you're hedging, when you open a long position here, you end up placing your stop-loss order below it. So that's basically the protection, a stop-loss. A stop-loss is nothing more than an active sell position that has been entered into the market here. This means for the market makers, they look at a chart like this and see, okay, hey, at 115,000 US dollars, Bitcoin has a massive, massive number of sellers. So in this case, there are simply a lot of stop-loss orders from long positions, and of course, that's a goldmine for market makers, because now they have a very strong interest in artificially pushing the Bitcoin price down, pushing it right into this area, exactly into this zone. What happens? We see here 500 million, 600 million, 700 million in, let's say, liquidation leverage lying here. And as I just mentioned, that's a gold mine for market makers. And that's why these exact areas are basically like a magnet, where the Bitcoin price keeps getting pulled in, because here the market makers can execute a lot of their own positions since the counterparty is available. Yes, then the market makers can basically make a huge move in the market all at once. Yes, they've basically lined their pockets here, and what happens to all the retailers, the general public? They get liquidated here. They have to look for new long positions again. They have to find a new entry point, get frustrated again, and so on. It's always the same game over and over again. The general public is systematically liquidated, and the market makers always push the price exactly to where the most liquidity has accumulated. And I think if you've already understood this principle, you're definitely much, much better prepared than many other investors, because many, especially beginners, always make the same mistake. They look at Bitcoin, right, and check, okay, hey, where might Bitcoin have important support levels? What often happens then is that people look and say, okay, hey, maybe there's some support here. Now, in this case, at 116,000 US dollars, the counter movement has basically taken place. What many people then do is, okay, hey, Bitcoin is coming back. I'll open a long position here, and I'll set my stop loss just below this point. Yes, so basically just below the last low. And that's a mistake many people make, because what happens then? You act just like 99 or let's say 95% of the other market participants. Once again, you ensure that a lot of liquidity builds up in that area. So what do the market makers do then? Of course, the market makers deliberately push the price down here, bam, liquidate everyone, and then the counter movement happens. Yes, and it's very, very common that there's basically a kind of trap. At first, everyone gets liquidated, and only then does the real counter movement happen. And once you understand this principle, you see it incredibly often with Bitcoin, and you also start to view the entire Bitcoin chart from a completely new perspective, because you can then understand much better why Bitcoin sometimes does such strange things. Yes, sometimes you look at the chart and think, somehow it looks strange. Yes, but you can't really explain what's actually happening in the background. And that's extremely important. And now, in this case, as I said, it's a completely live example. I didn't even prepare much, and without having prepared anything, I can immediately see where the market makers have been active here again. And that's what's so interesting, really. Once you've understood it, you can take a look at it here as well. We can now take a look at the price action here on the 4-hour chart of Bitcoin. As I said, in this case, the whole thing happened just a few days and weeks ago, and it's also very, very interesting to observe again. So, what happens is this. Bitcoin was at low levels here, around 80,000, then it moved up, let's say, to 90,000, and then there was the next pump. Often, as soon as an old structure is left behind, there is a strong pump in a relatively short period of time and a new structure is established. In this case, I'll move my face cam up so you can better understand and see the whole concept here. So, as I said, here, the old structure was formed, the old structure is left behind, and a new structure is established. And then, as soon as a new structure is established, things get really interesting, because it's incredibly important to immediately identify the individual points in the new structure, to immediately look, okay, hey, where did Bitcoin reach certain lows here? Okay, here we basically have a contact point where Bitcoin briefly dropped back to 100,700 US dollars. And then we can look at the next contact point. That one is also relatively relevant. Yeah, so I'll put a yellow line here as well, so it's easy to understand and follow. Alright, and now it gets really, really interesting, because if we take a look at the whole thing, we can even go into playback mode here, yeah, go back in time and see, okay, hey, back then Bitcoin was creating a new structure. Here we have old structure left behind, strong pump upwards, new structure is established, and in this case I'm only using long positions for the whole example. Of course, you could illustrate the whole thing on the other side as well, but for now, I'm only showing it here using long positions and intermediate levels to demonstrate how everything developed and what the current situation is. Now it gets especially interesting, because now we have these intermediate levels at 100,000, 101,000 US dollars. And what's happening here is an incredible number of traders, an incredible number of investors have opened long positions here and now have a stop loss here, have a stop loss here. Yes, so that's basically where the new position was created. There are a lot of stop loss orders here, a lot of stop loss orders here. So in this case, everything is completely filled with long positions and stop loss orders that, let's say, have been placed just below here in the short term. I'm deliberately drawing all of this in gray so that you can clearly distinguish everything. So basically, everything in yellow represents stop loss orders that are located here in this case. And now we can take a look. What is happening here? What are the market makers doing? The market makers, of course, check all of this and see, okay, wow, there's an incredible amount of liquidity building up here. Everyone might be thinking, oh, Bitcoin is about to break out here, make new highs, it's going straight to 120,000 US dollars or whatever. But anyone who has now understood the market maker principle can already roughly estimate what might happen next. As I said, in this case, I have this simulated playback mode turned on. This happened exactly like this with Bitcoin, but in this case, it's basically rewound. And now, make sure to pay close attention to this chart. What is happening here? What are the market makers doing? And in this case, once again, this is an absolutely perfect scenario. We can even fast forward and take a look at the whole thing. It's just so incredibly typical. Yes, what happened here again in this case? I think if you've understood the principle, you definitely know exactly what was going on in the background here, what happened. Now, just very briefly for clarification so that everyone really understands, what did we see? A new structure was established. In this case, an incredible number of stop loss orders were placed, also here below the intermediate levels. Many stop loss orders, many market participants basically set stop loss orders just below the wick. What happens? What do the market makers do? In this case, they made a nice quick dip. Yes, that's one way to put it. A quick dip with the candle wick. Nicely liquidated everything, filled their positions. All the retailers got flushed out here, they panicked. Probably a lot of investors also thought, okay, damn, maybe Bitcoin will drop back below 100,000 US dollars or something. What happened? Orders were filled, and immediately, bang, a V-shaped recovery, and in my experience, those are usually the best trades you can make, especially when intermediate levels have formed within a new structure. In this case, there was a quick dip, bang, positions were filled, and then an immediate reversal. So this is truly a textbook example. We can take another look at the whole thing, and you'll notice that this kind of thing happens over and over again with Bitcoin. In this case, I can also fast forward a bit, and then we can keep watching. What is Bitcoin doing? A typical consolidation phase. What is happening here at this point? Yet again, a perfect example. What happened? If we now remove all the arrows here, just for clarity so you have a better view. So what can we see? As mentioned earlier, a new structure was established. Here, all the positions were nicely liquidated. But what do 90% of investors do again at this point? A large portion opened new long positions here again or scaled up their existing long positions. What happened again at this point? Right below this low, under this candle wick, there are an incredible number of stop loss orders that can be perfectly swept up again. And what happened? Bang! It stabbed down once, and exactly the same thing happened again. Once again, there was a kind of V-shaped recovery. And that's so typical for Bitcoin. And once you've understood this principle, you can even do it without indicators, without looking much to the left or right, just by looking at the price. As I said, we don't have any indicators here yet, we don't have a strategy yet, we actually haven't done anything yet. I've only explained the market maker principle to you, and just based on that, you'll probably be able to trade better than 90% of other market participants, because it's a principle that happens over and over and over again. As I said, we can see it here as well. Yes, this is very typical for Bitcoin. We can even take another look at the whole thing here. Here we basically formed an intermediate low. We can see it illustrated here. In this case, it was at 78 US dollars. What happened? Again, there were a lot of long positions here, And once again, they were perfectly cleared out, this time with a spike downward. And that is very, very, very typical for Bitcoin. It is very, very, very typical of market maker behavior that this basically results in a V-shaped recovery. Yes, as I said, that's an indication that market makers were involved, that, as mentioned, it was just a spike. Yes, and this is usually a perfect reversal here as well, basically a perfect V-shaped recovery that happens, so to speak, when there's a brief dip and then immediately the counter move is initiated. That is very, very, very typical. And again here, what happened? We can clear this up a bit here, then it will be easier to see again. A lot of stop loss orders here. What happens again? Of course, we can make the whole thing a bit clearer using the rectangle. What happened? Bam, a nice dip, double bottom, and then again straight into a V-shaped recovery. We dipped in briefly, bam, straight up, and then shot through. And as I said, you see this incredibly often. I could go on talking to you for 10 hours about this market maker principle. Once you understand it, you'll see it over and over again in the charts. How there's always a dip, everything gets picked up, here again everything gets picked up, and that's why it's so incredibly important to understand this principle. Once you do, you'll definitely be prepared. You can even see it at the highs. Yes, of course, it's exactly the same with short positions. We can see right here, we have exactly this candle wick. I can even make it a bit more precise. Exactly at the candle wick. What happened? Very briefly, there's a quick spike, bam, and then the counter move comes immediately. Yes, it can be applied in exactly the same way to short positions. Because if you enter a short position here, let's say stop loss. A stop loss is nothing more than sell positions again. Of course, it's the other way around with a short position. That's obvious. But here, the exact same principle applies. And I think now you can definitely understand why I said earlier in chapter 2 that you don't even necessarily need this liquidity heat map. Because once you can read price action properly, once you've understood how the principle works, then you don't even really need to look in here anymore because you'll intuitively know exactly where stop loss orders are placed and what the majority is doing. And that's how you always need to think. You always have to think, okay, what would the average run-of-the-mill investor do? What is the majority doing? And what are the market makers interested in? Yes, and I think you've definitely gotten a good starting point here. That's all there is to say about that for now. I've talked for a long time now, but at the end of the day, chapter 2, this very chapter was the foundation on which everything else will be built later. It was an incredibly insightful and important chapter. Otherwise, feel free to rewind and watch it again, and also practice with the chart. It's definitely worth taking a look at Bitcoin here as well. How did Bitcoin behave? And just as a quick note, all of this applies to the daily time frame, the 4-hour time frame, and even the hourly time frame. So at the end of the day, it works the same way on the smaller time frames as well. Of course, the larger the time frame, the more precise and the better it works, because the more liquidity the market makers can extract. But at the end of the day, it works just as well on the daily time frame and on the smaller time frames. That's all there is to say about that for now. That wraps up chapter 2, the basics. Now we'll start with chapter 3, which is about candlestick patterns. Here, we will go over the 10 most relevant candlestick patterns. I've prepared a lot for you on this topic. This chapter will be a bit shorter because it's not quite as crucial. Theoretically, you could do without them, but it's still important that you've at least heard about them, because often, especially when a certain candlestick pattern appears, it can definitely help a lot with trading decisions, allowing you to make better choices and understand what you need to pay attention to. Now, just very briefly on the topic of presentations and PDFs, I've put so much effort into this. As I said, all of this is still from my Trading Academy. You'll get everything from A to Z here, especially in the other chapters and with the indicators. You'll receive so much valuable, well-prepared information from me that you'll have a wonderful overview. I've linked everything in my Telegram group. You're welcome to check it out. And as I said, for everyone who used my link through Bitunix, I've linked everything in the video description. Those who have an account there will get access to the completely free Telegram group. As I said, I'm not selling you anything, but this way it stays fair for everyone, and at the end of the day, it's also a small way to support me. Everyone who has an account with Bitunix, basically just with email and password, gets access from me. You don't need to verify yourself, submit any documents or anything like that. As I said, they will then get full access to all the PDFs here. Everything is neatly linked in my trading Telegram group. Just send me your Bitunix UID on Telegram. I've also explained everything again below, how the whole process works, how everything functions. At the end of the day, you just quickly create an account, you send me the UID, and as soon as you have the UID, you'll be automatically added to the trading group where you'll get full access to all the PDFs and all the information. Everything is neatly organized, and I'll keep you updated there anyway with all the trade setups, etc. So that's definitely going to be very relevant and important for you. As I said, I've linked everything. Now let's start with the 10 most relevant candlestick formations. It's important to distinguish between two categories here, reversal patterns and continuation patterns. Let's take a quick look at them now. As I said, it's not ultra decisive. You can never, this needs to be made very clear, you can never base a trade solely on a candlestick formation. You have to be careful with that, but still, it definitely helps a lot in deciding whether to take the trade or not. And that's why it's important to have seen and heard everything at least once. We'll start with the hammer, a reversal pattern that appears after a downtrend. So we basically come from a downtrend, and what happens then is something like a hammer here. In this case, you can see the stem here, and then here, the hammer is shown in green. This is a very positive sign. This is exactly what you would notice if you were really paying attention and watching everything from A to Z. That's why it's so important to watch every single chapter. If you've watched chapter 2 about the market makers and you understand how the market makers deliberately stab into liquidity with a single move, then you'll notice that very often, especially from market makers, a hammer pattern forms. And this is usually a nice reversal pattern that takes place. And the same thing also happens the other way around. In my experience, the inverted hammer is definitely somewhat rarer. So this kind of pattern is nicer to trade and you see it much more often. And with that, you can definitely enter some really beautiful long trades, especially if you've placed a limit order. If you've already placed it in advance and know exactly where you'll find an entry, then it's perfect, because that's when the stab happens, your position gets opened, and then the continuation takes place. That's all there is to it. Then there's the bullish engulfing, a bullish reversal pattern where a bullish candle completely engulfs the previous bearish candle. This happens from time to time. If you see something like this, it's definitely a positive signal that a trend reversal is taking place. The same goes for bearish engulfing. It's exactly the same, just in the other direction. Most of the time, well, one thing I can tell you about this, it's better if you download this PDF once. As I said, I've linked it. Then you'll definitely have a nice template here, a good overview, and as a beginner, you can compare everything one-to-one without having to think too much about it. Everything is nicely organized for you there again. There's the morning star, which is also very interesting. It appears from time to time and is a bullish reversal pattern made up of 3 candles that occurs at the end of a downtrend. The formation consists of a long bearish candle followed by a small doji or a longer bodied candle, as you can see here. Similarly, there's also the star, where both the opening and closing are almost at the same level for a very short time. And that's usually also a sign that the trend has come to an end. It's definitely sometimes the case that a big red candle appears afterwards as a result. Then there's the bullish harami. It's just like the engulfing pattern, but in this case, it's basically the other way around. In this case, the bearish candle is practically larger than the following bullish one. This is what it looks like, and it works the other way around as well. As I said, there's not much to explain here. I also don't want to go into too much detail because it doesn't make sense. It's better if you use all of this as a template. You look at it and think, okay, hey, maybe I'll enter the trade. I see a hammer. Okay, perfect. That indicates a reversal is taking place. And again here, I want to make this very clear because especially as a beginner, it can sometimes be confusing how much weight to give to each thing. If you listen carefully to chapter 2 about market makers, then you'll know that's, for example, much more important than any reversal patterns or anything like that here. That's just a bonus, it's optional. You can include it in your analysis. It makes sense to have heard about it, but it's not absolutely decisive. Yes, just because a hammer appears doesn't mean the trend is immediately over, but it is a sign, a hint, an indication of it. And it definitely increases the probability that your trade will be profitable or move into positive territory. Then of course there are continuation patterns here, yes, the continuation. There are, for example, the 3 white soldiers, as it's sometimes called in English, where 3 candles appear in a row, and the same applies here in a downtrend. Super simple. That's all there is to it. I don't want to go too much into detail because, as I said, it's just optional, not super important. Everything is linked in the video description, and now we'll continue with chapter number 4. So let's definitely keep going. We're making great progress with chapter 4, chart patterns, technical formations, structures, breakouts, market phases, and contexts. This is also a chapter that definitely has its place. Later on, it will become more relevant in live trading in terms of how individual positions are executed, so to speak. You'll also find out what weighting each aspect receives. That will become very important later on. You'll be able to clearly see, especially later when putting things into practice, what do I pay attention to first? What gets which level of relevance? Because sometimes it has to be said, chart patterns are also of secondary importance. I would never trade solely based on chart patterns, but they are still a component because sometimes, especially with bull flags, etc., they can be a strong indication, and in those cases, chart patterns and especially breakouts that you trade definitely have their place. It's very important to at least have heard about this. And especially here with the PDF, with all the PDFs that I'm preparing for you, it will be especially easy for you later on to identify everything right away. As I said, everything is linked for those of you who have an account with Bitunix and who then also join the Telegram group here. All the PDFs are linked there for you completely free of charge. As I said, chart patterns are definitely important for identifying possible price movements through pattern recognition. Risk management can be better adjusted based on this. You can especially understand market psychology better, and of course, it's a supplement to fundamental analysis. In this case, you have a complete overview of the table of contents again. It's detailed, but I won't go too much into detail because the point is more that you've at least heard about it and that you understand how everything fits together. That's why we'll start with point number 1, the overview. There are 3 types of price charts. There's a line chart, a bar chart, and then there's the candlestick chart. We always trade using the candlestick chart. Just to quickly explain again, as I promised at the beginning of the video, I'm starting you off from scratch. I already touched on this briefly in the TradingView tutorial, how a candlestick chart is structured, but here's another explanation. There are always different time frames. You can display the chart on a daily basis, 4-hour basis, hourly basis, 10-minute basis, and so on. No matter which time frame you set, it's always the case that each candlestick body represents the respective time frame. So, for example, here it's usually 4 hours per candle, or for instance 10 minutes per candle, depending on how you've set it up. But basically, depending on the time unit, each candle is displayed and is equivalent to 1 time unit, and it's always like this. As soon as, for example, a new day begins, we have an opening. In this case, it's red, which means the opening is, of course, higher than the close. For example, at midnight, the candle starts at the opening. Then maybe we even get a quick pump. Then it's quite possible that the candle is briefly green, but as I said, only briefly during the day, and then over the course of the day, before the close happens, we basically have the whole end here, which then ends bearish, so basically negative. And then we have the close down here. It can also happen that there's a quick spike just before the close, and then we basically have a wick here, a wick there, and then the candle again. At that point, the day is practically closed. That's how you can imagine it. And here as well, yes, you can also get a candle like this, for example, if at the start of the day, again, I'm always talking about the daily time frame here, Bitcoin opens at 100,000 US dollars. Maybe we briefly see a pump up to 105. Then it could also happen that we briefly see a sell-off down to 95,000 US dollars, but later the entire close happens again at 100,000 US dollars. So in that case, basically, nothing has happened at all. It's the same here. Open, close, small fluctuations. Open, close, small fluctuations. And that's pretty much all there is to say about candlestick charts. That's roughly how it might look on the chart later. Those are definitely the complete basics, just so you understand how a candlestick chart is put together in the first place. Now let's move on. Point number 2, the basics. There are resistances. These are usually price areas where Bitcoin keeps bouncing off. For those of you who paid close attention in chapter 2, you definitely know how resistances and supports are formed. Most of the time, it's always the reference point based on liquidity. I think you were definitely paying close attention there as well. It's one of the most important chapters, chapter number 2. Yes, as I said, everything builds on that. And here you can definitely see all the resistances or supports, in this case supports, which are usually areas dominated and defended by the market makers where many stop loss orders are placed. Here, the market makers can nicely fill their positions again, and then the counter move follows. That's how it often goes. These are usually also psychological barriers, like Bitcoin at 100,000 US dollars, Ethereum at 3,000 US dollars, or whatever the case may be. That's very often the case, or with altcoins as well. Yes, sometimes there are altcoins that pump really hard and then bleed out over time. And then it's often the case that a bottom is formed in a certain price range. Because you have to imagine, especially with altcoins, there is sometimes a core group of investors who simply refuse to sell no matter what, and that usually leads to what I'd call a price discovery phase that takes place in a bottom area once support is found there. That's all for now on the topic of support and resistance. It's super self-explanatory. Every one of you should definitely understand this. Next we have trend analysis, point number 3. There are upward trends. Upward trends are made up of higher intermediate lows and higher intermediate highs. I think that's also self-explanatory. The only important thing to keep in mind is, as soon as the last intermediate low is broken, we have a trend reversal. But as long as new and higher intermediate lows are being reached, the trend remains intact. The same applies to downward trends. A long downward trend. As soon as such a trend line is broken, things usually move pretty quickly and explosively. We'll talk more about that later when we get to the topic of breakout trading. This is also very relevant, but here we can see, okay, the individual points of contact are getting lower and lower, which is why there is a clear downward trend. The whole thing can also result in a trend channel. In that case, we basically have both the upper edge as a reference point and the lower edge, so we always have reference points, upper edge, lower edge. And I think this is something that even beginners can identify relatively quickly and easily, so you can immediately recognize, okay, we're in an uptrend or a downtrend. I think so too, yes, it's self-explanatory. Then point number 4, there are triangle formations. This usually happens when the chart narrows. Then we see, so to speak, symmetrical triangles, or what's called an ascending triangle, when the upper edge remains stable but everything converges from below. That's basically an uptrend with resistance, so to speak. And something like this usually ends in an explosive pump or a dump downward. So usually the breakouts after such triangles are always relatively explosive. The same goes here. Descending triangle, shown here again. Here we basically have a support and a downtrend. It's definitely nice when you can identify something like that. It's not super relevant, as I said, because my approach is more based on price action trading. That's why patterns are definitely secondary, but still important to understand. Especially when something like this forms, it's very common with Bitcoin, and many market participants pay attention to things like this. And as long as the general public is watching out for such patterns, it's definitely important to be aware of them. It's definitely important to understand how such a pattern even forms in the first place, that many investors start buying again here because they think, okay, there's support here, then sell again, and that's how a pattern can even occur in the first place, so to speak. At the end of the day, it's all market psychology. And that's why, once again, in this case, there's a rising wedge, which basically means the price is narrowing upwards and then sooner or later experiences a sell-off. Usually, even though the price is moving up, this is a pattern that, with increased probability, breaks out to the downside. Likewise, in contrast, there's a falling wedge, which also occurs frequently. That means the price has multiple contact points, lower interim lows, lower interim highs, and sooner or later the breakout happens, and it's usually a bullish breakout. So that's generally how these two patterns work. They definitely occur very often, and it's very typical with Bitcoin. Then point number 5, bullish accumulation patterns. In any case, it's also very relevant for being able to enter trades and also to consider, should I keep my trade open? Should I scale up my trade? Because especially with large bull flags that form, it's very often the case that a breakout to the upside occurs. Do you see that happening extremely often as well? So even when I pull up the Bitcoin chart here, as soon as certain trends, let's say, are broken, like this downtrend here, bam, everything moves up pretty quickly. As I said, this is from another part of the video course, but I think you definitely know what I mean by that. This happens very often with Bitcoin, and it's of course perfect for scaling up positions. It's perfect for opening new positions because what's really interesting is that quite often we have a kind of bull flag, and then afterwards there's another sort of retest. I can also quickly sketch it out for you here in TradingView if you'd like. So we basically have a bull flag, a consolidation phase that takes place. A bull flag can also appear here in the form of a kind of triangle. That's one possibility. But it can also be that the bull flag runs parallel, which is basically like a kind of downward trend channel. And that's important to observe. Does the bull flag really have a clear origin? Yes. Have we really seen a good pump? Because otherwise you're just investing in some downtrend, which usually, I don't know, ends up even worse. It's important to distinguish that, but often it's like this. We come in strong with an uptrend, then there's a cooling off phase between two consolidation phases. And we actually see this very often, even with Ethereum, for example. We can also take a look at that here. It's extremely common for there to always be, let's say, interim consolidation phases, and then the next pump comes. Yes, here, the interim consolidation phase is also a kind of bull flag, and then the pump follows. And that's exactly what I've drawn here. We come from a pump, we cool off. That's also usually the point when many indicators cool off nicely, when an RSI comes back from the overbought area, and it's very pleasant to open new positions here, especially if you're also trading the retest. So most of the time we have a breakout, and then the price comes back again, and then you can basically enter the long position at the upper edge. And in the best case, if possible, you can even place the stop loss below the bull flag depending on how big the bull flag is. Otherwise, just somewhere in the middle here. And these are usually very pleasant trades, because after a bull flag, the breakout is really strong, and you can take quite a bit of profit there. That's about it on the topic of bullish accumulation patterns. As I mentioned earlier, it also exists as a triangle formation. So there are several possibilities, and that's exactly what I was talking about. Especially with a triangle, it's often the case that we see the breakout, then a retest, and only then does the real pump happen. That's also very common, simply to shake out a lot of investors again. So we basically have the breakout. Many people think, okay, now it's starting. Then a lot of positions get liquidated again. There's another wick that stabs back in, and then the retest basically happens here at the upper edge, and after that, it practically continues. Yes, that's also very common. Then we move on to point number 6, bottoms and tops. We have the double bottom, a W pattern. It's also very common. Yes, that's basically when a trend reversal takes place. We come from a bearish trend, double bottom, bam, and then the next upswing basically follows. It's very pleasant to trade. In this case, there are two options for how you can trade something like this. So I either do it in such a way that you basically fill the position here. That's relatively common, especially for those of you who listened carefully to chapter 2. You definitely know that the market makers like to poke in here again with a candle wick and scoop up liquidity. That's why you can build long positions perfectly here. That's definitely one way to do it. And the other way to find an entry, if you missed it, if you see, oh, double bottom, maybe I missed it or didn't dare to take it, then it's still legitimate to open a trade as soon as the neckline has been broken. This is also called the neckline, basically just the area where there was briefly some resistance here. As soon as that's broken, it's often the case that a retest happens, and then, in theory, you can also enter a long position here. By the way, the same thing applies to what's known as an M pattern. So of course, you have it here as a double bottom or here as a double top. It also happens very frequently. What do we see here? Again, it's shown perfectly. The market makers poke in once, filling all the orders here. In this case, all the stop loss orders from the short positions. What happens? Here we have the neckline. We even bounce off the neckline briefly again. That's also very, very typical. I can even zoom in here for you if you like, so you can see it even better. So this is actually a very, very important chart, because in this case, a lot is being revealed. As I said, first the market makers poke in and fill the positions. Then there's another nice bounce. It's also very common that a lot of people think, okay, hey, that's it. Then we basically saw this wick here. Many market participants then think, okay, the M pattern is active, now it's really going to drop. But then it's often like this. There's a counter move, a few more get liquidated, watch out for stop orders, and then the complete break of the neckline happens, and that's when you can start building very, very nice short positions again. It's always very, very pleasant to trade the M pattern here as well. So these two patterns are definitely very fundamental and occur incredibly often. Every one of you should have at least heard once that there is such a thing as a W pattern. Yes, W pattern, double bottom. There are several names for it. At the end of the day, it always serves the same purpose, and you always have the same opportunities to open trades, either here or here. So now you definitely know about that as well. And of course, logically, the whole thing also exists as a W pattern, where you even have 3 contact points. That definitely happens sometimes. Yes, and of course, a lot of people get shaken out again, because many think, okay, hey, W pattern, it's starting. And then the price comes back again, and in this case, you even see another support level, which holds for the 3rd time. That happens too, you definitely have to be careful, but now you've at least heard that it can happen 3 times here as well, both with the N pattern and the W pattern. Then there's also a rectangle pattern, which is a bit different again. It's actually similar to a bull flag, just parallel. In practice, this means that a consolidation phase takes place here. So again, some indicators are cooling off here before the breakout to the upside happens. So that's all for that. Now in point number 7, there are a few more exotic chart patterns that you definitely see from time to time, but to be honest with you, they don't come up very often. I wouldn't put too much focus on these either, but it's important to me to provide you with complete analyses. So it's definitely interesting to have at least heard about them. There's a cup and handle pattern. It basically looks like a coffee cup. In this case, you can see the cup that is formed here, the handle, and then usually a breakout to the upside happens here. That's definitely one example. Then there's the head and shoulders pattern and the inverse head and shoulders pattern, which basically have 3 contact points. Interim low. The interim low is broken, and here again, it's basically at the same level as before, with a neckline. As soon as the neckline is broken, similar to, please remember the W pattern here, so the W pattern, we have a confirmation here, and this is where you can perfectly build long positions. So this is actually the only way I occasionally trade a head and shoulders pattern, by taking advantage of the neckline, the confirmation from the neckline, to build long positions, or in this case, short positions, because it's actually quite common for a retest to occur, and especially during the retest, it's very convenient to build long or short positions here. Then we move on to the next patterns. Broadening wedge, descending broadening wedge. Just a quick overview, so you've seen them at least once. As I said, it's more of a collection, so you can have a look over everything here. Or here as well, a rounding bottom, a rounded bottom. These appear only very rarely, or in this case, it actually happened with Bitcoin on a higher time frame. It's very interesting. In this case, it doesn't really have anything to do with trading anymore. Well, not with concrete technical analysis at least. It's more of a general overarching insight that you get, so to speak. You also see this from time to time with a few altcoins that, structurally speaking, sort of bleed out in this arc shape, and then you can roughly estimate where the bottom is forming, and from there, you can also find new entry points. As I said, it's more just for your general knowledge, so that you've at least heard of it. In the same way, I want to go over 2 scenarios at the very end, and then you'll have finished this chapter. So at this point, I'll move the facecam up again, and that's just for the sake of completeness. There are 2 different scenarios. A long squeeze scenario, where a lot of long positions get liquidated. Please remember this chart here. I think, yes, chapter 2 has come up often as a reference here, but that just shows you how important chapter number 2 is. It's absolutely essential. Everything builds on that. But that's basically the principle for later as well, because here a lot of market maker positions were liquidated, and very often it's like this. Bam, everything gets filled up at once, and then the counter move comes immediately. It's the same, of course, as in a short squeeze scenario, for example, where all the short positions get liquidated briefly. Of course, that happens from time to time as well. In this case, It even happened here with Bitcoin. By the way, this is the Bitcoin chart. At that time, Bitcoin was at 16,000 US dollars. These slides are a bit older. As you can see, these are all slides from my old trading academy, but I still think it's definitely a nice template, a good overview. As I said, I've linked everything in my free Telegram group. Anyone who has an account with Bitunix and sends me their UID will definitely get access or be added to this trading group. That's all for the chapter on chart patterns. I think you've gotten a good insight, and now we'll move on to the next chapter. Alright folks, we've already made it halfway through. Let's continue with chapter number 5, which is about indicators. This is also a particularly relevant chapter, especially at the beginning. One thing I can tell you, the more experienced you are, the more intuition you have as a trader, the fewer indicators you'll need. But especially at the beginning, it's extremely helpful to incorporate certain indicators. I'll also go into this very specifically. Which indicators make sense? Which indicators don't make sense? Because especially as a beginner, I remember this very clearly from my own experience when I started out, you're completely overwhelmed by all the indicators out there. Everyone claims theirs is the best indicator or whatever, but most of the time, everything boils down to the top 5 or top 10 most important indicators. And it's exactly those that are truly relevant that we'll cover in this chapter. As always, I've prepared a lot for you. A complete PDF with all the indicators. Everything will be explained in great detail. We'll go through different scenarios. Everything will also be highly practical and relevant, so it's definitely worth paying close attention here. I also try to share as much practical knowledge and experience as possible, because at the end of the day, it doesn't really make sense if I just read the text to you word for word. You can always do that later at your own pace, but for me personally, it was important to have everything nicely organized in one place, because I know what it's like myself. When I watch YouTube videos myself, after a week or maybe 2 or 3 weeks, I've already forgotten quite a bit, and then I have to watch the video 2 or 3 times in a row because I've forgotten how something works here or there. In my opinion, it's much better to have everything nicely organized in one place. As I said, you can find the entire PDF completely free in my trading Telegram group. But now, let's definitely get started with the most important indicators. And as I said, afterwards I'll briefly demonstrate everything here using a chart in TradingView. I'll show directly how to implement things and how to use them. But for now, I'm going to organize the relevant indicators here. And as I mentioned, especially for beginners, this is a really helpful support. Over time, you'll develop a certain intuition. So, one thing I can tell you, when I look at a Bitcoin chart like this, I can pretty easily tell where Bitcoin was overheated on the RSI, or where Bitcoin might have been oversold in certain areas. So you definitely develop a certain eye for it, but still, in the beginning, I would definitely recommend that you incorporate 2 or 3 really good indicators into your own trading strategy. It's definitely worth it, because over time you'll develop a much better feel for it. Let's get started right away with point number 1. So I've basically divided all the indicators into different categories. There are momentum indicators, trend indicators, volatility indicators, volume indicators, and then there are support and resistance indicators. In particular, we'll be taking a very specific look at Fibonacci retracements. Also very, very important and relevant. And then a few other indicators followed by the general summary. That will definitely be very important. We'll start with the most well-known indicator, the Relative Strength Index, or RSI for short. Every one of you should definitely be familiar with this indicator. It's truly an absolute must-have, and especially pleasant to use when you're just starting out. It's a great way to gain some insight, so to speak. This is what it looks like. This is how it will appear later in the chart on TradingView. I can even quickly show you. When we're in TradingView, we go to Indicators, type in RSI, and you'll see it pop up right away. We click on it, and that's how it will look for you later in the default setting. We basically have a value. Now in this case, I'll show it again using the slide. We have a value set between 30. Honestly, in this case, so you can see it because of my face cam, the normal range is between 30 and 70. Anything above that, so let's say anything in the range between 70, 80, 90 is then considered overbought. So that's usually when the price becomes overheated, when people have become too greedy. Everyone has thrown in their capital, and then there's usually a spike upwards. Often, when the RSI, let's say, reaches a value of 80, you can assume that the market will cool down again and that all the indicators will also cool off. And the same goes the other way around. Most of the time, the market overreacts here as well when many investors panic or something similar when values drop below 30. And as I said, especially for beginners, this indicator can be very, very helpful. Let's take a look at this with Bitcoin. And here, I just want to illustrate one scenario purely as a hypothetical example. Of course, you would never actually trade like this later on, but there's one thing I want to show you, just how powerful the RSI really is. And what we can observe now is this. We can take a look at what would have happened if every time, if we had sold Bitcoin in the overbought zone, so basically here, or for example here, if we had always sold off Bitcoin at these points, what would have happened? And conversely, what would have happened if we had always bought Bitcoin here? So completely blindly, as I said, without any strategy or anything else. Just in this case, using the RSI. And with that, we actually could have achieved pretty good results. Probably even better results than 90% of the general public. I can easily imagine that because, for example, we see here, okay, the RSI is oversold, which in this case was perfect at an intermediate high point for Bitcoin at 70,000 US dollars, which happened during the summer slump of 2024. And every time we look here, RSI oversold, it dips in once, dips in again. If we had bought Bitcoin here, these would definitely have been very, very good entry opportunities, and the same goes the other way around. So also to take profits, here we might have sold just a little too early because in this case we reached a value of 83 on the RSI. But still, it would have been completely fine to sell Bitcoin back then at 90,000 US dollars because in this case we bought in the oversold area on the RSI. So it is definitely very, very, very helpful. Of course, it's never perfect. Yes, sometimes, for example, we have a low point here in the Bitcoin price, but in this case, the RSI was right in the middle. You have to be careful with that, of course. As I said, it's obviously not a strategy to only look at the RSI, but I still want to show just how powerful the RSI is and that it definitely gives you a good indication of whether Bitcoin is overbought or oversold. And this really does become apparent time and again. You can also see this very clearly with Ethereum, for example. I only recently noticed this myself in my own analysis. So let's take a look here, and it's really interesting to observe this on a daily basis because Ethereum is very typical for the following price behavior. With Ethereum, it's always like this. Ethereum makes its move, bam, then has a consolidation phase, and then comes the breakout, bam, back up again. And that's exactly what we've seen here and exactly what we've seen here. And what happens very, very often is that Ethereum basically initiates its move. We can take a look at that here. Ethereum pumps extremely hard. Ethereum is completely overbought here. People get greedy, right? And then during the period when Ethereum moves sideways, the RSI basically has time to cool off. And that's, I would say, a scenario that I keep mentioning in my YouTube videos. It's like a kind of spring being compressed. It's a loading phase that takes place, because right after such a pump, a consolidation phase is really optimal, because then we have two factors at play. On the one hand, the price stagnates, but on the other hand, the indicators have time to cool off. This way, the spring can be compressed again. It's a kind of loading phase that takes place, and then we have a lot of room on the RSI again for the next breakout. And that's how the next breakout happens at an RSI value of 56, giving us significantly more room to the upside again so that Ethereum can potentially reach new highs. Especially if you make a comparison here. Ethereum was at 2,500 US dollars and was in the overheated zone at that point, but was able to cool off nicely thanks to the RSI. So this definitely gives you a reference point for how you can use the RSI, among other things, for identifying overbought and oversold conditions, just as I wrote down here. But now let's move on to the next point, because there are actually several use cases for the RSI. Namely, point number 2, there are clear divergences. And this is definitely also a very, very, very important and relevant point. So let's jump straight into the practical side of divergences. Specifically, we can take a look at what does the RSI do compared to the price. I'll read this out exactly as it is from the box. A positive divergence occurs. So basically, you can assume that the price will soon initiate a trend reversal. It first comes from a negative trend, yes, when the price basically reaches a new low. In this case, the price is in a downtrend, but at the same time, the RSI is forming a higher low. So the RSI is in a clear uptrend, and this is essentially the divergence. Price goes down, but the RSI goes up. And that's basically where the name RSI comes into play. The relative strength is essentially present here, and it's usually a sign that a counter movement is about to begin. And the same applies the other way around. By the way, this is the bull run of 2020 and 2021, if I remember correctly, and we saw it very clearly there as well. New all-time highs were reached with Bitcoin, but the RSI actually decreased. This means we saw relative weakness, which is usually an indication that a negative, that is a bearish trend, is starting. This is definitely very, very important. I think based on this example, you could see quite clearly what the RSI is all about. Then, of course, there is the third and final point. Now, let's say, aside from divergences, overbought and oversold conditions. We've already covered that in this case. Now, point number 3, RSI trendlines and chart patterns. Theoretically, you can also have a double top or double bottom in the RSI, at least in theory. But to be honest, I wouldn't take that too seriously. Simply because the first 2 points are the main use cases here. So that's really the most relevant thing to look at. Okay, where is the RSI? Is it either overbought or oversold? And the second point, are there currently any divergences present? At the end of the day, those are basically the 2 checks you need to perform when it comes to the RSI. In this case, there's also a kind of modified version of the RSI indicator, and that's actually the default setting in TradingView, where if you take a look at it, the RSI-based MA, meaning this moving average line, is usually even activated. You can turn it off for clarity, or you can leave it on. As I said, in this case, I've explained everything about what it's all about. I'll be completely honest with you here, because as I said, I'm also speaking from experience. I use music gets louder. I hardly ever use this method at all. Yes, I use the RSI exclusively for 2 things, overbought and oversold conditions and divergences. That's why, yes, feel free to read it for yourselves. It's definitely relevant if you want to have heard about it, but personally, I don't actively use it in my strategy. Now let's move on to the next momentum indicator, which is the Williams percent range. It's definitely very pleasant to use as well. I traded with it for a long time. Sometimes it's actually a bit better than the RSI, but even so, in the long run, I would still prefer the RSI simply because it offers more possibilities. Feel free to read about it. I don't want to go into too much detail here because, as I said, I want to focus only on the relevant ones, but in the PDF, everything is presented again in detail and in a consistent manner. The next indicator is the MACD. Also very, very important. In this case, we will go into detail because this is definitely an indicator that appears quite frequently, one that you can use very often and that is clearly applied. Later in practice, the MACD indicator or MACD indicator, depending on how you pronounce it, will look like this in TradingView. We'll get to that in a moment. On one hand, we have a MACD line, which calculates the difference between two exponentially weighted moving averages, EMAs, of different lengths. There are basically always two crossings that occur between the respective EMAs. You can definitely use it that way as well. Yes, that's what I would say is a component of the MACD indicator. On one side, that's a 12-period EMA and a 26-period EMA. If you don't quite understand and are maybe thinking right now, hey, what's that all about? It's too complicated for me. Don't worry, we'll dive deeper into it later because it will actually come up again. But as I said, more on that later. What is much more important is this histogram, specifically these green and red bars. The MACD histogram shows the difference between the MACD line and the signal line. Histogram equals MACD line minus signal line. I'm going to go into more detail about that right now. As I said, you don't even really need to understand exactly how something like this is put together, because later on, what matters is being able to use it in practice, not just in theory. At the end of the day, it's also pointless if I spend all day watching YouTube videos about the gym or how to build muscle, but never actually go and work out myself. And it's exactly the same with indicators. It's nice and good to understand the background, but later on, you need to be able to handle them in practice. That's why we're now going to talk about the most important, let's say, interpretations of the MACD. First, point number one, and probably the most important, trend direction and strength. Specifically, it's like this. As soon as there is a positive histogram, meaning these green bars, you can assume that there is a positive, strong trend and good momentum. That's also what it's called later in trading. So basically, at the end of the day, these are also momentum indicators. I can quickly show you what this looks like on the chart. You simply search for MACD under indicators and you can either use the standard one. There are also, let's say, some additional variations. It looks like this in one version and like that in another. Yes, so the differences are minimal. It's really just the visual representation. We can just go ahead and properly select the standard one here, and then we can take a look at, okay, when is there a strong trend, and when can we expect a trend reversal to be starting? Of course, it's very, very relevant to trade bull markets or individual trends. We can also take a quick look at the whole thing with Bitcoin, and as I said, we'll enter the entire MACD here again, and we can see very clearly, okay, hey, there are certain trends. When a breakout happens with Bitcoin, we have very, very positive momentum during the breakout. Yes, but as soon as this dark green turns into light green here, you need to be a bit more cautious. This means the trend is slowly but surely fading. That's one factor, so to speak. Plus, in addition, it's also important to watch when we get the crossover of the individual EMA lines. As soon as, in this case, the blue line crosses with the orange one, you can assume, okay, the trend is now slowly but surely coming to an end. That was in this area, and it was actually quite precise. So the big upswing was, in this case, also slowly but surely over here. You definitely need to be careful, and here's a little tip from me. There are minor disturbances that occur, like here, for example. So it turns red for a moment, then green for a moment, then red again for a moment. You really have to watch out for that because it can end up looking pretty messy on the chart. In that case, you basically have all the lines constantly crossing each other, and that's definitely something you want to avoid later on because it's very unclear. So I don't like to enter trades when something weird is happening with the lines. I want to have clear signals. I want to see very clearly, okay, hey, strong upward trend. Then I can enter beautiful long positions during this period, scale up my trades here, and as soon as I see, oh, okay, hey, both lines are crossing here, the trend is shifting into a bearish trend, or the momentum is fading, I can already see it here. Okay, the bars are now turning light green in this case. Here comes the crossover, and here it turns red again. Exactly here is where I find my exit, and the exit would have taken place at about this point, which was usually a very good time as well. So you definitely have some very, very good indicators here, and this way you can, of course, determine trends quite easily. You can see based on the signal line that the upward trend is still intact. How strong is the trend? The further the lines are from the 0 point, the stronger the momentum, so to speak. So that's definitely how you can categorize the whole thing. And especially on higher time frames, it's also very interesting because it's much clearer, of course. There we can see very clearly, okay, hey, the bull market is intact. For example, the bull market in 2017. A beautiful histogram in that case, beautifully green. The trend and the momentum were very, very strong. Then in this case, the crossover happened, and yes, it's also important to understand here, all these indicators are slightly delayed. So, just to explain again briefly, indicators never tell you what will happen in the future, but indicators show you what has happened, which you might not be able to read directly from the chart at first glance. That's why there are also some critics of indicators, because many people always think, yeah, with the right indicators, I can predict exactly what will happen in the future, but that's wrong. So that's really wrong. Indicators only show what is happening right now at this moment. That's why this is definitely important as well. That's why you'll never be able to perfectly sell the bull market top with a MACD indicator or anything like that. So I definitely want to take away that illusion from you here, because there is always a time lag. You might still have sold in time, because then, in hindsight, the bear market had already started. You would have found the exit in time, but you can never perfectly determine any tops or bottoms using the MACD indicator. As I said, it's just a reference point, and that reference point simply gives you a clear direction. Are we currently in good momentum, positive momentum, or negative momentum? That is, I would say, the main purpose of the MACD indicator. It's about trend direction, trend strength, and momentum. Be sure to take a look at the histogram. Are we in the red? Are we dark red? Or are we green or light green? That is, I would say, very important. How strong are the swings? Because at the end of the day, the stronger the swings, the stronger the momentum, the stronger the trend. That is, I would say, important to keep in mind. Then, trend reversals, whenever it switches from green to red or from red to green. And when all the lines cross, that's a good indication that you can identify clear trends, but also divergences. So in theory, just like with the RSI, you can spot divergences using the EMAs and the histogram. But let me be clear with you at this point, when it comes to divergences, it's better to use the RSI. The RSI is much better for identifying divergences. I've had much better experiences with it. It's much more precise than the MACD. It is theoretically possible though, as I said, I included it here for completeness, but in this case, it's better to use the RSI. That's all there is to say about that for now. Let's continue with the SMA, which stands for Simple Moving Average, and the EMA, Exponential Moving Average. These are also very, very relevant. You'll see them very, very often, whether it's with other YouTubers or if you've ever been on Twitter. Yes, you see this over and over again in the charts, and it's definitely justified, because it gives you a clear indication, is the bull run still intact, or are we already in a bear market? So it's always important to check in from time to time to see what these indicators are actually showing at the end of the day. The SMA calculates the average price of an asset, for example Bitcoin, over a specific period by adding up the closing prices of the last periods and dividing by n. As I said, this is getting a bit too detailed about how the entire indicator is calculated, and you don't necessarily need to understand that right away. At the end of the day, we'll get to the practical part later. I'll show you directly what it's all about. But basically, we just have average values that are calculated accordingly, whether it's over 20 periods, 50 periods, or 200 periods. For example, to briefly show this in practice in a simplified way, if you add a 50-period SMA, then if you're looking at daily candles, it's basically the last 50 days that make up the average. So this N or N periods is the time unit you choose. That's essentially the formula for it. Interpretation. There are definitely several possibilities here. On the one hand, we have clear support. Yes, so in fact, the chart often tends to follow what the SMA or EMA is doing. And in this case, both apply, meaning both support and resistance. And as soon as the flip happens, the barriers are usually broken, and it's actually more precise than you might think sometimes. Honestly, I personally am sometimes really surprised by this indicator, and in this case, I've included both charts here from Bitcoin during the 2020-2021 bull market. Specifically, this is the bear market of 2022-2023, and in this case, the bear market ended after this SMA was broken through, with a retest, truly a textbook chart. And it really is just like that with Bitcoin, and in this case, it's also Bitcoin in a bull market. It's definitely very, very important to understand all of this in practice. I'll show you again very briefly how all of this looks in TradingView. We just type in EMA, and then we basically have these exponential moving averages. They're calculated a bit differently, but we also have the SMA, which I can search for here again. Then here we have the simple moving average. We can click on it here, and depending on how we set it up, we basically have different periods. In this case, we can enter what the length should be. For example, we can now enter 20 periods. And as you can see, depending on what we enter here, the SMA adjusts accordingly on a weekly basis. In this case, it's 20. You can also add a 50-period SMA. As mentioned, all of this is always managed through the settings in the top left. Then you can enter 50 for the length here, and you'll see how everything changes in this case. It's definitely very interesting. With Bitcoin, we've always had clear points of reference here as well. I can even highlight the whole thing for you. You can make the whole thing yellow, make it a bit thicker, and then you can see quite well how precise this indicator actually was during this bull run. We can take a direct look at that right here, live with a practical example currently with Bitcoin as it relates to this bull run. So let's take a look at the 50-day SMA, and the number 50 is definitely quite relevant because it usually determines, is the bull run still intact or are we already in a bear market? So that's one of the ways I would say you can use the SMA. We saw it back then. The 50-day SMA during the 2020-2021 bull market served perfectly as support here. In that case, it was not breached on a weekly basis with a weekly candle. So there was no candle close below it here. Yes, and only when there was an obvious candle close below the 50-day SMA did the bull market truly come to an end. We even got a nice retest, and bam, the bear market was initiated. And when did the next bull market start again for Bitcoin? We can see that right here. As soon as the 50-day SMA was broken through here, Okay, here we saw a clear trend reversal, even a kind of confirmation. In this case, Bitcoin also found support again at the 50-day SMA, and this whole pattern repeats over and over again. Even during the summer slump of 2024, we briefly tested it here with a candle wick, tested it again, and then actually once more in April 2025. Here too, the 50-day SMA was extremely relevant. I even kept including it in my YouTube videos. So you can clearly see just how practically relevant this SMA is later on in trading or generally for classification. This doesn't just apply to trading individual mini trades that you take, but also more broadly to bull and bear markets. And it could very well be that this 50-day SMA continues to develop, doing something like this, something like that. Bitcoin does this again, that again, then it happens again, then it happens at some point again, and eventually this 50-day SMA gets broken, maybe even with a kind of retest. The 50-day SMA then also drops off, and in that case, the bear market is essentially triggered. So you should definitely make a note of that one right away. It's definitely worth having the 50-day SMA set up, and later on it becomes especially relevant when you combine multiple EMAs or SMAs. So we can go ahead and open a new layout if you like. Then I'll quickly show you something extra as a little bonus, which is something you'll encounter later on when it comes to trading strategies. So now we can use the SMA, or in this case an EMA. There are also certain EMA sets like the 20, 50, 100, and 200. These are already conveniently set up here, and you can see the individual lines. Just for orientation, I can make it a bit bigger in this case. And here, we can directly set the individual EMAs and SMAs, and there are various options and different ways you can combine them. In this case, I've added the EMA with different time frames. Now I can also add the SMA here, and then we've basically already combined two of them together. Now we'll go in here and set the SMA to yellow for a moment so we can really see it clearly. And in this case, of course, it all depends on what settings you choose. You can set it to 9 or you can set it to 14. So you need to experiment a bit with that. We'll go into more detail on this later. And what you can do now, for example, is switch to the hourly time frame, and on an hourly basis, you can combine certain indicators or different SMAs and IMAs. As I said, I don't want to go too much into detail yet, but I just want to give you an example of what's possible here. You can combine the SMA and EMA here, and every time the two lines cross, you could, for example, enter a short position. When the two lines cross upwards, it's usually an uptrend. So this is definitely a clear use case where you combine multiple IMAs and SMAs. As I said, this is purely hypothetical for now. Later on, we'll go into more detail about how to choose the right parameters, the correct settings, what you need to pay attention to, what makes sense, what you should do, and also what you shouldn't do. So this will definitely become especially relevant later on. That's why it's definitely worth watching this entire video course from A to Z. As mentioned, everything is summarized again here in the PDF. There are crossover signals that become relevant, for example, when you combine 50 periods with 200 periods. There are several combination models, and we'll go into more detail later about which ones make sense and which ones don't. As mentioned, support is definitely important as well. Now we're going to talk a bit about a transition. So far we've covered that there is the SMA and the EMA. The only difference is that in the case of the EMA, the exponential moving average, it's just calculated differently. The calculation is somewhat different from the SMA, but at the end of the day, understanding the formula is of secondary importance. Later on, what matters is using both indicators correctly in practice. Now things are about to get interesting again, because there is also the EMA ribbon. This consists of several EMAs layered together, and it's also a relatively well-known indicator. I can go ahead and add it here in TradingView right now. Just search for EMA, and in this case EMA ribbon, and you'll see right away that I've already marked it for myself here. EMA ribbon, just click on it here, and then you'll have a nice overview. And it's also very, very interesting to observe Bitcoin this way, because it gives you a very strong indication of whether Bitcoin is in an uptrend or a downtrend. And later in practice, you can use the EMA ribbon for support and resistance. So, as I said, it always applies to both cases, in this case for resistance or support. These are usually always good reference points, and of course also useful for determining the overall trend. So as long as the yellow line dominates, as long as the yellow line is on top in this case, it's an uptrend, and as long as the red line is on top, it's a downtrend. And only when this flip happens, so basically when these lines cross, can you assume, okay, hey, the long downtrend is over. We can definitely expect that Bitcoin will reach new highs again. And that's exactly what happened. So that's really very interesting. That's what we saw there. There, we had a flip. That's why in theory you could have built good short positions here. It became very clear that after this EMA ribbon flip on the daily chart, of course it always depends on the time frame, but in this case you can determine trends very well on a higher level. And then of course we also see the counter movement here as soon as the flip happened again. So it's definitely very interesting, and as soon as another EMA ribbon flip happens here, when the yellow line crosses the red line again, you can assume that a downtrend is starting, which usually lasts for several days or even weeks. Especially, of course, when you look at the whole thing on a daily basis, it's always a question of which time frame you're using with the indicators accordingly. We'll talk about that later, what makes sense when, depending on your trading strategy. But for example, the EMA ribbon is also very relevant for bull and bear markets because we've seen it very clearly. The EMA ribbon was always with the yellow line on top until the flip happened. In this case, the bear market was then initiated here in 2022, 2023. And as soon as the ultimate flip happened here in this area, that was exactly the point when the new bull run started in 2023, 2024, 2025. Yes, and I can also well imagine that the current bull market will end again as soon as the EMA ribbon makes its flip in this case. At the moment, everything looks very clean. Currently, we can assume that Bitcoin will reach further all-time highs. That is definitely the current situation. And as soon as at some point the flip happens in the EMA ribbon, you can assume, okay, hey, the bull market is really officially over. So that's usually also a very good indicator, so you definitely know what's going on. That's all for the topic of the EMA ribbon. Now, we're definitely moving on to the next two trend indicators, namely the Ichimoku cloud, and secondly, the Directional Movement Index, or DMI. We're only going to touch on these very briefly now, because otherwise it would really get too complex, especially in this beginner's course. As I said, I prepared all these slides to give you a complete overview, so you really have everything in one place. But at the end of the day, I will just be repeating myself here, because I can tell you one thing, all these indicators are composed in a similar way, just like the EMAs and SMAs. Of course, I can give you a brief summary at this point. We can also take a quick look at what the Ichimoku Cloud indicator actually looks like in practice. In this case, we activate the Ichimoku Cloud indicator, and as you can see, this is basically it right here. That's also why this indicator is called the Ichimoku Cloud, because at the end of the day, it looks like individual clouds, and depending on how these clouds cross each other, you can basically infer a trend, either an upward or downward trend. We can also take a look at the whole thing on an hourly basis. There, you can constantly see, okay, hey, we have a clear trend here. You can also highlight the whole thing here quite well, so it's best to increase the visibility here a bit. That way, you'll be able to find your way around a bit better at this point. Here, we can simply increase the opacity, and then you can see quite clearly, okay, hey, uptrend, downtrend. Yes, and it's similar with the DMI indicator. We can also quickly turn it on. It's also quite well known. At the end of the day, it works just like an SMA or EMA indicator. At the end of the day, it's also about all those crossovers, and that's how you can determine trends as well. It would go beyond the scope here, otherwise I could talk your ear off for hours. Definitely take a look at the PDF, download the PDF. As I said, everything is linked in the Telegram group, and then you'll have everything explained here down to the last detail, so you can really dive deep into the complexities here. But here in the YouTube video, it was only important to me to present the most important, the most relevant indicators. And as I said, in the category of trend indicators, it's very clear. The SMA is extremely important, the EMA is extremely important, and the EMA ribbon is also very important, or rather, great for getting an overview. It's especially a great starting point for beginners, and definitely something you can use. With these two here, things definitely get a bit more complex. You really have to dig in a bit there. So definitely take your time to look at the PDF here. Now let's move on to point number 3, the volatility indicators. Here, we'll take a look at the Bollinger Bands. They can sometimes be quite interesting, among other things. Personally, I don't use them very actively because I can roughly estimate how the Bollinger Bands will behave. But it's really just about showing how volatile the market currently is. The further apart the two bands are, the more volatile it is. As I said, if you're interested in more details, definitely make sure to read the texts. You can definitely glean some information from them, but personally, I only find the Bollinger Bands moderately relevant. Let's take a quick look at this in the chart so you can get a brief idea of what it can look like, namely the Bollinger Bands. Just search for Bollinger Bands here. There we already have the entire indicator, which I had already marked. As I said later on, you can also mark the individual indicators with stars. Now, in any case, let's get to the topic of Bollinger Bands. What you can see here, and this is a little tip from me, is that it's always interesting to observe. When the bands contract, it's quite often the case that an explosive move follows afterwards. And by now, you've probably slowly but surely started to notice why I said at the beginning of this video course, or at the start of this chapter, the more intuition you have as a trader, the fewer indicators you need. Because personally, for example, I would have recognized something like this immediately. Okay, hey, volatility is decreasing. Bitcoin is basically in a kind of loading phase, like a spring being compressed. Sooner or later, there will be an explosive breakout either upwards or downwards. And that happens very, very often. Of course, especially as a beginner, an indicator like the Bollinger Bands can definitely help with that. There you can see, okay, hey, when are the bands being squeezed tightly together? And that is usually a sign that an explosive move is about to happen. That is, let's say, a reference point for how you can use the Bollinger Bands. On the other hand, you can also use the Bollinger Bands to see, okay, hey, similar to the RSI, when are we overbought or oversold? In this case here, as soon as the lower band is reached, it's usually a good idea to build up some long positions, and as soon as we're in the upper area, you definitely need to be careful if the band is broken to the upside. That's all for the topic of Bollinger Bands. I don't want to go into it too deeply. You can definitely see from how deeply I go into each topic and how much time I spend on each indicator. That way, you can later implement everything yourself. So the more important the indicator, the longer I talk about it. And if I just skim over certain indicators, then they're optional. Ichimoku is optional, DMI is optional, but I would say you should definitely have the SMA. You should have the RSI. You need to understand the MACD. Yes, those are, I would say, the really important ones. Now, we're definitely moving on to the fourth point, which is the volume indicators. These can be very interesting and also very important. I'd like to talk about that in more detail now because they actually come up quite frequently. There's definitely one in particular that I want to cover more closely here. There's the standard trading volume. The trading volume simply shows how many buyers and sellers are currently present. As soon as we see a spike in trading volume, you can definitely assume that there's increased interest. You often see a lot of buyers and a lot of sellers there. That's also something I already discussed in another chapter, so you can definitely determine whether there are more buyers or more sellers present. That's what I'd call a reference point. That's also a behavior I mentioned earlier. We can quickly pull up CoinMarketCap for that. For example, if you notice, okay, hey, in the trending coins section, we can, for instance, click on Dogecoin, and it's quite often the case. A coin is trending when there's increased volume here. We can see it down here, for example, that the trading volume has skyrocketed. In this case, we've seen an 89% increase in Dogecoin over the last 24 hours, and that's an indication that a lot of people are interested in this coin. Many are buying, many are selling, and most of the time, this behavior is also accompanied by increased volatility. So that's definitely something you need to keep in mind. That's important, right? It's definitely a good indicator to look at to see whether there's enough trading volume behind certain breakouts. Because one thing I can tell you, if you start doing pattern trading or anything like that later on, and you see that the trading volume is dead, nothing is happening, then it's usually a fake out. So in that case, you can basically disregard the entire pattern. It basically dilutes the entire market psychological structure behind this chart pattern. That's why it's always important to pay attention. Is there enough trading volume behind a chart movement? Yes or no? If yes, it's usually sustainable. If not, you can definitely ignore it. I would never enter such a trade because in this case, there simply isn't any trading volume. That's why there's no possibility for a sustainable breakout to occur. That's, I would say, a relevant point that you can always apply when it comes to normal trading volume. Now let's definitely continue, and this is actually closely related to trading volume. So both basically go hand in hand. On the one hand, trading volume, and now the volume oscillator. Because at the end of the day, the volume oscillator determines the strength of the trading volume as if we were seeing a kind of relative strength. Practically, everything above it is in the neutral zone, or in this case, we currently have negative strength. So you can assume that there is little trading interest when we enter the negative range here. This is basically measured based on previous values. As explained above, it is essentially calculated using a moving average, and it is usually a good tool to measure whether there is real buying power, real buying pressure behind it. We can quickly switch over to the chart here and take a look at the whole thing. We have the regular trading volume displayed at the bottom. There we can see, okay, where are there a lot of traders involved? Where is a lot of buying and selling happening in that area, in this case viewed horizontally? And now we can also add the volume oscillator here. I've already marked the volume oscillator here as well. We can also add it to the chart at this point, and then we can clearly see when there is a lot of volume and when the volume is tapering off. And most of the time, these are also the points where the chart stagnates. Where we see consolidation here is usually the time when there is no real interest, low trading volume, and these are generally the quieter phases. As a small tip, what I personally like to do is always observe, okay, if I want to enter a trade, for example, if I want to open a long position here, then I quickly check, hey, what is my volume oscillator doing? Are we in the positive here or in the negative? In this case, everything looks very clean. Then it's definitely fine to enter the trade. It's just a little check, a quick checkup to see if there's really buying power behind it, and then it's definitely legitimate to take the trade. Personally, I don't use the volume oscillator all that often, actually, because you usually develop a sense for whether there's a lot going on at the moment or not. As I said, you can read a lot from the chart. The more experienced you are, the better your intuition as a trader, the fewer indicators you'll need. As I said, I'm probably already annoying you with that saying, but that's just how it is. And you can also ask other traders, experienced traders, and you'll definitely notice that truly professional traders, especially the really experienced ones, will trade with almost no indicators at all, simply because they have such a good eye that it's no longer necessary to use certain indicators. That's all I have to say about that, in any case. Now, there's one indicator that's actually very interesting, which I also occasionally use, and that's the site volume profile. This is definitely very interesting because here the volume isn't displayed horizontally, but vertically. So basically here we can see how much volume is present in which price range. There are certain price ranges in Bitcoin and in trading in general where a lot of trading takes place. This usually coincides with important support or resistance zones, so to speak, and you can read this very well from the chart since it simply displays vertically what the trading volume looks like. So we can actually jump right into the chart at this point and take a look. Okay, hey, what does this actually look like in practice later on? Then we'll switch to a new layout here, go into TradingView, and there are several options available. At this point, one option is to turn on the VRVP, which stands for Volume Range Visible Profile. So you'll find it if you search for VRVP. What I personally like to do here is remove this line, because that's a kind of average value, the POC. This is also explained in the PDF, but for now I'm going to remove it. And now I basically have a reference value, where in this price range, right now in the case of Bitcoin, is a lot of trading currently happening. Where is there little trading happening? Where do we basically have support, and where do we have resistance? And depending on what you add to the chart, you'll see here on the right side where a lot of volume occurs. And that, I would say, is the main use case for this indicator. Now I'll move the face cam up so you can see everything clearly here on the right side. And now we can determine pretty well, okay, hey, we clearly have a price range for Bitcoin at the current time around 116, 117,000 US dollars. That's the price range, and there's a lot of trading volume here. This means that this is usually a reference point for Bitcoin. And these are typically the areas where Bitcoin enters a kind of consolidation phase, where, for example, something like this happens here. And that's exactly the behavior we're seeing here. Now, it's important to note that there are certain volume gaps. There are holes here where there's virtually no volume at all. And what does that mean specifically? Now, let's go back to chapter 2 at this point. That's why chapter 2, I've said it again and again, is extremely important. In chapter 2, we explained the principle of market making. How does the game played by market makers actually work in practice? And it's definitely important to understand this. The less liquidity there is, the easier it is for market makers to push the price up or down. Yes, so depending, of course, on where Bitcoin is currently positioned, especially when such volume gaps occur, it's very, very easy for market makers to do something like this. And on the other hand, it's also very, very easy for market makers to do something like this. So in practice, it's very, very rare for Bitcoin to do something like that within a volume gap during a consolidation phase. That's very, very rare because usually Bitcoin shoots straight up, or at that point, Bitcoin can't hold the support here and drops directly down. And then the next support is usually exactly where the next volume appears again at 110,000 US dollars. That's usually the case when there's a lot of trading going on here again. There are several positions here again, and that's when it's worth pushing the price down here. That's incredibly common. You see it over and over again. It's definitely worth understanding the indicator. And especially important, what you need to pay attention to in practice, where are there volume gaps? So where are there clear gaps in volume, where hardly any trading is happening? There actually is another one, which is called something different. That's another modified version. This indicator is from Lux Algo, which is also a relatively well-known indicator provider, and it's called the liquidity sentiment profile. Yes, and it's quite similar. Here we can basically see it as well. Let's take a look at it together. By now, of course, everything has become super confusing, but what I also want to show you is that if we remove everything, you'll notice that the indicator works in a very, very similar way. We can take a look at it here as well. Okay, in orange we have increased volume appearing. Then here we have our volume gap, another volume gap here, and the next volume doesn't actually show up again until down here in this area. So this is actually exactly the same indicator, just displayed a little differently, and we can also set that here. In the settings, we go to inputs, and then we can specify how many periods should be included in the calculation. We can also enter 500 here, for example, and then you'll see how everything changes, because now everything within the box is being calculated. And accordingly, depending on how big the box is, that's how the calculation is done here. So we can also add even more, maybe even 1,000, and then we'll get more reference values here as well. Then we can take a look at the whole thing, and you'll see right here exactly things are already changing. So we've basically included more data. All data from that point on, yes, within this rectangle, are included in the calculation, and based on that, the volume profile is displayed here on the right side. And we actually have exactly the same result. We have a lot of volume here, then a volume gap, which means if Bitcoin doesn't hold this level, you can definitely expect that Bitcoin will drop back into the range of 108 or 110,000 US dollars. That's what I would call very typical. So it's very unusual for Bitcoin to stay in a volume gap for a long time because, as I said, in those areas, it's very, very easy for market makers to push the price up or down. So that's all for the topic of VRVP, or in this case, the Lux Algo Sentiment Profile. So you have the name here again. I'll move my face cam down for a moment. Then you'll see up here on the top left in TradingView, the Lux Algo Liquidity Sentiment Profile is integrated, just so you're aware. Both are equally good. Yes, I use both quite frequently in my own analyses as well. That's all for now on that topic. As I said, everything is explained in detail again in the PDF. There you have another summary. Now we move on to a very, very, very important topic, namely Fibonacci retracements. It may sound complicated, but it's actually used very frequently by many traders, and it's by far one of the tools I personally use the most. There are many things where you can train your eye. There are many things where you can develop a feel for it, whether it's with an RSI or with volume oscillators. So no matter which indicator I look at here in my PDF, you can develop a certain intuition for every indicator, except for Fibonacci retracements. And even the best and most professional traders use Fibonacci retracements every day. So you really need to understand this. This is actually one of the most important points, especially if you want to trade professionally. It's a very relevant tool that comes up again and again. Fibonacci retracements are a technical analysis tool used to identify potential support and resistance levels within an existing trend. That's, let's say, the main reason. And at the end of the day, they are based on a Fibonacci number sequence, a mathematical series of numbers that is founded on the golden ratio. We'll get into more detail about how to use all of this in just a moment. This is what it looks like on the chart later on, and how you can use it. I've listed it here again. But at this point, I want to go into a bit more detail about this in the chart because it's very, very relevant, very, very important, and that's why we're going to switch to a new layout here. And now we'll take a close look at all of this in detail using the current Bitcoin chart. This works on smaller time frames as well, so it works just as well for day trading on the 5-minute chart. But it also works just as well on higher time frames, on a daily or 4-hour basis. There really isn't a specific guideline here. It basically always works. And that's why I would say you can determine quite well where important levels are. By the way, I also do this especially often when making spot repurchases of certain altcoins, just quickly getting an overview of where important Fibonacci levels are, and based on that, you can really find good and targeted entry points. Here's how it works. First, you need to understand, are we in an uptrend or are we in a downtrend? Because in an uptrend, you draw the Fibonacci retracement from the swing low to the swing high, and in a downtrend, from the swing high to the swing low. Let's take a look at how this works in practice. In this case, we're going to look at it from swing high to swing low. And this way, we can practically determine quite well at this point, okay, hey, where will the price be heading in the future? So you can get an even more concrete insight here. Let's switch to playback mode. Let's just say, okay, hey, Bitcoin has reached its bottom here. So at this point, we've rewound to April 2025. We're looking at Bitcoin on a 4-hour basis. And what you can simply do, if you assume, okay, hey, we've definitely reached the interim high here. So in this case, in the short term, as I said, everything is always viewed from swing high to swing low. If in the meantime you had assumed that Bitcoin had reached its ultimate bottom here with this double bottom, as I said, it's not a big deal if you theoretically drew it too early, because at the end of the day, it's only about seeing how the further price movement looks in the uptrend in retrospect. So it's important to definitely understand the difference there. That's why we're now going to take a look at how you can theoretically, or in this case practically, use Fibonacci retracements. So let's take a look. What is the Bitcoin price doing? And it's often the case that every single Fibonacci level, here we have the 0.236 level, the 0.382 level, and so on and so forth. Here we have the golden ratio, or the so-called golden pocket. The 0.65 and 0.618 levels are extremely, extremely important levels. And most of the time, it's often the case that Bitcoin, in retrospect, tends to react very strongly to the golden pocket. That means in this context, Bitcoin often does something like this. It encounters resistance here, finds support here, breaks through, faces strong resistance here, comes back again, and so on and so forth. So basically, this step-like upward movement is guided by the Fibonacci levels, and accordingly, you can build short positions here. In this case, it's an upward trend. It has to be said very clearly, the trend is your friend until the very end. In plain German, this basically means the trend is your friend, and you should always go with the flow, ride the wave, as long as there is an upward trend. Don't take any short positions, and the same goes the other way around. In this case, if you were to draw a trend line here, you can clearly see, okay, got it. Right here at this point, the trend was broken because in this case, these individual interim highs were, so to speak, breached. Here, ultimately, the trend reversal has taken place. Now we can assume that the bottom is in. The Fibonacci level has been drawn. Now things will definitely continue. I'll make everything a bit clearer for you here in this case. And now we can take a look at the playback mode. How did Bitcoin behave? As I said, we check everything based on the Fibonacci levels. What happened? Let's just let it run for a moment so we have some reference values. It actually turned out pretty much exactly as I mentioned, that especially at the golden pocket, Bitcoin often runs into problems, and most of the time, it clearly follows the Fibonacci levels. This means we're now going a bit more into detailed analysis. Let's take a look at what the 0.382 Fibonacci level is doing. Let's zoom in and we can clearly see, okay, hey, Bitcoin had short-term trouble breaking through this Fibonacci level. Yes, as I said, that's usually a resistance that needs to be broken through. It was definitely broken, and once a Fibonacci level is broken, things usually move very, very quickly in between. Yes, so between the individual levels, it's usually a strong pump or a strong dump without much price action. Of course, in this case, it's not a guarantee, but it's just a rough guideline. And it continues the same way here. Fibonacci golden pocket. What happened? We dipped perfectly into the golden pocket, got sold off again, ran into some more trouble here, but as soon as the golden pocket was broken, bam! It moves up to the next level, goes to the next floor, and here too, the 0.786 Fibonacci level was broken, and after a breakout, there's usually a brief cooling off period. So as I said, that's how it happens relatively often. Of course, it's never exactly the same every time, or it doesn't always have to play out that way, but these are simply good reference points where support and resistance are present. And as an extra tip for you, as soon as a Fibonacci level has been broken, it usually becomes good support below, meaning that the Bitcoin price tends to hold there. And that's obviously ideal for identifying entry points. We can stop playback mode here for a moment. Now let's go live into trading right here and take a look at how a Fibonacci level could be drawn in this case. For example, we can look at the current structure here. In this case, In an uptrend, you could say, let's take a look at Fibonacci here. Then you can pretty easily observe, okay, where are the important levels? What could you do here, for example? In this case, you can see that the 0.236 could be good support below us. Especially important, always pay attention to the Fibonacci golden pocket 0.618 and 0.65. Here we will definitely get strong support. So this is again a very, very important range that Bitcoin could theoretically target. Otherwise, we have an order block formation here. As mentioned, we'll talk more about order block formations later during the live trading, but this is usually also a good indication that Bitcoin is orienting itself here. What did we see? We saw a candle wick. We have an order block formation. This means we can clearly assume that the 0.5 Fibonacci level will definitely be taken into account. Of course, it doesn't have to mean that a counter move will happen here, but what you can definitely assume is that Bitcoin will dip in here, make at least a minimal counter move, and then the decision will be made. Will it be completely sold off in this case, or will it go up? But it's often the case that Fibonacci levels are respected, and you see this over and over again. And as I said, the principle is always the same: swing low to swing high, or swing high to swing low. And of course, at the end of the day, it always goes in both directions. Depending on how Bitcoin is positioned, in this case, you have reference points here. Again here, the Fibonacci golden pocket is almost always a strong reference value for Bitcoin. We can see it very clearly. Fibonacci golden pocket is repeatedly given strong attention in this case. For example, we can also take another look at this with Solana, a complete live example. As I said, I haven't prepared anything here because when you prepare a lot, you always end up finding something that fits somewhere. A chart where something always fits. But here I just want to show that it's almost always the case that you have good reference points. From the swing low, from the bottom at 10 US dollars, we've now pulled Solana all the way up to the absolute peak. In this case, I've drawn it up to the very tip of the candle wick. Yes, in this case here with Solana, and what a surprise. Here we have the 0.382 Fibonacci level. We've encountered strong resistance here twice, and now again. Yes, we've seen it here. We bounced off. Again here, I can easily imagine that a small cooling off phase will take place, and that's very, very typical, very, very common. Everything always orients itself around the Fibonacci levels. It's the same here as well. What a surprise. 0.6 weight, 0.65 Fibonacci golden pocket. What did we see? Here, in this case, resistance, resistance. In this case, support, 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 and again support. This means the Fibonacci golden pocket was definitely clearly respected by the market here. So once again, we clearly saw that the Fibonacci levels work very, very well. And as I said, this can be applied to any altcoin, to any chart, no matter how big, no matter how small, no matter which time frame. You can always draw Fibonacci levels. Even here now, on a 15-minute chart. If we zoom in a bit more here, of course, in an uptrend, I have to mention, just as a quick note, whenever new highs are reached, the question always comes up. Okay, hey, do I draw the Fibonacci here, then tomorrow here, then here the next day, and then here again? Of course, that's not how it's supposed to be done either. What you do in such a case is this. You look at it and say, okay, hey, in this case, we're on the hourly chart. We draw the Fibonacci level from the swing high to the swing low, and that usually serves as a reference point. Also for Solana, if you take a look at it, maybe even here at the double top. Yes, of course, it always depends on how the individual charts look, but in this case, we also have a reference value here showing that the Fibonacci golden pocket was once again a good point of orientation. In this case, we also saw here that the 0.5 Fibonacci level was respected. It was accepted, or rather, it was factored in as resistance here. Then the resistance was broken, and it became support, support. And after the Fibonacci golden pocket level was broken, things are looking very, very good again. Now we're here at the 0.786 level, so this is definitely a method you can keep using again and again. As I said, I haven't prepared anything. Everything is completely live because I want to show it in a totally authentic and truly practical way. It might not always work. It's not always perfect. It can also happen that in this case we have an example where it doesn't work quite as well, where maybe not everything lines up perfectly, so to speak, but it's still a wonderful point of reference, and it always gives good insight into how, generally speaking, the price behaves. It's really great in uptrends and downtrends. You can enter positions based on this quite well, and that's generally how you can proceed in practice. So now maybe one last example. Maybe we can quickly find something here with Ethereum on the daily chart. Just so you can see here, as I said in full detail, how you can approach this. In this case, from swing low to swing high, and then we also have relatively good reference points here. In this case, we see the Fibonacci golden pocket level at 0.618, 0.65. What can we observe? Okay, here we have very clear reference points. That's already, I would say, a good starting point. But what do we see here? Okay, we dipped into the Fibonacci golden pocket. What do we see here? In this case, it was accepted again, and that's always important to observe. When you're reading a chart, it's always interesting to see, okay, hey, what happens in the meantime? You shouldn't always observe it too roughly. If you see here, okay, the golden pocket was initially respected, we first got support, but the support from the golden pocket didn't hold. We broke through, got a retest, bam, and then we were completely sold off. What happens the next time? We shoot right through with Ethereum, and the candle wick lands perfectly on the Fibonacci level 0.618, 0.65. And here you can clearly see how the individual Fibonacci levels really work beautifully. Now we can zoom out again here. What can we see? At this point, the next Fibonacci level is, in this case, the 0.5, exactly the middle, and at the 0.5 we got a bit of support again here. The next one after that is the 0.382. What do we see at the 0.382? I know it's a lot of input all at once right now, but here we see beautiful support, really beautiful support. Again, we see here that it's perfectly respected. It's perfectly checked here. This really is a textbook chart here with Ethereum. Here you can see once again how well Fibonacci levels work, that the market keeps respecting them, and that they provide beautiful points of reference. That's why you can definitely rely on them. If I were to assess Ethereum right now, I would definitely say, okay, hey, in this case, we've now broken through the 0.236 Fibonacci level. Now, you could possibly assume that a small cooling off phase will take place, that something like this might happen. Bam, 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 bam. Above the Fibonacci level, a kind of box forms again. That's typical for Ethereum before the next breakout happens. Similar to what we saw here, bam, the whole thing happens again in this case. So, as I said, this is very, very typical for Ethereum. For many altcoins, Fibonacci levels are incredibly important. I've now explained Fibonacci's in great detail and at great length. I think you've definitely gained a clear insight into how to handle something like this, how to actually use it in practice, but it's extremely important. So it's actually almost the most important part of this chapter on indicators. Now let's move on to the Fear and Greed Index. We'll definitely cover 1 or 2 points there as well. I would say for general market assessment, it's quite useful as it allows you to get a good overview of the market. We can also dive into a chart for that if you'd like. You can always find all of this on CoinMarketCap. Just click on it once, Fear and Greed Index. And yes, I think at the end of the day, even if you're a beginner, you've probably already heard of it. At the end of the day, it's an index, an indicator that reflects the overall sentiment, and the indicator simply shows whether the overall market is in a state of greed, whether people are greedy, throwing a lot of capital into the markets, and generally willing to take on a certain amount of risk, or whether the market is currently in a state of fear. Of course, this is very useful for the broader assessment, and it's also very helpful in determining whether we're in an uptrend or a downtrend. I'll put it this way, for trading, it's more of a secondary factor, more relevant from a macro perspective. It's quite useful for putting things into perspective, but for daily trading, it's more of a secondary consideration, because at the end of the day, you'll be looking at the chart and not the Fear and Greed Index. But for spot positions, for example, if you want to buy more for your own long-term portfolio, Bitcoin, altcoins, cryptocurrencies in general, then it definitely makes sense to take a look at this. In those cases, I would definitely be more cautious when there are extreme greed phases. It's better to take a step back, act counter-cyclically, and sell positions. On the other hand, when the market is in a state of fear, that's when you can buy positions. So overall, that's definitely the most sensible approach. But as I said, it's not quite as important for trading. In general, I would definitely consider this indicator to be relevant, especially for your overall portfolio. But for trading, it's more of a secondary factor, because as mentioned, it usually reflects the broader time frame and the overall investor sentiment, just so you're aware. That's all there is to say about that for now. That was also the last indicator. Now, just a very quick summary. Always use indicators in combination, since each one has its strengths and weaknesses. It definitely makes sense, especially for beginners, to use several indicators. 2 or 3 so you can get an overview right away. Maybe combine an RSI with a VRVP, for example, along with Fibonacci levels. This also works very, very well if, for example, you use a side volume profile, in this case, what we discussed here, in combination with a Fibonacci. You'll often find a lot of overlaps that way. It's especially great when, for example, a Fibonacci golden pocket level coincides with a spike in volume. Then it's an absolute dream scenario for entering long positions. So things like this can always be combined very well. Otherwise, it makes sense to use indicators as confirmation and protection for trades, so you simply get, let's say, a clearer picture, especially as a beginner. All 4 categories of indicators have now been covered: momentum, trend, volatility, and volume indicators. So you're definitely fully taken care of in that regard. Next point, indicators can sometimes react with a delay. That's exactly what I explained. Indicators never predict the future. You can't read the future from an indicator. In 90% of cases, indicators always react with a delay. Yes, it's very important to keep that in mind so you don't get the wrong impression or build up any illusions or anything like that. Next point, more is not always better. Use a maximum, and I really mean this, a maximum of 5 indicators, and even 5 indicators is already quite a lot. Most of the time, 1, 2, or maybe 3 at most are enough. Of course, as a beginner, it might be a bit different. You can experiment a bit at first, but otherwise don't overdo it with indicators, especially for a single trading decision. Because the more indicators you use, the more diluted your trading decision becomes. So it's better to keep things simple. Less is definitely more in this case. And finally, the last point, exotic indicators are often just a combination of the most well-known ones. So don't be fooled by any YouTube videos claiming to have the ultimate indicator or anything like that. Most of the time, it's just a mix of RSI combined with Ichimoku combined with some EMA. That's quite common. Usually it's just some fancy name or something like that, so please don't get confused by all the indicators out there. You're definitely fully covered with all the standard indicators. As I said, everything is linked in the video description and in my free trading Telegram group, so you'll definitely be informed. That's all for the topic of indicators, and with that, we'll close this chapter here. Now, let's move on to the right side, to point number 6, psychology and mindset. This is definitely a very, very important chapter as well. I've listed it here once. At the end of the day, it's the foundation on which everything is built. Later on, chart analysis, risk management, fundamental analysis and strategies are basically the house, and trading psychology is the foundation on which everything is built. If you have the wrong trading psychology, not the right mindset, not the right techniques, then no matter what indicators you use, no matter what chart analysis you apply, you will go down without a trace in the crypto market, because at the end of the day, you won't have your own emotions under control. So I can give you as many tools as you want. If you simply can't handle the tools because you're just an emotional trader, then you will never be successful in the crypto market. So this is really the be-all and end-all. And this chapter isn't about eliminating emotions or anything like that, but rather about dealing with them properly. In fact, you can even use your own emotions as a kind of indicator to help you make decisions. For example, if you feel extreme greed and you want to throw even more capital into the crypto market, then that's usually a good indicator and a good sign that it's time to take profits. And of course, the same applies the other way around. If you are super anxious, panicked, and say Bitcoin drops back down to, I don't know, 50,000 US dollars or something like that, then that's usually a good time to consider buying more or opening long positions. So it's important to understand that everything is based on the principle of contrarian behavior, meaning you basically always do the exact opposite of the majority. That's usually when you end up in the best position. I know that this chapter can be very, very dry, or maybe you just don't feel like dealing with this chapter at all. I can definitely understand that. With the other topics, things were definitely much more practical. Now, for many, everything might seem a bit abstract or a bit dry, especially when we start talking about psychological topics. Of course, I've also prepared a lot for you, but it's still an important topic. I'm also trying to get through this chapter as quickly as possible, but it's still fundamental. It's extremely important. I can't say it enough at this point, just how important this chapter, how important this topic really is. But on the other hand, I also know that you'd probably prefer to just skip ahead to the chapters where we get into live training or where the specific techniques are explained. But still, take the time consciously, listen to it briefly, and you'll definitely gain a clear advantage. So, very briefly, here are 4 reasons why trading psychology is just as important. First, emotions, being able to control them and knowing how to deal with them. Then there are certain cognitive biases, and then the topic of self-reflection. How can you actively improve yourself in trading? And of course, certain character traits that should ideally be present for trading. Take a look at all of this calmly, and it's best if you quickly take a screenshot and pause the video, because now we're going to get started right away with point 1.2. The entire market is based on psychology. That's important to understand. At the end of the day, trading is inevitably player versus player. We also explained this in chapter 2 on market making, that there always has to be a buyer and a counterparty, a seller position, so that a price discovery phase can even take place. And that's important to understand and always keep in mind. On the one hand, you might think, okay, Bitcoin's going to rise now, but there always has to be a counterparty who is betting exactly the opposite of you. You always have to keep that in mind so that anything can even take place, so to speak. And that is, at the end of the day, the principle of market equilibrium. I already explained a bit about this in chapter 2, about the market makers and the retailers. The next point I want to highlight is that it's especially important to take advantage of the loss of rationality among the general crowd, because most of the time the majority always acts as a herd. We'll talk more about this later, about the topic of herd mentality, or in other words, herd behavior. And once you understand how the general public really acts, that the broad masses aren't particularly intelligent, because for the most part, it's more of an emotional crowd, you could say. That's how you should picture it. And that's why you can really take advantage of this for your own decisions, for your own trades. This is especially true, as shown here in the case of Bitcoin. With Bitcoin, nothing has ever changed since day one, yet there are still bull markets, there are still bear markets, and at the end of the day, it's nothing more than human psychology. The general public isn't interested in cryptocurrencies when everything is dying, when everything seems dead, when prices are low, even though in reality it should be exactly the opposite. Normally, if I, let's say, see prices in a supermarket, or if I go to an electronics store and I want to buy a new iPhone, and I see, okay, hey, I'm only paying half the price, or maybe just 20% of what it used to cost, then normally you should jump at the chance and stock up. Yes, that's the right mindset, so to speak, to apply here as well. Really imagine it like a supermarket, imagine it like an electronics store where you can buy things. And that's exactly how you should look at it when it comes to cryptocurrencies. With Bitcoin, always buy when it's cheap, always buy when there are discount offers, and don't buy when everything is pumping again. Otherwise, you'll be making mistake number one in this market, and the same applies to smaller time frames as well. In this case, it's illustrated here on a larger scale with Bitcoin. Of course, it's a bit easier to show it this way, but exactly the same behavior applies on an hourly basis, on a 10-minute basis with Bitcoin. Emotions of market participants also come into play there. Maybe not quite as strongly as on the higher time frames, but you can still take advantage of this behavior here, especially when the market makers flush out a lot of positions again. Everyone panics again, the general public is systematically washed out of the market, and for you to be on the right side, it's important to be psychologically prepared in order to understand these behavioral patterns of the majority. That's all for now. Now let's move on to point number 2, cognitive biases. Also quite relevant, because there are 7 of them that occur very, very frequently. Point number 1, hindsight bias, which is basically the tendency to believe in hindsight that an event was predictable. You see this quite often when you have certain chart patterns, or when, in hindsight, you think, wow, it was so obvious that Bitcoin would make this or that move, that Bitcoin would reach new highs again. But that's very, very, very dangerous, because then, in the present moment, you often assume again that it has to happen that way. Yes, that's exactly how it will be. And now, here in this fourth quarter, then comes the altcoin season or whatever else you always hear about. But you definitely have to be careful not to fall into this cognitive bias, because it could just as easily be that the exact opposite happens. Just like right now at this very moment, Bitcoin is pumping in the summer of 2025. How many people claimed, yes, there will be another summer slump and Bitcoin will bleed out and Bitcoin will drop back to 50,000 US dollars? I mean, the comments and opinions I've seen saying that somehow the bear market is starting now or whatever, or some even claimed, yes, it's not even possible for Bitcoin to reach new all-time highs in the summer. And what are we seeing now? Once again, Bitcoin is at a new all-time high. That's why you really have to be extremely careful not to get too confident here. Yes, that can also happen sometimes when you use a lot of indicators and then think, well, I have so much information, so it has to happen this way, and so much points to it. But at the end of the day, nothing is guaranteed. Yes, the exact opposite can also happen. At the end of the day, it's always just a game of probabilities. So much for point number 1. Point number 2, loss aversion. It's also important, I would say, to mention this again. This bias affects traders or investors who are afraid of taking losses and focus more on avoiding losses than actually making gains. And that's, I would say, also a typical and very well-known saying in English, scared money makes no money. This means fearful money will never make big money, never reach large capital. You have to take risks. That's one thing I want to say. And the other point is, losses are perceived much more intensely than gains. And it's also very, very often the case that losing a certain amount is much more painful than, for example, making that same amount back as profit. So here it's shown again, the perceived value from an emotional standpoint versus the objective change. So it's definitely important to be aware that for many traders, losses hurt more. In comparison, even when you execute the trade correctly, that's all for point number 2. Point number 3 is having too much self-confidence. Complete overconfidence is definitely self-explanatory as well. And this is especially true for many people who think they have some kind of insider information or have watched tons of YouTube videos and now believe that just because they've gathered information from hundreds of sources, they know exactly what's going to happen. But that's definitely a big trap, thinking that just because you have more knowledge or have spent hours researching something, it has to turn out that way. Yeah, so at the end of the day, nothing has to happen in the crypto market. Then we move on to point number 4, which is confirmation bias. This is very, very, very relevant, especially when it comes to investing. And honestly, it still happens to me from time to time, so I actually catch myself doing this every now and then. Often you invest in a certain altcoin, and what you do then is you look for any news about this project on Twitter. What's happening? What's going on? And you basically only look for positive things, which already confirms your investment. This means you don't look at things neutrally in advance and consider both sides, but instead you invest first and then afterwards search for lots of information about why this investment or trade has to turn out positive. For example, you open a long trade and then you keep staring at all sorts of liquidity heat maps, convincing yourself, yeah, Bitcoin has to go up and so on. So you basically keep talking yourself into it more and more, even though you've already placed your investment on the trade. And all of this has to happen beforehand. That's how you can avoid cognitive bias. Look at everything calmly and objectively, and then when you place the trade, when you make the investment, draw a line under it. So don't go looking for exactly the information that, let's say, benefits you or reinforces your position. Instead, you need to maintain a certain level of neutrality in that situation. And that's it for point number 4. This is definitely very, very common and also very, very dangerous. So be careful with that. Now, point number 5, the tendency to remain stuck in losing positions. This image really describes it perfectly. You're completely in the red, not doing anything anymore, just hoping, neither adding fresh capital nor, let's say, cutting the position, finally dropping the anchor and realizing the losses in this case. There are actually some people, some folks, who hold on to certain projects until the bitter end, or ride a trade all the way down to the absolute bottom, even to zero. And you definitely need to be careful about that. It's better to just draw a line under it. Either you're convinced and you add more capital, increase your position, expand the trade, or grow the investment, or you strictly cut ties with it. But you definitely shouldn't just stay stuck there, like that guy with the anchor on the boat. So be careful and make sure you keep checking yourself regularly. And you always have to ask yourself, with the capital I have invested in this trade, for example, would I do the same thing again right now with fresh capital? Yes or no? Ask yourself that question. If the answer is no, let it go. If it's yes, hold the position or even add more capital. But in any case, always be careful and evaluate yourself neutrally from a meta position. So always observe yourself and don't get too caught up in individual positions. Then, point number 6. The misconception that past events influence the probability of future events, such as the assumption that after a series of losses, a win becomes more likely. That's nonsense too. It's actually self-explanatory. Then we come to point number 7, which is herd behavior. This refers to the tendency to follow the actions of other traders instead of acting based on your own analysis and convictions, and especially in a bull market, getting too caught up in emotions, becoming too greedy, or focusing too much on individual trade positions and letting yourself be overly influenced. What is the majority doing? Because most of the time, or actually always yes, in the long run, the majority is always wrong. The majority always loses. If you look at the crypto market from a bird's eye view, it's always the case that the 10% who are profitable absorb 90% of the capital. And the majority always comes up empty, while those who are profitable practically take all the capital out of the market. That's always the case. And everyone is affected by thinking, yeah, but point 5 doesn't apply to me, or point 4, or whatever. That's simply wrong, because at the end of the day, we are all more or less affected by each of these points. That's why it's important to have heard about this, so that you are definitely aware and can always keep yourself in check. Now let's definitely continue with point number 3, emotions in trading. The most common emotions: greed, fear, hope, euphoria, frustration. Here you also have, I think everyone has seen this image before, where you get an overview of which emotion is present at which point, especially in a bull market. And as I said, everything that's shown here on a larger scale can also be applied in exactly the same way to smaller time frames. Now let's briefly go through each emotion so that you can always classify them for yourselves and understand the risks, for example, when you feel greed. Greed has a very, very big impact on your trading decisions. You will take on excessive risk. You won't have any diversification because, for example, you'll put everything on one card. You'll sell far too late. You'll probably trade way too much because you're greedy. You'll open 10 positions every day, want to buy every altcoin or whatever else. So definitely be careful about that. Or, for example, you ignore your own trading rules because you're caught up in the rush, because you're just so greedy in general. And of course, this also affects your overall performance. If you always want more performance and become even greedier, that usually leads to overtrading again, which in turn causes you to sell too late, and so on. So everything is interconnected, just so you've heard it before. Next, the topic of fear. Fear is, of course, also a very important topic, especially during phases when Bitcoin is crashing or when a trade is going in the wrong direction. A lot of people are way too hesitant. They miss out on entries because they're afraid and don't dare to take action. That's, I'd say, a major factor. But then, of course, poor risk management, FOMO, for example, fear of missing out. But we'll take a closer look at what that's all about later on. Yeah, at the end of the day, FOMO is actually pretty similar to, let's say, greed. You could theoretically have included it here as well, but it's also a form of fear, so to speak. Then point number 4, making decisions based on emotions. That applies to everyone anyway. Ignoring trading rules applies just as much to fear as it does to greed. And a lack of self-confidence is also an important point, when people don't dare to add more capital or buy more when prices are low. Yeah, you can definitely recall the previous image. Then, point number 3. Point 3, techniques for emotional control in trading. Also very, very important. What can you actually implement in practice so that you gain a certain level of emotional control and can also observe yourself while trading? First, create a clear trading plan. One thing I can tell you guys, an important tip from my personal experience, make sure you create a system for yourself. Trade with a system, with clear rules, yes, with clearly structured guidelines, because then you definitely won't be overwhelmed by your own emotions, and at the end of the day, you stick to this plan no matter what happens, no matter what comes up. So that's very, very important, and it's always worth it to set up a clear strategy. Maybe even do it together with ChatGPT, which is also a clear recommendation at this point. Ask ChatGPT, yes, give ChatGPT your data, how much you have to invest, what makes sense, and in that way, you can definitely work through a lot. It's definitely also very exciting nowadays to use artificial intelligence to simulate things, to work things out, so to speak. The more data you give ChatGPT about yourself, the more detailed it is, the more specifically ChatGPT can, for example, work something out for you. So that can definitely also be very helpful for getting an overview. Then, of course, at the end of the day, risk management is extremely, extremely important. Always think before every position, where is my stop loss? How am I protected? When do I want to exit the position again? Where is my take profit? It's extremely important to be aware of the risk in advance and not to act based on emotions or gut feeling, but instead to have a clear risk management plan. That's it for point 2. Then, keeping a trading journal can definitely help. You can do this either in paper form, in a notebook, or together with ChatGPT, yes. So again, here's the recommendation, the tip: work a lot with ChatGPT, make use of it. So, how were your emotions? Yes, keep a kind of trading journal, and this way you can also conduct some very, very good self-analyses so that you continuously improve yourself in this area, and of course, also take breaks. Here again, just as a side note, so to speak, to make sure you don't fall into overtrading. There are some people who are so enthusiastic that they want to sit in front of the chart all day and be productive the whole time, making 10 trades in a row, but that usually leads to overtrading. So just relax sometimes. Yes, and sometimes it's actually better to simply do nothing. That's also something I always say in my YouTube videos. Just relax, guys. Yeah, just calm down a bit. And that really is often the case, especially in the crypto market. Patience is key. Yeah, sometimes just do nothing. Just observe. You don't always have to be in the market with a position all the time. So that's definitely very important as well. I've put together a little checklist for you at this point. Everything is compiled again here in the PDF. You can always check everything off, so to speak. Yeah, it's definitely very exciting, very interesting, and very important. I put a lot of effort into compiling everything based on my experience. As I said, everything is completely free and linked here in my Trading Telegram group. You can definitely join in. If you have an account on Bitunix, as I mentioned, I've linked everything in the video description. You just need to send me your UID on Telegram, basically your account ID, and then you'll have permission to join this free trading group. There you'll have access to all the PDFs. You'll also find, in this case, the checklist for behavioral patterns in trading. Then, point number 5, the topic of self-reflection. It's also extremely important to recognize your own strengths and weaknesses and to develop your trading strategy based on those strengths and weaknesses. This will become especially relevant for you later on, because you'll need to be able to identify for yourself, okay, how much time do I have? How much capital do I have? Where are my strengths and weaknesses, etc. And based on that, the strategy will be developed later on. That's why self-reflection is absolutely essential, so that you keep yourself in check again and again. That's why the saying fits perfectly here. You are to blame, not the market. This shows a clear understanding of the problem, that you always take responsibility, especially in trading. Never put the blame on the market, even if it seems like it's not your fault. Yes, even if some bad news comes out and it really isn't your fault in that case. Sometimes it's just bad luck in the market. But still, take personal responsibility. Maybe you should have been even more mindful with your risk management. Maybe your stop loss should have been set a bit tighter or something else. So always take personal responsibility in those situations. That is absolutely essential if you really want to grow as a trader. Next, point 5.2, how to analyze and improve your trading performance. And it definitely makes sense to document everything either using ChatGPT or a trading journal. I've put together a few questions that you should keep asking yourself, especially in the beginning. In fact, especially with your very first trades, it's worth it to achieve rapid growth and improve quickly. Write down, when did you enter the trade? When was the position opened? When was it closed? Which coin did I trade? Then the trade size, how much capital did I use? Entry and exit prices, profit and loss, trading strategy, justification for the trade, why did you enter at all? What actually motivated you to take the position in the first place? Then emotions and psychological factors. Definitely check all these cognitive biases. Take another look at the PDFs at your leisure. There you can double check everything again, and at the end of the day, do a complete reflection and note your learning outcomes. Write down, what did you do wrong? What can you do better next time? Extremely important if you really want to grow in the long term. Of course, all of this always applies to both spot positions as well as leveraged futures positions. So how can you, let's say, measure your trading progress? A key metric here is definitely the win rate. The win rate indicates what percentage of your trades ended profitably. For example, out of 10 trades, you closed 6 with a profit and 4 at a loss. So that's what I would call an important metric. Then there's the average return per trade. This is extremely important because let me tell you one thing, the win rate doesn't even have to be positive. Theoretically, you could end up with 8 losing trades, but if the other 2 trades are profitable, they could make up for the losses from the other 8. At the end of the day, it's all a numbers game. For example, if the stop loss is set extremely tight, you can even afford to have a negative win rate and still trade profitably. That's why you always have to take all the tracking metrics into account so you can really get a complete overview, basically a comprehensive review of your results across all your trades. Then, the profit factor is the ratio of total profits to total losses. It indicates how profitable your trading strategy is overall. Next, the maximum drawdown. So what is the maximum you can lose per trade, so to speak? This is extremely important for risk management. We'll talk more about this later, including what can make sense in practice. Then, the Sharpe ratio is essentially the risk-adjusted return metric that evaluates the performance of a trading portfolio in relation to the risk taken. Of course, that's somewhat more difficult to assess, I would say. But here too, you can work with ChatGPT to get reference values. These are, I would say, the 5 most important ones you should definitely pay attention to. Now let's move on to section 5.4, how to adapt trading strategies to your own personality. I already touched on this briefly earlier, namely that you need to ask yourselves several questions, generally speaking. And this is extremely important, especially how much time do you have available? Are you even able to do day trading? Do you actually have the time to sit in front of the charts all day? Or is that not possible for you at all? Or maybe you only have time on the weekends to do day trading. Maybe you're using a combination strategy between day trading and swing trading. So you really need to position yourselves clearly here. You need to ask yourselves very clearly, what makes sense based on your personality? And accordingly, the trading strategy will be developed later on. Of course, there are certain universal principles. We'll talk about those later. What do I mean by that? We'll set up different categories for that. Category number 1, category number 2. Of course, I also have a general idea of how most people trade or what makes the most sense for the majority, but it still definitely makes sense to ask yourselves these questions. So that's all I'll say about that for now. But we'll go into more detail later about which strategies exist and which ones make sense for whom. Now we come to the last point, which is the topic of mindset. Of course, at the end of the day, you also have to approach this with the right mindset. You definitely won't get rich overnight. That should be obvious as well. You need patience, discipline, and realistic expectations. It's like a kind of apprenticeship. There too, or in your studies, you first have to study for 4 years before you actually get your degree. And it's exactly the same with trading. It takes 1, 2, or even 3 years before you become profitable, before you truly master the market to the point where you're better than 90% of the general public. But that is, let's say, the premise, or rather the goal you should aim for, to outperform the majority of market participants. And it takes time, even though this video course will provide you with the perfect tools. Still, you have to put in your own work. You have to learn to use the tools yourself. You have to keep at it yourself again and again so that anything can come of it at all. But I think at the end of the day, that's pretty clear. Still, I just wanted to point it out here briefly. As I said, having a long-term perspective is also important, especially when it comes to compound interest. Definitely be patient, especially with your own trading portfolio. And at this point, I have a small hypothetical example to show just how incredible 5% per month really is. Because everyone always talks about, yeah, a 10x here, a 5x there, and I want to double my Bitcoin position quickly. I've got 100% here, 500% there. But it's really important to show this calculation here. 5% per month. It doesn't sound like much, especially if you're a beginner. Of course, experienced traders know exactly how much 5% per month is, but just as an example, as a projection so you can understand it. 5% monthly with a starting capital of 5,000. And I'd say 5,000 is more than realistic. If you think about it, after 14 months you've already doubled your money, and after 10 years you'd theoretically have 1.7 million euros. So just imagine that for a moment. No external deposits, no cash flow, nothing at all, just 5% per month. You really have to keep that in mind. That's why you should definitely be patient and trust the process. That doesn't happen overnight. Definitely stick with it. As I said, of course, this is just a hypothetical calculation. In practice, of course, things look quite different. But as I said, this is purely a thought experiment to show you that you shouldn't be fooled by people who claim, yeah, I make 50% every month and so on. It's just bullshit, because otherwise these people would have been multi-millionaires long ago if they were really able to do that over several months or years. So I just want to point that out. Of course, I have to say that things are a bit different in the crypto market, because in the crypto market you can, of course, trade the bull market. You can trade the bear market, and of course that's a bit different. There are sometimes phases where you actually make 50 or even 100% in a month. Yes, that's really possible, I would say, in the crypto market. But there are also phases where you really get burned and you will never end every month in the positive. There will be months when you'll be in the negative as well. That's why, as I said, it's just a theoretical calculation. In practice, of course, things look very different, but I still just want to show you that it's important to keep in mind what, let's say, a reference value is, what you can aim for, so that at least you've heard about it. Otherwise, self-motivation in trading, set clear goals for yourselves, and celebrate even small successes. You don't always have to compare yourselves to the big YouTubers who somehow have several $100,000 in a single trade. And of course, the last point, exchange ideas with other traders. That can definitely help a lot as well. I'm definitely extremely active in my groups and in my community. So feel free to join the free trading Telegram group. Everything is linked in the video description. You'll definitely be in good hands there. We can easily exchange ideas there. We can discuss things among ourselves and also show, let's say, which positions currently make sense. It's definitely worth it. And just to quickly summarize, as I said, it's very, very important to take this chapter seriously, to stay on track, to keep reflecting on yourself, and to learn from your own mistakes. Yes, because otherwise you will never be successful in the crypto market if you can't, let's say, analyze yourself, constantly check yourself, build a certain neutrality towards yourself, and be able to observe yourself from a kind of meta position, a bird's eye view. That is extremely important for trading in order to become successful at all. That's all for this chapter. I definitely hope you enjoyed it. As I said, I tried to keep it brief because I know it's a rather dry topic, but it was still important to me to cover everything. As mentioned, you can find all the PDFs in the groups, and otherwise, we'll now continue with the next chapter. Alright folks, we're definitely continuing with chapter number 7, Trading Styles and Strategies. An extremely important, relevant, and also practical chapter. So I've prepared quite a bit. We'll actually put everything into practice depending on the trading style and strategy. I'll show you exactly which trading strategies I've set up. All of them have been tested by me. So you can definitely look forward to a lot. There will definitely be something for each of you. It's definitely worth sticking around for this. First of all, congratulations on making it through chapter 6. That one was definitely much drier and more theoretical. Now things are going to get much more practical. We'll take a look at what trading styles are out there. We'll look at scalping, including specific scalping strategies, day trading, swing trading, position trading, and later on, some very concrete setups. We'll also jump right into the charts for that. But now, let's start right away with slide number 1. It's extremely important that every trader, or more generally every investor, ask themselves, what actually suits me? What type of personality am I? We'll get to the specific questions in a moment, but it's really crucial to find your own path, not just any path. That's a very important and fundamental point because I see very often out there that many people claim to have the ultimate trading strategy, or that this or that trading strategy is the best, or something like that. But you really have to be careful not to just copy something from someone else, but instead to adapt your own strategy based on your own personality and what you personally bring to the table. So this is very, very relevant, and we'll talk about how you can actually implement all of this in just a moment. Of course, I'll also show you later on how I personally approach things and what my strategy is. You can definitely draw inspiration from me. Of course, you don't have to copy it one-to-one, but you'll definitely see what, let's say, could make sense. You can definitely also combine several trading styles later on so that you have a kind of combination model. We'll talk about that in just a moment. But yes, it's important to understand that most traders don't necessarily lose because they don't know enough. In fact, many actually have relatively good knowledge, but they don't have their own system. Yes, without your own system, there's no repeatability, and without repeatability, there's no profit. It's extremely important to know that you really need a clear strategy that's tailored to your own personality. For example, a scalper needs completely different tools and nerves than a swing trader. And of course, the same goes the other way around. If you don't know your own style, you'll constantly switch strategies, lose confidence, and that's the biggest killer for a profitable trader, or in general, for a profitable investor in the crypto market. And that's why we're going to take a closer look at this now. First, we'll get an overview of what's out there, and then later we'll look at what makes sense for whom. And first of all, it's important to distinguish what is actually out there. We'll start with scalping and then work our way up step by step to the higher time frames. Yes, so everything that's lower down is, let's say, more long-term. Scalping is therefore the smallest time frame trading method. Most of the time, this is done on a time frame or time unit of 1 to 5 minutes. So you often make a lot of very, very quick trades there. The focus is on microstructure, news volatility, and breakouts. And you can really execute several trades in a very short period of time. It has clear advantages, but also clear disadvantages. We'll talk about that in a moment. Then there's day trading. Most of you have probably heard of it before. This usually involves a time frame from 5 minutes up to 1 hour. That typically means 2 to 5 trades per day, also with clear trading sessions. Even though you have to keep in mind that the crypto market is open 24/7, there are still specific times when the crypto market experiences increased volatility. For example, during the New York session, when more liquidity comes in, you can definitely take advantage of the increased volatility, or when news is released, etc. We'll talk about specific examples of this later on. Otherwise, swing trading is very relaxed. Yes, that's usually more on a 4-hour to daily basis. There are only a few trades per week. You have more structure and more peace of mind. Yes, those are usually retests or in general market phases where you have a clear uptrend or downtrend. Otherwise, position trading actually already moves towards spot trading. Yes, you could even lump that together with spot positions because I claim, especially in the crypto market, or at least in my experience, you have at most a leverage of 2 to 3 because these are really positions where you can basically ride out the entire cycle. That's, I would say, the very big advantage of the crypto market, that you can also do cycle-based trading. You have clear bull markets and accordingly clear bear markets, so you can actually scale up individual trades over several months sometimes and keep taking profits along the way. You can almost consider it a dynamic spot position, similar to a regular investment in Bitcoin. But for example, you might use 2x or maybe 3x leverage, and then you can gradually take profits or, for instance, add more margin. So there are several options available. You're a bit more flexible, a bit more dynamic compared to simply buying and holding Bitcoin. It has clear advantages, but of course also some minor disadvantages. You have to pay a bit more attention to it, but you can definitely get a lot out of it, and it's especially exciting in the crypto market. We'll talk more about that later, especially regarding the cycle theory, etc. As I said, this is more of a long-term approach, with very few trades, very macro-based, and in the case of crypto, also very, very cycle-based. Here again, as mentioned, is everything in an overview. Now let's take another look at the different types, so to speak, in the overall overview. There are very clear advantages, I would say, between scalping, day trading, swing trading, and position trading. I think at the end of the day, the advantages of the right column are pretty obvious. You need fewer trades, and accordingly you spend less time. You don't have to worry about it as much because, for example, with swing trading, you only make a few trades per week. You look at, okay, where is the overarching structure? Where might there be a liquidity sweep or something like that? And then you can calmly set it up in advance. You then have the trade open for several days, a long time. That's clearly the advantage here. The downside, of course, is that you have relatively few trades. Especially if you're a beginner, in my opinion, it's better if you have a somewhat higher volume. At the end of the day, it's just like with any other skill. A beginner who, let's say, makes 50 trades a day. And as I said, this doesn't have to be with real capital or anything like that. You can also start out very slowly with little capital using a demo account. But the one who executes more trades will also grow faster, will definitely make better progress in training, and therefore generally has a higher volume in trading. And that's, I'd say, the big advantage at the beginning, that you can try out a lot of things. So you can test out a trading strategy here, try out another one there. Of course, sooner or later, you definitely have to commit to one. The downside here, on the other hand, is definitely that it's much more time consuming. You really have to be in front of the chart for this. I'd say with day trading, it's still manageable. If you have a setup there, it's enough to check it a few times a day. But still, it definitely requires significantly more time investment here. Now let's talk a bit about myself personally. How do I approach things? Because I use a kind of combination strategy. So I basically use several things simply because I also bring experience to the table. Back during the pandemic, or rather during the pandemic period, I basically had the whole day to sit in front of the charts, and that's why I did a lot of scalping, a lot of day trading, and as a result, I gained an incredible amount of experience here, especially in the beginning. It was also, I would say, the big leverage, the major advantage for me personally, that I made a lot of trades in a very, very short period of time and grew very quickly, which allowed me to gain a lot of experience in a very short time. That, I would say, was the big advantage here. Now my daily schedule is much more packed. That's why I no longer necessarily have the time to sit in front of the charts for 5 to 12 hours every day, and that's why I'm currently doing a bit more swing trading. Occasionally, when some news comes in, I also do news trading, or rather, I don't actually trade the news itself. Just as an example, Trump posts something negative again. The market crashes. Yeah, in that case, I don't actually trade the news itself and just go short. Instead, what I do is, after the news, once the spike down has happened, I wait for a reversal, for example, a W pattern, and then I basically enter a long position again. That's the kind of thing I do as active scalping. It really depends, so that's how I sometimes do it. If I really have a clear time slot, like a specific block of time where I can say, hey, for example, Saturday afternoon, I have 4 hours to really focus on trading, then I do some scalping as well, especially when there's more volatility. That's definitely my approach, I would say. I always do position trading, no matter what, because first, I have my spot portfolio, and second, I keep a lot of low leverage positions open throughout the bull run. A 2x or 3x leverage on Bitcoin, for example, or also on Ethereum. That's pretty relaxed anyway, and basically anyone can do that. Yeah, that's always an option, I would say. Swing trading is also quite possible, especially, I would say, in the liquidity zones. With both of these, you definitely need to be aware that it takes a bit more time. But later on, we'll talk very specifically about trading strategies, both in scalping and day trading, because especially in the beginning, you can make the fastest progress here. And especially if, for example, you have a regular job, you can take some time on the weekend to scalp on Saturdays, Sundays, or maybe in the evenings after work. But otherwise, you have your swing positions open in parallel, or your regular spot portfolio as well. So I would say that's the best combination. On one hand, you learn very, very quickly, and on the other hand, you have the advantage of being able to take structurally longer term trades as well. So that's definitely, I would say, my approach at the current time as well. It's very, very important to understand that. Now, let's move on to the next slide. Here, you can ask yourselves these questions. You can theoretically work all of this out in even more detail together with ChatGPT. Write it down or record it as a voice message. Yes, using ChatGPT is definitely a little tip from my side, and with that you can relatively quickly, I would say, figure out what suits you. Are you more of a scalper, more of a day trader, or do you really have no time at all and prefer position trading or swing trading? Yes, that's pretty much all there is to say about that. And here's another important key point. Trading is like clothing. It doesn't have to look spectacular, it has to fit you. It's extremely important not to fall into the trap of suddenly, I don't know, getting tangled up in scalping when you don't have the time and you're trying to do it somehow alongside your job, trying to fit it in somehow. That doesn't make any sense. So if you really are scalping, then be in front of the chart and focus on trading, on what you're doing. Otherwise, it's better to leave it, because if you end up making too many trades, the whole thing can definitely backfire. That's why you really need to think carefully about what suits you. Now let's start first of all with the scalping strategies. All the scalping strategies that I've prepared for you here have also been tested and reviewed by me. Of course, there's no guarantee of definite profits, but I can still tell you that some of these scalping strategies have worked very well. In particular, the last and third scalping strategy is especially effective for me personally, because you can really execute quite a few trades with it, and it works extremely well together with the Bollinger Bands. So it's definitely worth sticking with it and trying out these 3 scalping strategies. We're now starting with the very first one, namely the EMA cross RSI trigger, based on a 1 to 5 minute time frame. I'll explain everything to you here step by step, calmly showing you how to implement everything on the chart. That's exactly what Chapter 7 is for, to give you a comprehensive insight into what it all really looks like in practice. Because in theory, everything sounds pretty good, but later I also want to clearly show how to set up all the indicators. What does it all actually look like on the chart later on? So we'll definitely be talking about that in just a moment. Now, just a quick explanation. What is this strategy all about? How does the strategy work? In short, the EMA tells us what is happening. The EMA is basically the signal generator. Are we going long? Are we going short? And the RSI is the safeguard. So the RSI tells you whether it's enough to enter a trade. And that's why we basically have a duo set up here. We've included 2 EMAs in total, so we keep getting EMA crosses. If you're now wondering what an EMA is, what an RSI is, then definitely take another look at the indicators chapter at your leisure. This definitely builds on that here. That's why I said at the beginning of this video course, watch everything calmly, step by step from A to Z, because then you won't have any problems. There's a reason why this course is structured the way it is, because everything builds on each other piece by piece. So here we're now bringing everything together, so to speak. We're looking at everything on a 1 to 5 minute basis. We have one EMA set to a period length of 9, then the other EMA is set to a period length of 21, plus the standard RSI set to 14. Then we basically have the indicator for both long and short positions depending on the crossover, plus the RSI acts as confirmation. If the RSI is above 55, only then are we allowed to enter a long position, and in the case of a short, the RSI must be below 45. This way, we avoid trading any fake outs, false signals, or anything like that. This confirmation using the RSI definitely increases the hit rate significantly based on experience. So you are definitely right more often when you have a clear confirmation, because trading only with the EMS can sometimes be a bit risky. Sometimes, as you'll see later on the chart, they only cross very briefly and then immediately go in the other direction, which can definitely end badly. That's why we absolutely need the confirmation from the RSI. What is it? The topic concerns stop loss and take profit. Let's take a closer look at it now on the chart, completely live. If you want the slides, they're also a nice way to check your work. You can always refer to them to make sure you've set everything up correctly. As I said, I've linked everything completely for free in my Telegram group. For everyone who has an account on Bitunix, you'll definitely get access to all these slides. Now we've definitely arrived here in the chart. I recommend that you always implement everything directly within the trading exchange. In the case of Bitunix, we have the huge advantage that TradingView is fully integrated here, because especially when scalping, you definitely need to be fast. And if you don't necessarily have 2 or 3 monitors available, it definitely makes sense to do everything within the interface, because here we have the ability to set up all the technical indicators directly. So you can immediately see, okay, hey, what's going on? And then you can also execute the position right away. It definitely makes sense to do it this way. As I said, everything is linked in the video description. There you'll find the link to Bitunix, so you can create an account and then implement the trading strategy here. We'll start with the technical indicators. As mentioned earlier, we definitely need the EMA twice. In this case, it will be shown to you here as exponential moving average. We click on it once, and then we click on it again right away. And now we have the EMA added twice here. Now it's extremely important that we configure this EMA. To do that, go to the top left, click on the gear icon for settings, and then you can set the length here. The first one stays as it is. In this case, length 9, everything is fine. And the other one, we set to length 21, so that we get clear crossover signals here. Click on OK here, and then you can already see how both EMAs are active. At this point, I would definitely recommend that you click on the gear icon again and change the visibility, or under style, you can also change the color. It definitely makes sense, maybe set it to white in this case. That way you get a nice contrast. You can also theoretically increase the thickness of all these lines here, so you can see all the charts even better and more clearly. In this case, increase the thickness of the line again, make it a bit thicker. And then you can see very clearly here how the individual crossovers occur. And now, just as a very brief explanation, we actually have a perfect live example of what just happened here. And this is exactly what I was talking about. It happens quite often that there are individual fakeouts. You can see here from time to time that these lines briefly cross each other. This is basically called noise, a kind of disturbance that should not be interpreted as a trade. Otherwise, you would go short here, even though, as I said, the long position comes in right away. And that's why we also have the RSI as a safeguard. We can also add it here directly by searching for this RSI, the Relative Strength Index. And then everything is set up right away, and the RSI tells us whether we are even allowed to enter the trade. This way we only trade when there is good and positive momentum and not just any noise, so that we don't end up falling into a trap and trading this minor crossover when there is actually no momentum. That's, so to speak, the whole point of this trading strategy. Now let's jump right in live and take a look at how all of this looks in practice. Also, just a quick tip at this point. Later on, within Bitunix, you can configure everything exactly the way you want it. For example, you could make the order book smaller, and in this case, make the chart larger. That way, you get a better overview, and everything is displayed more clearly. Just so you know, you can move and adjust everything as you like later on. That's the big advantage in this case. You can also make it a bit larger. In this case, you'll have a better overview for the video as well. It definitely makes sense, especially if you're executing trades here, so to speak. You can use the order book, which can definitely be helpful for scalping, but for this video, I don't really need it. Now let's get started with the trading strategy. As I said, what do we have here? Now for the explanation, we clearly have repeated crossovers of the two IMAs. In this case, blue crosses white. That means we've received a clear short signal here. Theoretically, we could have entered a short position here, but as mentioned, we're using the RSI as a safeguard. What does our rulebook say? The RSI, I've got it open here on the left side. The RSI must be below 45 for a short position. That's why, in this case, we don't immediately enter the short position, but first check, where is the RSI? In this case, it wasn't below 45, so we didn't go short here yet. We only go short once the RSI drops below 45 from that point on, and then the short position can be opened. Of course, there are cases where you could have opened the short position just based on the EMA crossover alone. Sometimes you end up in a better position this way, but one thing I can tell you, to increase your hit rate, it always makes sense to work with safeguards, and it always makes sense to include the RSI. That's why you should always double check at this point. Where is the RSI at? Likewise, conversely, we can take a look. Here, a perfect crossover has just occurred again from blue to white. In other words, the 9-period EMA crosses above the 21-period EMA. And what do we have here? We have a very clear long signal here. We can look at the RSI. We're sitting at 59 here. That's why a long position would have been opened here right away, and we can clearly see that this would have worked out very, very, very well. We could have easily taken 1 or 2% profit here right away. Depending on the leverage, of course, that could mean 10%, 20, 50, or even 100%, depending on how you set the leverage. We'll talk about that in a moment. As I said, I'll also give you live examples here. So guys, we can definitely see the next cross on Ethereum. That's why you have to act pretty quickly here again. We're going in with $200. Take profit, stop loss, again right here in this case. Changes in percent, changes in percent. And then we can set the take profit here at 0.6, and in this case the stop loss at 0.2. We're actually already a little bit late because the cross already happened. That's why, in this case, you can also wait a moment to get a slightly better price. So that's fine too, but in principle, the signal for the long position has now come in. That's why we can wait a moment to see if we can get in at a slightly better price, because the trend itself is there, and that's why we're entering the long position now and taking a look at what happens here. The cross definitely took place. Momentum is present here with Ethereum, so we'll wait a moment here as well, and we'll see you again in a bit. Alright guys, that worked out really, really well. Ethereum moved exactly into the target area, just as we wanted. All in all, we entered with $200 and in this case, made a nice $57 in just a few minutes. Everything worked out very well this time with Ethereum. Unfortunately, I'm not sitting in front of the monitor, sorry about that. I just went downstairs for a moment, really just to grab something to drink, and in this case, the position opened immediately. I had to wait about 20 minutes this time, but everything worked out perfectly. That's it for Ethereum. Here's a quick check. You can definitely see where we entered our position. Here we had the crossover, so just a quick summary of this trade. In this case, we entered the long position here on the 1-minute chart. The RSI was also nicely above the 55 level. That means it was definitely legitimate to take the long position. In this case, the trend is actually quite strong. We're even starting to overheat a bit in the RSI now. So yes, in this case, both lines are now quite far apart as well. As a quick note, in this case, if we take another look at our trading setup here, we can review how the rules are set up. In this case, take profit number 1 is at 0.4 or optionally take profit at 0.8. So what did we do in this case? Now in our case, we set a take profit at 0.6, but only 1 in this instance. Yes, as I said, you always have to check, what is the market doing? How volatile is it? What leverage are you using? In my case, 1 take profit was enough. Theoretically, I could have split it into 2 take profits at 0.4 or 0.8. So at the end of the day, it's always up to you. Feel free to experiment with it. Like I did in this case, always set a take profit and a stop loss. Sometimes it's just more comfortable to trade that way. but if the trend is really, really strong, you can definitely work with 2 take profits, just so you're aware of that. Now let's continue taking a look at the Ethereum chart. We might find some more setups with other coins. Of course, this works just the same with Bitcoin, Solana, XLP, Dogecoin, SUI, and so on. So I'll definitely check in a moment to see if we can catch 1 or 2 more setups here. Alright guys, let's keep going. I'm slowly but surely spotting a bearish cross on Solana. This could get very interesting. That's why we're going to prepare everything here in this case. The position should be $200 in size. Again, in this case, so you can see everything regardless of my face cam. As a recommendation, always enter everything not as price USDT, but when you're setting stop loss or take profit, always use percentage change. That way, you can directly input everything according to the rules of your specific trading strategy. So in this case, I'm going with 0.6 again here for the take profit. This way, we have the opportunity to earn $67 US. And in this case, with Mr. Block, I want 0.2. Then we have a risk-reward ratio of 1 to 3, in this case for this short position. As I said, I'm just waiting a moment for confirmation. I really want to enter the position for good now, so to speak, and now the signal has arrived. This means the short position is now official. We've received a cross, plus the RSI is below 45. So, we have a clear confirmation for the short position here. Now let's wait and see. As I said, in this case, I've set the stop loss very, very tight. Simply because, in my view, there's a clear trend reversal here. We've received the signal, and now we just have to wait. We'll be back in a moment. Alright guys, we've definitely received our next signal. We've got a bearish cross this time, in the case of Bitcoin. Now we can go ahead and set everything up right here. We want to go for $200 US. In this case, we've set the stop loss again as well. Change in percent, 0.6 and 0.2. The risk-reward ratio is basically 1 to 3. Everything looks very clean here. In this case, we've moved up slightly. To be honest with you, I missed it by just a little bit. But in this case, the RSI has dropped again to below 45. That's why the position is opened here. What we can see, guys, is that the next trade position can be opened, and with SUI, we've also just gotten a cross here. That's why, in this case, we can also prepare the position here. In this case, the leverage will also be increased. As I said, you don't always have to catch everything perfectly, so to speak, in the moment, but especially when scalping, you should definitely be quick so that you don't end up with a really bad position or a really bad entry afterwards. That's why we're also setting take profit here at 0.6, and here as well, the stop loss is at 0.2. Then, in this case, we can also open the short position here. That means we've done everything we can here as well. In my opinion, there's now a clear downtrend here, because we've just had the cross, and with that, we'll see each other again in a few minutes. Alright guys, we're back with Ethereum. As you know, we nicely took the long position here from this level upwards. Now, in this case, a clear trend reversal is taking place. We can clearly see that, slowly but surely, both IMAs are crossing again. The RSI is also cooling off. Definitely a very good sign. That's why we can now set it at cost price here to open the next short position. In this case, again, set the take profit and stop loss at the respective levels. Changes in percent, again here, changes in percent, and then we can set the take profit at 0.6, just like we did earlier. That way we can potentially catch the short here as well. We'll set the stop loss at 0.2 in this case, giving us a risk-reward ratio of 1 to 3. Now it's definitely getting very interesting because the cross is slowly but surely coming in, and if it gets confirmed, we can definitely open the next short position here. Let's wait and see. By the way, it doesn't really matter whether you have it set to cross or isolated. As long as you're using stop loss orders, it's secondary, but just as a quick tip, always use isolated mode so you're protected in case you ever forget to set the stop loss or something similar. But otherwise, as I said, if you have the stop loss in place, then it doesn't really matter because you're protected either way. Now we have to wait and see whether the trend will continue, whether we've just hit a small interim low here, or whether the short can continue to be executed. We'll just wait and see. I'll keep you updated. Alright guys, a quick trade update. It's looking very, very good for the short position. In this case, let's zoom in to see when our cross happens. The RSI is definitely ready. Now I'm just waiting for the final signal from our EMA, and then in this case, we can also open the short position. Yeah, I'm always pretty strict. Theoretically, you could already go short now, but sometimes there are little fake outs. Okay, the cross has come in. In this case, the position was opened immediately. Yes, now things can move quickly in such a situation, especially after strong highs have just been reached here. The position is open. In any case, we're waiting to see whether the short will be executed right away in this case. And I'll definitely keep you updated on how things look in a few minutes. So guys, a quick update on our XRP short, which we can go ahead and do right now. It's looking very, very good. In this case, our short position on Solana has worked out. Now, our next short position on XRP will probably work out as well. At this point, we can also move the stop loss into profit. There you go. The XRP short was also taken right away. Things are really looking fantastic at the moment. So guys, a quick update on our Ethereum short position. We can see it beautifully here. And just to explain briefly, we can clearly see that the trend has been broken. We were clearly rejected here at the 9 EMA, in this case on the 1 minute chart, and we're already nicely in profit. Now we're just waiting for our take profit to be reached. Everything looks very good at the moment. By the way, I also have a Bitcoin short position open at the same time. That's also going very well right now. So in this case, I'm now opening several positions in parallel because we've basically received multiple signals, both for Ethereum and for Bitcoin. So theoretically, you could do the same later on, trading several altcoins or multiple currencies depending on the situation. Of course, you have to be careful. At the end of the day, everything is interconnected. So if Bitcoin crashes, usually Ethereum crashes as well, depending on which market phase you're in. Except, of course, there are some rare cases where Ethereum completely breaks away. Like right now, Ethereum is a bit stronger than Bitcoin, but the market is still correlated overall. That's why you shouldn't necessarily open 10 positions at the same time in 10 different altcoins. I wouldn't recommend that either. But what is fine is trading the big ones. Ethereum, Bitcoin, Solana, XRP, SUI, Dogecoin is also still okay, especially with the larger positions. But the smaller it gets, the more careful I would be, especially with scalping, because it doesn't do you any good to trade a tiny altcoin that's dependent on Ethereum anyway. In that case, you'd be better off just trading Ethereum directly instead of, I don't know, trading some tiny altcoin with a market cap of 200 million. So that's definitely my recommendation as well. Now, in any case, we're going to wait here for a bit. It looks very good because, as I said, we've gotten a clear cross here. We've received a clear confirmation from our RSI. What could also happen now is that something like this occurs here, and in that case, the downtrend would continue. That's how things look at the moment. If the downtrend continues here as well, we will definitely take out this low. However, it could also end up being a liquidity sweep, where we briefly dip in here, and then a counter move is initiated. If that's the case, which is quite possible, then it's also likely that we could get some long positions coming in afterwards. But just to explain again briefly, the take profit in this case is perfectly placed, because especially with Bitcoin and Ethereum, it's often the case that there's a quick liquidation, the low gets swept, and then either a counter move happens or even a new low is reached. And that's why in this case we're definitely positioned correctly right now with our take profit. We just need to be a little patient now, and then we'll see each other in a moment. Alright guys, a few minutes later, and with Ethereum, we're live. Our position has definitely been closed successfully. The next position has basically just been taken out. So here, you can really see how well the strategy works. We went long here perfectly at our crossover. We got confirmation from our RSI, and in this case, beautifully caught the short position. Exactly at this crossover, we hit our take profit again here. So really, truly beautiful. We can also take another look at the order history here, so you can get a sense of how many trades you can actually execute. We can see here that we also successfully took the Solana short position, where we were able to make $74. Similarly, with the XRP short, we were able to take $19 at 7:01 p.m. And there we also got a bearish crossover, which allowed us to make $46 in that case. And now here, in the case of Ethereum, we were also able to take the short position, making $60 in this case. So this gives you a rough idea of how many trades you can execute on the 1 minute chart, so you definitely have a reference point there. As I said, you can do this every 15 to 30 minutes, depending. So it really depends on the scalping strategy. It depends on the time frame and the volatility. Now, in this case with Ethereum, things are looking pretty good again, and now you just have to wait. And this is exactly what I mentioned earlier, that liquidity was fished out here. And now there are two possibilities. On the one hand, Ethereum could continue to be sold off upwards. Then theoretically, you would have to wait a bit longer until the turnaround happens again. But it could also theoretically be the case that liquidity was just briefly skimmed off here before the last interim low, so to speak, and that we might even get a bullish cross again soon, and you can play this game 10 times in a row. You can see it here as well. It's beautiful. Here again, we would have long positions and short-term short positions. And of course, I want to say one thing about this. It doesn't always work. Sometimes you also get fake outs. Sometimes the trend isn't actually confirmed, yes, but as long as you have a reasonably positive hit rate here. And you have to keep one thing in mind. In this case, we're working with a risk-reward ratio of 1 to 3. This means that even if you have a losing trade, it's not nearly as bad, because in this case, we make back 3 times as much when we have a profitable trade. And as I said, it's extremely important to keep in mind that it's not even a big deal if half of your trades go wrong, even if half of them end up negative. At the end of the day, you'll still be nicely in profit because, as mentioned, you're always trading with a positive edge. So just to wrap things up here once more, that's basically it for now. I could theoretically open the next long position here again. Yes, so you could really play this game all day long if you have the necessary time for it. In theory, the next position could even be opened here if, for example, the next crossover happens. But for me, that's enough for now. So I'd like to wrap things up here with scalping strategy number 1, specifically 7.4.1. Now you've definitely gotten a wonderful insight As I said, all the PDFs are available in my free Telegram group if you have an account on Bitunix. But as you can see, it works absolutely beautifully on Bitunix. Simply because here, by the way, here's another little tip for you. You can set up these indicators, in this case the scalping strategy with all its parameters, and then you can click through all the setups directly here and observe everything beautifully. Now, in the case of XRP, we're even about to get our next long signal, and then you can quickly check everything between Solana, SUI, Dogecoin, XRP, basically the bigger ones. That way you have a great overview and can basically trade or scalp through all the major altcoins, all the major cryptocurrencies. It's definitely very, very convenient that the parameters are adopted one-to-one, so you'll always be in the know. That's all for that part. Now let's move on to section 7.4.2, the next scalping strategy. Alright guys, I'm definitely really excited. We're continuing with the second scalping strategy, which is actually one of my favorites and one I've used a lot for scalping because it really creates a lot of trading opportunities. Yes, I'll say a few words about that in a moment. What you need to watch out for, the advantages of this scalping strategy, but also the disadvantages and the risks. So I really want to address both sides here, specifically 7.4.2, which is scalping strategy number 2, reversal scalping, Bollinger Band snapback with RSI confirmation, countering with structure. I'll explain in detail in a moment what it looks like and what it's all about. Most of the time, it's on the 1-minute chart, but theoretically, it also works on the 3-minute or 5-minute chart. What we definitely use are the Bollinger Bands. The Bollinger Bands are set to the standard settings, 20 and 2. We'll talk about what exactly that means in a moment. We leave the RSI at the default of 14 for confirmation, which is basically the core of the strategy. The Bollinger Bands show the boundary, and the RSI tells you whether it's going to break. So in practice, the RSI serves as the confirmation in this case. Otherwise, for the RSI conditions, we have below 30 for long positions, basically oversold, so that's when we enter long positions, and above 70 for short positions, meaning when we enter the overheated area. It's very important to mention there are several possibilities here. So you shouldn't get completely fixated on 70 and 30. Depending on market volatility, it's also fine to adjust these levels downward. One thing you need to keep in mind, the RSI later serves as a safeguard, and depending on how you use this safeguard, potential trading opportunities can arise as well. And that's, I would say, also a practical tip, or rather an insight from my own experience. What you can do, for example, if your hit rate suffers, or if you have too many fake outs, is that you can theoretically lower the value here to 25 and, for example, 75. What then happens in the case of the RSI is that you get fewer trade signals, but usually the hit rate is a bit higher. And here, it's always important to find the golden middle ground, because at the end of the day, you don't want to be sitting in front of the chart all day either. Maybe you take the time on a weekend to really sit in front of the chart for 4 or 5 hours, and then you also want to execute trades. And if the values here are too low, for example 20 in an extreme case, or even 80 in this case, then you won't find very many trades. Then later on it will also be very, very difficult to find any entries at all, and that's why I've had good experiences with 70 to 30. That's also, I would say, the standard parameter for the RSI. Yes, and of course you can also make adjustments accordingly. But at this point, I don't want to go too much into detail regarding the theory. I want to dive straight into the practical side, because that's where I can share a lot more from my own experience. So let's jump straight over to Bitunix and take a look at the whole setup. As I said, you can set everything up here at the top. I can quickly show you how to do it as well. Just go up here to Technical Indicators, search for the regular Bollinger Bands. You set them up here, and for a quick check, you can click on the gear icon, and you'll see that the default settings are applied. 20 to 2. Of course, there are other options available. We'll talk about those in a moment. In theory, you can also increase the value here. As I said, this will change some parameters of the trading strategy, for example, to 25. Then you'll see that the individual Bollinger Bands become a bit wider. I can also give you a quick extreme example here. For example, if I enter 50 here, you'll notice that the Bollinger Bands will shift significantly. But I can tell you from experience that beyond a certain value, it just doesn't make sense anymore. That's why it's best to simply use the default setting in this case. You can always double check that, 20 to 2. Then everything will definitely be correct. As I said, we're now on the 1-minute chart. What we're going to do in addition, we're going to select the RSI, the Relative Strength Index. As mentioned, if you still have questions or don't fully understand, make sure to review the indicators chapter in more detail. That's the complete setup in any case. And what we're going to do now regarding the trading strategy, we're going to zoom in on the Bollinger Bands and take a live look at the current Bitcoin chart, and we can see where we would have potentially received signals. Here, I can immediately spot one. As soon as a candle closes, meaning the body of the candle closes, above the Bollinger Bands or below them, of course it applies to both, then we enter long or short positions accordingly. In this case, the main indicator is essentially the Bollinger Bands. So that's the very first thing we look at, and here we can see, okay, the candle close is happening outside the Bollinger Bands. That would definitely be an important indicator. Okay, at this point, I want to enter a long position. This is, let's say, reference point number 1. But now it becomes extremely important that we don't get any fake outs. because there are also occasional fake signals. For example, we can dive right into this example. Here, we also briefly moved outside the Bollinger Bands. But it's extremely important to use the RSI as a reliable safeguard so that we basically have the signal provider here from the Bollinger Bands. But the safeguard is the RSI, and that's why it's extremely important to look at this. What value do we have on the RSI? And only when we are structurally in the oversold condition here do we actually enter the long position. And in this case, that would have only happened here. This way you protect yourself from opening positions too early. And as I said, it's extremely important to always get confirmation from the RSI, just like here as well. Yes, in this case, I wouldn't have opened a long position here yet. Why? Because strictly speaking, the RSI was still at 69 here, and only when both conditions were met, when the candle closed here above the Bollinger Band and the RSI was truly overbought above 70, only from this point would I have entered a short position. I can give you an example of that. As I said, we'll be moving into live trading in a moment, but in that case I would have entered a short position, and you always have to check how volatile the market currently is and what makes sense. Of course, you can work with a tighter margin, like 0.1, but you always have to keep in mind, it's never really about the percentages themselves. It's always about the risk-reward ratio, so that we simply work positively, always aiming for at least a 1-to-2 ratio. That's extremely important. Just now I accidentally selected the wrong option. So logically, we need to select short positions here, and then we can take a look at the whole thing. We set the stop loss here, and the take profit below. And as I said, it's extremely important to have a risk-reward ratio of at least 1-to-2. Otherwise, it will definitely be quite difficult in the future, because then your hit rate would have to be significantly higher just to trade profitably at all. That's why we see here, in this case, the trade would have worked out. For example, here it's 0.1 to 0.2%. In this case, on the 1-minute chart. Of course, you always have to pay attention yourself and consider what makes sense. You can always use reference values from the past for this. So, if I just look at the whole thing as an extreme example, normally, as I said, scalping strategies are used on the 1-minute chart, 3-minute chart, or 5-minute chart. Now, just as an example from the 15-minute chart, because obviously things work a bit differently there. If I take a look at the entire structure here, you would need to allow for a bit more leeway. So for example, a short position here, just as an example. As I said, the RSI would be invalid in this case, but still, you would need to work with, say, 0.5% and 2%, for example. Yes, so the higher the time frame, the higher, of course, the percentages themselves, so to speak, that you later set for your take profit and stop loss. That's all there is to say about that for now. On the 1-minute chart, of course, you can work much more closely with much smaller numbers in this case. At the end of the day, it never really matters what percentage your stop loss or take profit is set at. It's always about the risk-reward ratio. Yes, so remember that. It's definitely a very important parameter, a very important factor. That's why, for example, we can see it here again. As I said, I'm completely live here without having prepared anything special to make it look perfect or anything like that. I'm really giving you completely authentic examples here. Sure, it's not live in that sense, but it's still a recording that I'm doing in one go. And for example, you can see it here as well. This is actually another very good example. We did have candlestick bodies that closed here. Yes, in this case, we would have opened a long position. What would have happened? We definitely would have hit the stop loss here. We would have been stopped out. But the big advantage here is that we have a double indicator setup. We have the RSI as a safeguard. This means purely from the perspective of the Bollinger Bands, a long position would theoretically have been opened, but we use the RSI as a safeguard. The RSI was not oversold, which means no position would have been opened. Instead, the position would only have been opened here, where the RSI is oversold. That means, at this point, we would have caught a perfect spot to enter the position, so to speak. That's why it's so extremely important to work with the RSI and to always check and monitor where is the RSI value. And depending, of course, on how you work yourself and how many trades you want to take, you can also adjust the RSI here. You can theoretically act even more strictly, as I mentioned earlier, by only entering a long position. For example, if the RSI is below 25. What will happen then, of course, is that you'll get fewer trading opportunities, but your hit rate will increase. So you definitely have a bit of leeway there as well. In that sense, nothing is ever set in stone. You'll definitely get a feel for it too, and I also always make it a bit dependent on the market. I base it on, am I on the 3-minute chart, on the 5-minute chart? So it's definitely important to take all of that into consideration. Now we're definitely going to move on to live trading. At this point, I'll give you another tip. As I said, the big advantage is that we're on Bitunix because there we have the option to open individual charts directly. That means I can quickly switch between Bitcoin here, and then I can just click on Ethereum. And I immediately have the Ethereum setup as well. At this point, I have a Solana setup. I can click here on XRP and then have the XRP chart open. This means we have several options to work with, and that's obviously a huge advantage because we basically set up the indicators once here and they are applied to every single chart. And that's the big advantage. Here's another important tip. Altcoins are significantly more volatile. With altcoins, you have to be much stricter. And that's why I showed earlier that this value is variable. You really have to pay attention to which chart you're trading, which altcoin, etc. If, for example, you're trading memes, I would be more cautious. In that case, I would set the stop loss a bit tighter. For example, doing 25 to 75 would also be an option, as I mentioned. So you really have to be stricter there and also consider, are you trading Bitcoin or are you trading altcoins? So you have to develop a bit of a feel for it, but I think you now basically understand how I personally approach things, and that's why this live trading here is so important to me, because I can really speak from experience. I can speak a bit from my gut feeling and also show you, so to speak, how I personally proceed, what my thoughts are, and how I later make trading decisions, especially with Sky. So now we're definitely getting started. I'm definitely going to get to work now, take some time here, watch the charts, see where good setups are forming, and also give a bit of commentary. Where will I enter a long position? In this case, we would have gotten some beautiful entries again, but as I said, I'm not worried about the strategy anyway, because this is definitely a scalping strategy where you definitely get enough opportunities, since the Bollinger Bands and the RSI, as you can see here, definitely provide plenty of chances. You really do need to set aside 2, 3, or even 4 hours to get a good number of trades, because of course you don't want to overtrade. You definitely don't want to jump into positions too early, too eagerly, or too greedily, especially when there might not even be a proper setup. So it's also important that you strictly stick to your rules here. Especially at the beginning, you don't have any intuition yet. At the beginning, you don't have any experience yet. That means you shouldn't rely on your gut feeling. You absolutely have to follow a clear system. So that's something I definitely wanted to mention again. And now we're definitely getting started. I'll see you in a moment when the first positions are opened, once I've found the first setups. Alright guys, as we can see, everything has been confirmed. We've definitely got the candle close. We're oversold. This is definitely an opportunity to open a long position. At this point, I've set both a stop loss and a take profit. As I said, as soon as the candle closes below the Bollinger Band and we're clearly oversold, the long position is opened. Accordingly, you of course have to see how it fits for you. In this case, I can also set the stop loss below the low, and I always like to set the take profit at the middle Bollinger Band, which is shown here in orange. That's always my approach, so that you're definitely protected in that sense. That's why, in this case, I'll just let the position run. So that's the first scalp that has now taken place. What especially prompted me to open this position now is that we are really strongly oversold. We see a value of 21 here. And as I said, if you remember the sheet, the basic rule is, let's say, at least 30. But of course, you can always keep that in mind. Of course, I'm always dependent on how confident I am, depending on how oversold the area is here, and the trade is now running with a $25 profit. You always have to check, what does your own risk management look like? Definitely take a look at the last 8th chapter. I'll go into more detail there about the topic of risk management, as well as stop loss and take profit. How many percent are you allowed to lose per trade at most? That is definitely an extremely important key figure that you need to determine. It's always a percentage value, depending on your total trading capital. You should never lose more than a certain percentage per trade, so that you definitely don't gamble away your trading account and still have enough opportunities. Yes, the trade is definitely moving nicely into profit now. Depending on how much risk you can tolerate and how large your margin is, you can of course also adjust the leverage. When scalping, I use leverage between 20 and 60, depending on the situation. So it always really depends on how I'm currently positioned and basically what my trade looks like. In this case, things are looking very good right now. We've set the stop loss below the last candle wick. We were oversold, but now we're slowly but surely coming back up in the RSI, and that's often typical, just like here with Solana, as you can see here. So that's an example. In this case, we can see very clearly on the 1-minute chart how the middle band repeatedly serves as a reference point where the price comes back to orient itself. And that's why I would always pay attention to this in your trade, that you set your take profit roughly at this point in the case of a long position, so that we have our take profit just below this middle band. We can set it like this here as well. Of course, you can always adjust it slightly, but the basic structure always has to be correct. You always need to have a risk-reward ratio of at least 1 to 2 before you enter the trade, and accordingly, wherever the middle band is, that's where your take profit should be set. So here, we just need to wait a little bit, and then we'll check back in a few minutes. Alright, a few minutes later, we can definitely see what's happening with Solana. The trade is definitely looking very good. We're now 30% in profit, 64 US dollars have been made so far, and we can clearly see the reference point was found again, and our Solana long position has been closed. Definitely very satisfying. Now we can take a look at the position history. There we can clearly see where our entry was and our closing price. And now we can see here how everything basically worked out. We took a profit of 33%, a total of 73 US dollars. That's how it looks right now. It worked out really well already with the first position. I'm definitely going to keep looking for other trade setups now. So I can show you briefly how I go about it. Depending, of course, on what the market is currently offering, I look at different positions. And I've got Pepe open, I've got ADA open, Sui open, Dogecoin open, and XAP open. Then, as I said, Solana as well, Ethereum as well, and always Bitcoin. So guys, you can see what's happening here. A very, very strong sell-off. We have to be quick. Change in percent. We're going to set the take profit right away at this point. At 0.6, 0.3, we open the long positions immediately because we've just received a very clear signal here. This is really, really, really extremely oversold. We've also taken the profit right away. And it's really, really, really crazy, guys. We've hit a value of 19 on the RSI. You really have to take advantage of opportunities like this. What I'm going to do quickly now is check the other charts right away and see if we can catch any more longs there as well. You really do have to be quick. You can see the spikes happening instantly here. It's being bought up immediately here. Hammer candle also on Dogecoin. Now we can follow all of this live. Sometimes there are a few altcoins that lag behind, but this is just insane, guys. Just look at this candle. It's incredible, and that's exactly what I love about this strategy, that you can catch positions like these. Yeah, once again, this is a really good example of how we jumped into the position right away. Otherwise, as I said, you can just work your way through here a bit now. So guys, we definitely have to be quick. Unfortunately, I missed it a bit because I was away just now. Still, I'm trying to get the position opened. We clearly got a short confirmation right here at this point. We've completely left the Bollinger Band, in this case for Eve. And now I just need to set everything up quickly. 0602 is, let's say, my standard basic setup. Here we can basically see how everything is displayed. And now I'm just trying to open the short position here because we've clearly received confirmation here. We even have a very clear candle here that spikes upward with a strong wick. And that's exactly why I want to take this trade right here, right now. In the case of Bitcoin, the short position, we can quickly switch over to other positions, take a look at Solana, XRP, and now also observe here whether a similar setup might be forming. Because most of the time, as soon as Bitcoin gives us the signal, there's sometimes also an opportunity with altcoins. But here, we actually weren't that oversold or overbought in this case. That's why, exactly, let's just look at Bitcoin now, check out the position here, and especially when something like this happens, when we're overbought again with a spike upwards, it's usually a good sign. The stop loss in this case is set exactly perfectly above, so to speak. So we definitely have a bit of room from the last spike. That's definitely very comfortable as well. Now, regarding take profit, of course, you can take a look at that. I have a risk-reward ratio of 1 to 3. That's, I would say, relatively well set up. We could definitely tighten the take profit a bit more in hindsight since we're already somewhat outside the lower Bollinger Band here. That's why it's also fine to have something like this. Still, all in all, I would say you should stick to a 1 to 2 risk-reward ratio. But that's how the position is now opened on Bitcoin, and we'll definitely see each other again in a few minutes. Alright guys, I'm back, both with Bitcoin and Ethereum. It's really looking very good. I expect that we'll hit our take profit, yes, right now perfectly. Bitcoin closed, 45x leverage is done, Ethereum is closed as well. Perfect. Just as a quick summary at this point, we can take a look at the position history and see here 31%, $71. And now you can roughly estimate how I actually proceed, how much capital I put in, and what my potential risk is, so to speak. So in this case, with a risk-reward ratio of 1 to 3, I can lose about $20 per trade. That's, let's say, a guideline from my side, and it's definitely legitimate. As I said, it's never about the leverage, it's never about the capital you put in. It's always just about how much you could potentially lose per trade. Yes, it's extremely important that you always keep this key figure in mind. How many dollars could I lose on this trade if my entire setup gets invalidated, if it goes in the wrong direction? In my case, it's about $20 per scalping position, and that's absolutely fine, and that's always how I approach it. And as I said, that's where leverage margin and so on come into play. You always have to do the math yourself when it comes to your own risk management. By the way, we'll come back to this later in Chapter 8, which is all about risk management. How much should you risk per trade? And we'll go into a lot of detail on that, so don't worry about it for now. Everything will be clearly and systematically explained again, because these are among the most important, yes, the most important parameters and key figures you should know in trading. Alright folks, at this point I want to wrap up with scalping strategy number 2. Definitely one of my favorite scalping strategies because it creates so many opportunities, and sometimes you can even trade 2 coins at the same time. And I think at this point, you've definitely gotten a good insight into how I personally approach trading, especially with live trading. There's always a big difference compared to theory. As I said, at this point, I've linked everything related to Bitunix in the video description, and especially when it comes to scalping, I definitely recommend make sure to use this bonus first. That's why I specifically set up this campaign for you for this video course. In this case, you'll get $400 completely free as a gift when you deposit 2,000 US dollars. Depending, of course, on how much you deposit, you'll receive the corresponding bonus credited to your account, and it's extremely advantageous when you're starting to scalp because you want to ease into it slowly. With this, you have bonus capital to start with, which, as I said, is completely free in that sense. You just need to make a deposit and then you'll receive the bonus accordingly. I think this is especially pleasant for beginners since it gives you a buffer of capital that's provided for you at the start. That's all there is to say about that for now. As I said, everything is linked below. Now let's move on to scalping strategy number 3. Alright folks, we're now at the third and final scalping strategy, the MACD cross plus EMA re-entry. The core of this strategy is based on the following. The MACD shows you where the market wants to go. The EMA shows you where you can jump in. So basically this is another double indicator setup. One indicator backs up the other because often there are clear advantages and disadvantages, or rather clear strengths and weaknesses for each indicator. To compensate for the weaknesses of one indicator, especially the noise, the false signals, it's often very important to work with at least one other indicator. And that's why this scalping strategy will also be applied here on the 1-minute chart or on the 3 or 5-minute chart. We will definitely use the standard MACD indicator with the default settings of 12, 26, 9 plus the 21 EMA. Yes, in market phases with clear trends, those are definitely the ones we want to trade. This strategy now differs somewhat from the other two. I can speak from personal experience here. You won't get trading signals as frequently with this one. However, the advantage is that the hit rate is very high with this strategy. So when a trade actually comes together, you usually have a very good setup that you can take advantage of. I would say with the previous strategy 7.4.2, there are definitely more false signals than with this strategy. Here the signals are, I would say, a bit clearer. Still, it has to be said that there will be nowhere near as many signals, nowhere near as many trading opportunities as with the second strategy. That's why a bit more patience is required here. That's why at this point I'm only going to show everything in TradingView. With the other two, I took the time to prepare everything in detail, so to speak, and always picked out trades for you. In this case now, otherwise this whole video course would last several hours or simply be way too long. That's why at this point I'm going to show you everything in TradingView, how I proceed here, and so to speak, how you can find setups. Because at the end of the day, with the other two trading strategies, you've definitely seen how I proceed, live in the chart with the individual trades. Now, in this case, I just want to show what it all looks like later in TradingView, or rather, in practice. So let's jump right over now. We're going to take a look at everything here in TradingView. At this point, I can also remove everything again for you just to show how you can practically set everything up later, because now you've seen how you can implement everything in Bitunix. And now we're going to take a look at how you can make all the settings in TradingView as well, so that you also understand how to implement everything here. Exactly, and that's why I'm going to show you now how to add the individual indicators. So let's go to the EMA here. We need the 21 period one, specifically here, exponential moving average. You can set it up and then you'll see it displayed right away in blue. What you do here is adjust the settings. Inputs, length 21, as explained in the sheet. As mentioned, everything is linked for free in the Telegram group. What we're going to add now is the MACD indicator. Then you just take the standard one here, moving average convergence divergence. And then we click on it once, and that's how the strategy is set up. Now let's get into the rules a bit. What do you need to pay attention to? What is the strategy based on? We only trade trends and the retests of those trends. And it's very common that, for example, we have uptrends here. So it's important to pay attention to the histogram here first. If the MACD indicator is positive, we can assume an uptrend, and we only enter long trades if the price is also above the EMA. Here's an example. We moved into positive territory, got a bullish crossover, and the histogram is positive. That means in theory we received a signal here. However, we only enter the trade on the retest of the 21 EMA. That is, so to speak, the basic principle of this strategy, that these individual retests take place. And if a retest occurs and the histogram is still positive, long positions are opened. And of course, the same applies in the opposite direction. This provides a kind of safety net, because with the MACD indicator, it's often the case that new movements occur, basically individual spikes that aren't accurate and later turn out to be fake outs. To protect yourself against this, you only trade either above or below the 21 EMA line, so to speak, in downtrends or uptrends. And that's why it's important to clearly identify trends. That's also why I said that signals won't appear very often here, simply because Bitcoin is often in a sideways trend or in a consolidation phase, and then it becomes a bit difficult, I would say, to find trade setups. But there are also phases where there is a clear trend, and then it's very, very, very pleasant to take advantage of the individual retests, because that's often the case. You can see it here again, for example, that there is practically always a reference point to be found, and then you can enter positions beautifully, and they also have a relatively high hit rate. Then you have to imagine, for example, that we got a bullish crossover here on the indicator. We don't go long yet. We first wait for confirmation on the 21st EMA, and here we can see very clearly that the uptrend is still intact. We have a positive green histogram, so positive momentum is present. That's why a long position is opened here. So as you can see, it works very well here too, just like here. We don't go short at this point as soon as a negative histogram appears. We wait for confirmation first, and the confirmation would have come exactly here. Then we could have entered a beautiful short position. In any case, we have a negative histogram here. We had the breakout here. Another confirmation here, so to speak, a retest. We were then rejected again at this point, basically bounced off, and then you can enter beautiful short positions here. This works very, very, very well in uptrends and downtrends, but where it doesn't work well, please be careful, is especially during consolidation phases, when something like this happens here, where you get a lot of fake outs. Here, for example, I have an example for you. When something like this happens in the ID indicator, yes, something really, really, really ambiguous. We have a lot of intersections here, we have a lot of fake outs, so at this point, many false signals, a lot of new things, and if there is also little volume and something like this happens with Bitcoin, please do not enter any positions here, because then the strategy does not work well. The whole strategy only works well if you have clear trends. Yes, a clear uptrend or a clear downtrend. And that is extremely important. Here you can also see it very well, for example, when a clear downtrend is taking place. We see the break of the 21 EMA here very clearly. We also see a negative histogram in the MACD indicator. We got a bearish cross here, but at this point, we don't enter the short position yet. We wait first, yes, until the entire downtrend basically plays out. Then usually comes the retest, yes, the confirmation, so to speak. And here is where the short position is entered. We are still negative. This means we were able to take a perfect short trade here. Yes, and you can definitely see how well the whole thing works. You really have to pay close attention to this. Do we have a clear uptrend, a clear downtrend? For example, in a downtrend here, there would have been some great opportunities again here as well, for example. So over time, you'll probably start to recognize how the strategy works. And especially here in uptrends, we keep seeing these retests happening. Yes, and when we get close to the line here, or when the cross happens, you can open beautiful long positions, because this is usually the reference point for uptrends and downtrends. At this point, I won't be doing any live trading here, because you really have to be patient for that. You really have to keep checking the chart, and I would say keep looking for new setups. That's why, strictly speaking, it's not really a true scalping strategy. You could even apply this strategy on higher time frames, so it would theoretically also be possible on 5-minute or 15-minute charts. But as I said, the 21 IMA is always used as a reference point. For example, here as well, we're now on a 5-minute chart. Here we had a small spike, and you can see again that, yes, we might briefly move above it even in downtrends, but overall, it's pretty clean that we are basically always positioned along the line. And that's why it's also very clear here where we could have gone long or short. Now here as well, live with Bitcoin. As I said, we're currently recording this on July 23rd, and you can see here, for example, we got a long signal, a bullish crossover. The histogram also looks very clean. So in this case, there isn't really anything particularly new. And just to quickly explain one last thing, here we wouldn't have gone long yet. Instead, we would have only entered a long position here at the retest. And then, for example, we would have gone long here. And then, of course, depending on which time frame you're on, you can do 0.3, 0.1, or even 0.1, 0.2. So at a minimum, as I said, a risk-reward ratio of 1 to 2. Adjusted a bit depending on the situation. Are you on the 1-minute chart, the 5-minute chart, or even the 15-minute chart? And as I said, it always depends, and you can see that this works very well here too. Yes, I'm completely live here. As I said, I haven't prepared anything or the like. We see a bullish crossover here, see a beautiful confirmation, and here you could have entered a long position perfectly again. So it's really, really pleasant. As I said, when a signal comes, for example, here again, we can see it here too, a negative histogram. Here we then got the confirmation. The strategy works very, very well, very well. But I can tell you one thing, if you pay attention to the timing here, there are quite a few hours in between. You need a clear trend, you need a clear confirmation. You should really only enter the trade if all the parameters are right, because otherwise, yes, your hit rate will suffer. Yes, here too, for example, a beautiful short. You can definitely see I find so many examples in this chart, and I think that once you develop an eye for your own trading strategy, you'll also be able to spot the individual opportunities where you can keep entering positions, because here the 21 EMA is always an extremely important point of reference. That's all there is to say about that for now. Alright, that's it for scalping strategy number 3. Feel free to give it a try yourself. Of course, you can also try out different trading strategies in parallel from time to time. For example, you could set up this scalping strategy on a higher time frame here in TradingView. Yes, you can have this on one monitor, and on the other monitor you can run a different scalping strategy, maybe one that uses Bollinger Bands or the RSI. That's actually something I've done myself. You can trade the trends with this strategy and then trade the other spikes, like the overbought or oversold positions or movements, using the Bollinger Band scalping strategy. So that's definitely a potential approach as well. That's it for scalping strategy number 3. Now we'll continue with swing trading and day trading. Alright folks, let's move on to the next chapter, 7.5 day trading. This will go hand in hand with 7.6 swing trading because the principle is the same for both. Yes, so basically the core of the strategy is based on the same principle, and if you are paying close attention in chapter 2, you should already have a rough idea of where this is going, because now we're going to discuss in detail how to actually take advantage of these stop hunts or liquidity grabs in your own strategy, both in day trading and swing trading. So later on, all of this will be based on the 15 to 30 minute chart for day trading, up to the 4-hour and daily charts, because you'll notice anyway, especially when we get into the liquidity heat map, that you always have to work your way structurally from the higher time frames down to the lower time frames. And that's why we'll be covering both aspects here together, and later on in live trading, both will be addressed as well, meaning both on the smaller time frames and the larger ones. You'll definitely see how I personally put all of this into practice, which is also what makes the most sense. So let's jump straight into the theory now. I'll definitely keep it brief because later on in practice I'll have a lot more to say about it. Theory is one thing, but practice is something else entirely, and that's where you'll really see much more concretely what my approach actually is. First, let's briefly look at the prerequisites. We need a clear structure, meaning a marked daily high or low that hasn't been broken for several hours. It's extremely important that you come out of a structure, whether that's from a bullish structure, moving from a low point into a new one, or from a bearish structure into a new one. So it's extremely important to have reference points like individual daily lows or individual daily highs. And what we'll do is trade within this structure and essentially take advantage of individual liquidity sweeps when certain lows are taken out, because it's quite common for retail traders to place stop loss orders just below the lows or above the highs, and accordingly you can position yourself in advance. We'll go into more detail on this later and show what it looks like in practice. The trigger event itself is when the candle briefly breaks the high or low but immediately wicks back into the range. This is extremely important, and it's exactly the principle of the market makers, this single spike that occurs both for short and long positions. So you'll definitely see this in great detail later on, how the whole thing looks in practice. Then theoretically there's also a confirmation candle. I'll show you that later. The entry is made at the close of the rejection candle in the opposite direction of the sweep. So basically this spike that can occur from the long positions being taken out at the stop loss orders or from the short positions in the upper area. As for the topic of stop loss and take profit, to be honest, I don't want to go too deep into the theory here because it will be explained much more precisely in practice later on, so you'll be well informed. Here's another concrete example of what the whole thing can look like later, so feel free to take another screenshot here. I also don't want to repeat myself 100 times now. You know why this setup works. You know that all the retailers, the general public, always place their stop loss orders directly above the individual daily highs or daily lows. And we can take advantage of that by going with the flow, with the whales, with the smart money, and thus positioning ourselves on the right side, instead of making the same structural mistake as 95% of traders who simply place their stop loss orders below the last structural low. Then moving on to 7.6 swing trading, it's exactly the same principle that we also take advantage of the structure here together with smart money. We look at where liquidity is located, where potential limit orders can be placed, and we'll get into this more concretely in practice later on. And here as well, you can of course take advantage of individual trend movements in swing trading, or you can also exploit this liquidity hunting by the market makers. In my opinion, this is the better option. That's why here you have everything at a glance again, and it's of course extremely important to always check all the heat maps. But we'll take a look at that in practice in just a moment. That's all for the theory part, at least for now. All the PDFs are also available for free in the Telegram group anyway. There you can review everything at your leisure, including the topic of stop loss and take profit. But in my opinion, practice is much more important here because in theory, everything always sounds quite simple and nice. But later on in practice, you'll definitely see, also based on my own experience, as I'll talk about it personally, what I pay attention to and which additional parameters come into play. But now we're definitely moving on to the practical part. So guys, we just discussed day trading and swing trading in theory. Now I want to show you how I personally put all of this into practice, what it actually looks like with Bitcoin. Because theory is one thing. Yeah, sometimes things sound better in theory than they actually are. But now in practice, I really want to show how I personally approach my analysis and how to properly trade these liquidity sweeps, meaning these market maker moves. This is going to be extremely, extremely important now because this is where it really becomes relevant to practice. Now I'm going to show you my approach and among other things, how you can proceed as well. As I said, you shouldn't see it as completely strict, making a hard distinction between day trading and swing trading. A lot of things overlap with each other. Sometimes you have more opportunities, more chances, and sometimes nothing happens at all. Yeah, so it might be that you want to do day trading and want to position yourself where the market makers might soon make a move. But when phases like this happen with Bitcoin, like here, or for example here, then it's much harder to look for real liquidity hunts. Because as you can see here, this is over a longer period. Let's take a look at it. This is about 2 days here where nothing happened at all. So you can't really hunt for liquidity or anything like that during those times. Even if I look at the whole thing on a 12-hour basis, nothing happened at all. Yeah, so as I said, it's important that you really understand this when it comes to Bitcoin, especially on weekends. There really isn't much going on with Bitcoin. Even today, I'm recording this whole video on a Sunday, and it's very, very typical for the weekend. So you can't really open positions or take trades during that time. That's why I would recommend that if you really want to trade on the weekend, you should stick to scalping, and otherwise, it's better to position yourself properly. It's better to look at higher time frames, like in this case, on a weekly basis. Where is the liquidity located? Where could the market makers push the price? And especially on weekends, it's ideal to prepare yourself for the coming week. And that's exactly how I personally do it as well. I take my time on the weekend to calmly look over everything because I can tell you one thing, this behavior we're seeing right now is incredibly typical. This is actually another textbook example of what happens on weekends. Nothing happens on the weekend. Liquidity builds up both above and below. You can't really say where there's more right now, maybe a bit more on the top. That's why you could open short positions here again, but this is really perfect for preparing for the coming week, because yes, on the one hand, crypto and Bitcoin can be traded 24/7, so the markets are open 24/7, 7 days a week. But still, it's very clear that there's significantly less volatility and much less liquidity on the weekends. That's why we have to be patient and wait for the start of the week. So we're preparing ourselves here at this point. I've now clearly shown the setup and have directly marked where the important liquidity zones are located. So first I get an overall picture on the 4-hour time frame. We also take a look at things like, okay, hey, where is the side volume profile? So where is important support? What needs to hold? Or for example, what happens if the support doesn't hold, like here in the volume gap? So you should definitely have understood this already so that you have a rough overview here. Now it's extremely important, and this is something I would recommend to every one of you. Whenever a new structure forms in Bitcoin, no matter where, I would always suggest that you mark the highs and the lows, the individual points. At this point, we're also going to remove this indicator on purpose. We'll remove the other one as well just to keep things clear. What I would recommend to you, always mark individual high points and individual low points. That way you always have clear reference points and know exactly where everything is. You'll also notice that time and again, these levels are respected by the price afterwards. That's why it's so important to get a clear overview, just like I've done here with Bitcoin. This setup is also beautiful right now. We've left the old structure. We've established a new structure with a high point here and a low point here. These are extremely important. Then we work our way down step by step. And here we have the second mini high point, which coincides with this one. By the way, liquidity was already taken out there, just like in this case here. And these are, I would say, the relevant key levels that you absolutely need to mark for yourselves later on also for your trades so that you know exactly how to prepare for the coming week. Of course, we will also prepare everything here on Bitunix one-to-one again so that you can see directly how to handle things in practice, or rather how to prepare yourself for the coming week in practice so that you basically plan your trades in advance, especially for those who don't have much time during the week. It's extremely important to do this kind of preparation on the weekend. And as I said, the weekend is very well suited for this because you have a very, very good overview and you can clearly see, okay, hey, what could become interesting for the market makers in the coming week? We will also work this out here on CoinEnc in this case. Always analyze structurally from the higher time frames down to the smaller time frames. So basically, start here on a 2-week or weekly basis. Yes, most of the time it's always pretty similar. Here again, we can see perfectly below the last intermediate low at 115,800 US dollars. definitely remember this level, or rather, all the way down to 115,300 US dollars. There's a lot there, a lot of liquidity, several billion. Yes, you can see it here, liquidation leverage, it's displayed here by the number. We can clearly see that there's a lot of liquidity here, and I've marked it directly on the chart all the way down to, yes, at most 115,000 US dollars. There's quite a bit here, and this could become very, very typical. I've covered this in the other videos, especially in chapter 2. If you listen carefully, you'll definitely know what keeps happening because of the market makers. They basically poke in once. Yes, they poke in, grab the liquidity, and then the counter move follows. And that's very typical, and as a trader, you need to be prepared for things like this. Especially now on the weekend, it's much more comfortable, and you can already set limit orders in advance so that your position is triggered immediately when the spike happens. Because one thing I can tell you, catching that spike perfectly, being online at that exact moment and pressing the button to go long right then is pretty unrealistic. Of course, it can happen if you happen to be in front of the chart by chance. I also have to do my research, have calls with others and so on. So I also have plenty of other things to do besides sitting in front of the chart all day. And that's why it's extremely important to set up limit orders in advance, for example, in case it happens at night as well. Yes, that's of course very often the case, that when you're away, whether you're at the gym, eating, or somewhere else, you need to be optimally prepared. That's why it definitely makes sense, for example, to clearly set up limit orders in this area, where you also protect yourself accordingly with a stop loss. Because this is extremely important now, as it will set you apart from 90% of other market participants, specifically 90% of the general crowd. Yes, they enter their long positions here and then set their stop loss here, here, and here. And under no circumstances should you act like the general crowd. You must absolutely not act like 90 or 95% of market participants, because if you do, you will be systematically washed out. And that's why it's extremely important to always keep an eye on the liquidity heat map. Okay, it's lighting up very strongly here. You set the stop loss below it, for example, at 114,950 US dollars. That would be roughly in that area. So basically, you can place the stop loss at the lower edge of my box. Of course, it can also happen that there's another wick down to 113 or 112, but that's something you have to accept. You can never be 100% right, but this way you significantly increase the probability if your stop loss is placed below the liquidity. And the same applies here, for example, on a weekly basis for potential short positions. We can see it beautifully here as well. Here it lights up extremely strongly from 121,000 US dollars up to, well, I always look at the area that lights up the most, up to 122,300 US dollars in this case. And we can take a look at the whole thing here. This is exactly the box that I have prepared. 122,300 US dollars is exactly up to this level, and there is quite a bit of liquidity here, which also makes sense. Why? Because here we have two small intermediate highs, and that's why there are a lot of short positions placed here by retail traders who are just waiting to be taken out by the market makers. So that would be a typical move if Bitcoin does something like this. Bam, everything gets liquidated nicely again, and then it comes back into the zone. And especially zones like this one right now, these consolidation phases, can be used very, very well because here we have beautiful reference points. We basically have a lower level, an upper level, and based on that, it's relatively easy to determine where is the liquidity. Yes, where do the market makers have a strong interest in pushing the price? And that's exactly how I prepare myself for the coming week. What we can also take another look at now are the smaller time frames, the 3-day and daily basis, so we can get a brief overview there as well. There we can definitely see at 116,000 US dollars, there's still something there, so exactly up to 116. In this case, it's up to this level here. So especially at these levels, there's definitely still quite a bit of liquidity. Now we're going to look at the daily time frame, and based on that, you need to determine, okay, where do I place my trade? Where can I set my stop loss? 117,200. In this case, 117,200. There's still something here. So you definitely need to watch closely there, and now also on the 12-hour basis. Then you've worked your way through everything nicely, step by step, in terms of structure. Again, 117,200 US dollars. Yes, so it's also very realistic that the price could dip back in there. And that's how I would personally prepare myself for the coming week. What I like to do, especially in a structure like this, is to place 2 trades in advance, which we can do now. Now let's switch over to Bitunix, take a look at everything here, and now it's important that we remember the individual levels. Specifically, I definitely want to open a long position at 115,500 US dollars. That's definitely, I'd say, the first position I want to establish. So here on Bitunix, I go to limit, click on it, and in this case I can set directly when the position should be triggered. As I said, if you listened carefully in the second chapter, especially regarding the setup, or actually that was chapter 1, then you'll also understand here how to set everything up. 115,500 US dollars. So actually pretty much exactly. Yeah, we can quickly double check it again. In this case, the liquidity is here. If you set it a bit too low, sometimes your order might not get filled. Yeah, theoretically, you could also set it to 400. So you need to develop a feel for this, because on the one hand, if you set it too low, it's quite possible that the move from the market makers isn't enough for your position to be triggered. That's happened to me so many times, where I put in a limit order and it doesn't get filled just because of a few dollars, so you need to be a bit careful with that. If you set it too high, then you lose a bit in terms of percentage and your trade isn't optimally placed. But I think in this range, it's definitely fine because then you're positioned exactly below this level. So if Bitcoin dips in here once, your position, or in my case the position, will be triggered. Then I want to enter the trade with a total of 1,000 US dollars using the limit order. Now we definitely need to continue with two more parameters. First, the leverage, which we need to set correctly, and then take profit and stop loss. For that, I'll take a look at the liquidity heat map and see what's going on here. Up to where is there still liquidity so that I'm covered and don't just set the stop loss right here, just a few $100s below. That would be too tight. In addition, the topic of price action is also very important here. So I take a look and consider what makes sense. You can always throw in the VRVP as well, because then you can see pretty clearly up to where there's still volume and when this volume gap starts. Because as soon as this volume gap appears, it doesn't make sense to set a stop loss here. Because as soon as this level doesn't hold at the end of the day, the price will quickly revert back to the old structure. And in this case, the origin of the old structure is at 109,000 US dollars. New liquidity only comes in again here, and that's why it doesn't make sense for me to set a stop loss here or here. Instead, I can keep it relatively tight. I might even set it at 114,900. That makes the most sense for me right now because I can still see some decent support here since there's at least a bit of volume present, even if it's only minimal. But if there's a spike caused by the market makers, I'm at least somewhat protected here with 114,900. Yes, that makes the most sense. 114,900, and that's how you can enter it here as well. And now, in this case, 114,900. 900 is entered. Then you see, with this trade, I could potentially lose $50 if I'm using 10 times leverage. Of course, it all depends on how much capital you're putting in, so you're aware of that. In this case, you could just throw in $2,000 here. That's also an option. Or you could say, hey, I'll stick with the $1,000 and just increase the leverage instead. That's extremely important. Here's a little tip. Have your own rules for your trading capital. Then you have to ask yourself, how much capital am I allowed to lose per trade? Yes, and you always have to calculate that as a percentage. It never has anything to do with a dollar amount, but always with a percentage. If you set a general rule, for example, 2%, then you can roughly calculate it. With $10,000, you should never lose more than $200 per trade. Yes, so that's extremely important. That's why you absolutely need to have a clear set of rules. In my case, I can set a leverage of 15 here, and then check everything again for confirmation. I lose 75 or 76 US dollars per trade. And in my opinion, that's manageable. Yes, if the trade is executed and hits the stop loss, it's completely acceptable for me to lose $76 because now we come to the next point, which is the take profit. We ask ourselves the question, where can we take profits? And in my opinion, that's relatively simple because in this case, I choose the upper edge of this structure, yes, and I do make sure there's a bit of volume because as soon as the area of 120,000 US dollars is left behind in this case, the probability is very high that we'll shoot up to a new all-time high. That's why the probability is still high here that a rejection will occur, because, as I said, that's also the next liquidity area. Let's take another look at the whole thing. To double check, we can take a look here. It's also very typical, of course, for market makers to push the price back down here again to 121,000 US dollars. And that's definitely where I'll set my take profit. 121,000 US dollars. That's where I basically want to take profits, and with this trade, I could now make $700. Yes, so that's basically what I can get out of it now, and in this case I would lose 76 US dollars potentially. That's an incredibly good risk-reward ratio. So that's definitely how I'm going to proceed for now. What should also be mentioned here, and what I sometimes do myself, is to take partial profits. In this case, to secure yourself to some extent, or to move the stop loss into profit afterwards anyway. So that's also something I would definitely recommend. As soon as you're a bit in profit, move your stop loss up, and then you're definitely in the trade without any risk. That's all I have to say about that for now. That works for me in this case. Now, in this case, I'm going to open a long position, click on confirm, and then we can see here that the position has been opened. Let's take another look at the whole thing. In this case, here's the limit order, and right here is the stop loss as well. The stop loss is perfect because once we reach this area, everything would break downwards anyway. For example, what I'm noticing in the chart right now, and as I said, I'm doing this completely live. I haven't scripted anything or anything like that. I really want to show authentically how you can approach this. If you now realize here, okay, hey, on the one hand, we have an incredibly good risk-reward ratio. That's one thing for starters. So here we have a risk-reward ratio of almost 1 to 10, which is really quite decent. That's why there's definitely still some leeway. That's also why you can say, let's set the take profit a bit lower, so we're protected in case this high isn't fully reached. That's one thing for starters. And you can also move this limit order up a bit in case the market makers don't push in as strongly. If it gets bought up immediately, you can also do it here, confirm again, and of course the risk-reward ratio will be a bit worse, but in return, the probability that the trade will be executed at all is higher. And this is now a very, very typical example of range trading. On one side here, we have an order block formation. Yes, we can see it here. Order block formation always basically means this pause during the upward movement. Here we have a complete order structure. Here is the next order block formation, and it always makes sense to use take profit and stop loss orders here because the price very often reacts to these levels. That is definitely also very important. That's all for the long position. Now, in this case, we will do exactly the same thing one-to-one with a short position, and that's also relatively simple. I want to go short immediately as soon as we enter that area in case there's a small spike. In this case, at $121,000 to $122,000. So in this case, I will now open the next limit short position. Again, in this case with $1,000. In this case, I'm also using a 15 times leverage again. We can always calculate everything again afterwards anyway. So you don't always have to plan everything out completely because you'll see it displayed here anyway. So you can always check again to see if it fits or not. What does the risk-reward ratio look like at the end of the day? Because on the one hand, you have the option to calculate everything manually, so to speak. Theoretically, up here on the top right in Bitunix, you have a calculator function. There, you could also recalculate each individual position. Yes, in case you're wondering, hey, what is the risk-reward ratio? What makes sense? But personally, I also find it very convenient here to see it directly on the chart and know exactly where the position will be opened and closed. Now, it's definitely about executing the limit order properly. Let's just do a test now with 121,500. Then we'll set take profit and stop loss. We can take another look at that as well. Where is the liquidity? In this case, up to 123, we can set that as well. As I said, it's really not a big deal anyway. That's what's nice about Bitunix. You can always manually move everything up and down afterwards. Now we'll set the stop loss at $123,000. In this case, we could lose $181, which is already quite a lot for me personally. That's a bit too much for me, and that's why, for example, you can also lower the leverage here. Accordingly, you can of course also take the trouble to calculate everything in advance. In my trading rules, I have a rule that I don't want to exceed a certain percentage per trade, so that I'm protected in such cases. And now, in this case, I'd also prefer to take a more relaxed approach. That's why I'm going to use 8 times leverage here. That way, in this case, I'm back under $100, so I'm definitely on the safe side. That makes sense to me. So now, in any case, the stop loss is set here, and I'll set the take profit at this point at $117,200, $117,200. That way, we definitely have a clear risk-reward ratio. We can take a profit of $82, and the potential loss would be $97. For me, that's definitely fine, since the ratio is roughly 1 to 3. Let's take another look at the whole thing. Why did I choose $117,200? Because we're in this range here. And what can happen, if you turn off everything for a moment, is that Bitcoin might do something like this. It spikes in, our order gets triggered, and then afterwards Bitcoin does something like this, and this, and this. And then you can keep taking advantage of the lower areas, the upper areas, and keep setting up nice long and short positions. So that's very, very convenient when Bitcoin does something like this, because you can always take advantage of the volatility. That's why, in this case, everything fits perfectly for me with the short position. Now, in this case, we'll open the short position, click on confirm, and then we'll see that the short position is active. Now, in this case, we've set up a beautiful range, both for the short position and for the long position. What I notice now is that the stop loss up here is a bit too high, and the nice thing about Bitunix is that we can simply move it down 122,500, and that way, our risk-reward ratio also improves. And in this case, I really want to catch this liquidity sweep here. We can also confirm everything here again, maybe even tighten it up a bit more. As I said, you can always see it better on the chart. In this case, I set it up pretty quickly based on our liquidity heat map, but I really like it this way because this way we immediately trigger a short when we enter the upper area, and as soon as we enter the lower area, our long is opened. A beautiful setup that we currently have. This is definitely a perfect preparation for the coming week. It also goes relatively quickly. Of course, in the video I explained everything a bit more thoroughly. Naturally, it takes a bit longer if you check everything, but eventually you'll get a feel for it. You'll be able to read the chart completely intuitively, know exactly where the highs are, and know exactly where the liquidity is. Now, you definitely have a rough idea of how I approach things, and as I said, something like this is a very good example for the weekend. Right now, we have a nice range, and if Bitcoin moves up, there's a high probability that it will get tested again. If Bitcoin moves down, you can basically trade the range up and down 10 or 20 times, and eventually, of course, there will be a breakout. At some point, there will be a breakout either to the upside or the downside, and then the structure is broken. And what exactly do I mean by structure? Structure, just to explain it briefly again, is the following. In this case, we come from an uptrend. Something like this happens, and then a new structure is basically formed. Yes, and then it's decision time again. Yeah, I don't know, maybe a bull flag. Then of course the question is, do we continue to break out to the upside, or is the bull flag invalidated? Then we come back again, usually into the old structure. This happens quite often because a lot of side volume profile builds up here again, and in this case we have another volume gap here. It's just so incredibly typical, and it works the other way around as well. Yes, so even if we enter a bearish structure here, something like this happens again. Yes, and in this structure, you can also beautifully catch double bottoms during a reversal, or if a trend continuation occurs, you can build nice short positions at the upper edge here to catch the next dump downwards. So it's also very pleasant to trade this way. That's actually the best thing you can do with Bitcoin, especially with swing positions. It's super comfortable, and above all, you can base it solely on price action. You don't even necessarily need this liquidity heat map, but of course it's an amazing support, and it fits perfectly because you get confluence here. In other words, alignment with your own analysis. If you see here that it makes sense to go short and notice, oh, there's a lot of liquidity lying there, then it's perfect, and you also have the confirmation that you can enter positions here. That's all there is to say about that for now. I'm curious about the new week. We'll definitely see which position gets triggered, because what we've done here is a kind of sandwich. Yes, a sandwich with Bitcoin. We have now placed both a short and a long position. So, a position has to be opened. No matter what Bitcoin does, sooner or later a position will be opened, and in any case, we are prepared. We will benefit from the volatility, and I will definitely keep you updated on when each position is opened. Then we'll see each other in the coming days. Or in your case, you'll probably see it in just a few minutes, but for me, I'll have to wait here for now. So guys, would you look at that? 2 days later on Tuesday at noon, here's what has been opened. Nice, our limit order was caught, just like out of a textbook. Yes, you can see here the limit order that was placed. You're also welcome to rewind a few minutes. That's when I set everything up, live on Sunday evening, during the preparation. You also saw right away what my approach was, in this case at 116,125, and what happened. And that's why I said chapter 2 is so incredibly important, so you really understand how the principle of liquidity grabbing works. How does the principle of market makers work? Once again, it played out here just like in the textbook. Our limit position was triggered perfectly. Let's take a look at the liquidity heat map, and here you can clearly see, right above my face cam on the weekly chart. The liquidity was beautifully swept, and that's exactly where we positioned ourselves because we know exactly how the market makers operate. We know exactly how the game works here, and we saw that some retail traders had placed stop-loss orders for their long positions just below the recent swing lows. And what happened? With a single spike, the liquidity was taken out, and in this case, our long position was triggered perfectly. And since we're now in a live trading situation, I'll show you specifically what I'm going to do with the position. It's already nicely in profit, of course, and it's very comfortable to operate in this kind of range trading. As we all know, I have my final take profit up here because, and we'll get to this in a moment, I'll show you how to manage a position live. The very first thing I'm going to do now is this. As you can see, I've set our stop loss here at $114,900 I'm now going to clearly move it up at this point, because in this case we have the huge advantage that this position can never go into loss again, especially since we're now moving the stop loss upwards. That's why I'm going to show you live here how I personally always handle this in my trades. We've caught the perfect entry. The position has been triggered. In this case, we're currently at 27% profit. That's $266 on a total investment of just under $1,000 that we put into the trade. So in this case, it's very comfortable, and now we can immediately take advantage of the position by moving the stop loss upwards. As I said, on Bitunix, the whole thing is super easy, really simple to implement, so I'm going to set the stop loss just above the last interim lows so that we definitely walk away with some profit. And now, in this case, I'm just going to let the position run. Now we're moving a bit into trade management. What will I do when a position like this is in profit? As I said, right now we have a very comfortable position. We now have several options. On the one hand, we can start taking profits. That would be one option. We could reduce the margin, for example, to hedge ourselves. In theory, we could also scale up the leverage afterwards. That would also be an option, yes, that in this case you withdraw margin and increase the leverage. We really do have several options now, so I definitely want to talk about a few scenarios now. First of all, it's especially important to take a look at, okay, hey, first, what happened? I think that's become pretty clear to everyone now. At this point, I can go ahead and move the face cam to the left. That way, we have a complete overview here regarding the liquidity heat map. And as you can see, if we look at it on a weekly basis, as I said, this is where the spike happened, which in this case triggered opposition. And now the question arises, okay, what do we need to do now? What do we need to pay attention to? Which important key levels should we watch? So let's dive into that now. And at this point, I always take a very structured approach personally. I work my way from the higher time frames down to the smaller time frames. In this case, let's take a look at what's happening here on a monthly basis. Then we can observe where liquidity is still present in this case. As I mentioned in the previous analysis, the next larger liquidity cluster would be here if this structure doesn't hold, because this is where the origin of our structure is located. Let's quickly dive into the TradingView chart here, and just to recap briefly so you're definitely up to date. I even still have it open here. At this point, use the VRVP indicator. Definitely make use of this tool. What can we see? In this case, we have the current structure here. Within the current structure, let me make it a bit clearer for you. The whole thing is usually a bit redundant anyway. You can also turn off this POS if you want. In this case, I'm primarily interested in the volume, so let's take a look. We have increased liquidity, or more precisely, very high trading volume in these areas. This is, let's say, the current structure, and that's also my personal trading approach to trade the current structure. That's why we opened the position here as well. Now, in this case, you can clearly see a liquidity hole, also known as a liquidity gap. And in this area, it's relatively easy for the market makers to push the price down or quickly pump it up. Yes, so of course this always applies in both directions. Therefore, if this structure doesn't hold, the next time we'll see liquidity coming in is at 108,000 US dollars. This aligns perfectly with the liquidity heat map. So it's definitely great when you find confluence here as well. In other words, when the technical analysis matches up with the liquidity heat map. That's all for now regarding the monthly basis. But as I said, the monthly basis is pretty much irrelevant for our trades, because we trade the current structure, and if the current structure breaks, then we have to completely reassess anyway. What makes sense? Where can we find new entries? In any case, we've already protected ourselves with our stop loss. So let's take a look. What's happening on the 2-week basis? So that you can get an insight here as well. Now, we've clearly left liquidity below us at 115,000 US dollars, all the way down to 113,600 US dollars. You definitely need to be careful here now. Even though we caught this spike perfectly, I'll be completely honest with you. Of course, I don't know where the price is going, but I still want to be prepared in case more liquidity gets taken out. And that's something we can take a look at here. It's definitely possible that Bitcoin could come back again and take out all the long positions, which is why it's extremely important to take partial profits and secure yourself as the price moves up. And that's, I would say, the big difference in what we discussed here during live trading, because there I can speak in a very practical way and draw on my experience to explain what makes sense and when. For example, if I notice that there's almost no liquidity left below us, let's say for instance that there's nothing lying below us, then I'm much more willing to let the trade run. In fact, in that case, I'm even willing to scale up the trade, increase the leverage, or do something similar. But in this situation, it's actually a somewhat risky setup, because what's currently the case is that we have more liquidity below us than above us, and that's why I'm being a bit more cautious with this trade. I definitely want to secure myself right away. In any case, we've immediately secured ourselves with a stop loss in the positive. That's, let's say, the first safety measure, but now you also have to ask yourself, when do I exit the market? Where do I personally set my take profit order? Now let's take another look at the whole thing on a weekly basis. On a weekly basis, we already have a somewhat better picture here, because we still clearly have liquidity above us. Yes, so I definitely want to potentially take advantage of that move. At the same time though, I want to protect myself in case the price comes back here and sweeps up liquidity again on a 2-week basis. So this is definitely very, very relevant for me personally right now. We can also take another look on a 3-day basis and on a daily basis. It's definitely also relevant what's happening there, but in this case, it looks pretty bleak. There's not much going on there right now. We can't really read too much into it at the moment. Here, let's say around 20,000 US dollars, a liquidity grab could theoretically still take place. Now, once again, we can also take a look at it on a daily basis. There was still a little bit happening there as well. As I said, it's quite possible that we might pick something up there. We can jump into the chart, and there we can see it pretty clearly now. In this case, we're looking at the 15-minute chart. There was a very, very nice hammer candle that formed. A strong wick to the downside. That's always a very positive sign for a reversal, for a trend change, or for a strong support area below us, because all the orders have been filled here. Just to explain a bit, when this spike happened here, we can zoom in on that if you like. Shown here in green, that's where our limit order was placed. So I basically prepared myself in advance on Sunday evening, anticipating that Bitcoin could potentially spike down here, which is exactly what happened in this case. And you can see it very, very clearly here. It's a beautiful sign when a spike occurs, and in this case, the candle close, that is the candle body, still ends up relatively high. So that's exactly what you want to see, and that's actually what has happened here again right now. That's why I definitely want to let the trade run until our take profit target up to 120,500 US dollars. We can also quickly check that again. In this case, we have 120 here, so I can also make it a bit stricter now to make sure we definitely reach the take profit. Yes, that's also a measure you can implement so that you definitely reach your target, and then you can make some adjustments afterwards depending on how things go with the liquidity. Of course, you always have to make sure at the beginning that the risk-reward ratio is right so that you always act positively. That's extremely important. but afterwards you can adjust the take profits and stop loss much more flexibly. Alright guys, sorry for the brief interruption with the face cam. Let's continue with the topic of trade management. As I said, we now have several options. Here's a tip for you that you definitely need to keep in mind. Never just give up your position so easily if you've managed to get a good entry. So never close out 100% of your position right away. The best tactic is always to take some chips off the table from time to time and adjust your positions afterwards. Because sometimes you have the opportunity and the luck to hold a position over a longer period of time, scaling it up and reducing it again and again. So that's definitely another tip here. Always work with partial profits. And that's, I would say, the big advantage with Bitunix as well. The whole process is very, very easy. You simply click here on amount, and then you have the option to reduce by 25%, 50%, 75%. So it's really very convenient to take partial profits here, so you can clearly take some chips off the table. We can take another look. The main reason why I'm actually a bit more cautious right now is simply because there's quite a bit of liquidity below us on a 2-week basis. And of course, I'd be foolish not to consider that the market makers might still be interested in dipping in here again to remove some more liquidity. We saw it here at the low, then we saw it again here, liquidity was removed again, right where our trade was opened. And in fact, there's still quite a bit below us, in some cases several hundred million. To protect myself in this regard, I now want to take partial profits from the trade. And of course, in this case, I'm also doing it a bit demonstratively to show you how important it is to take chips off the table. So that's definitely extremely important, especially when you're in profit with a position. Taking, for example, $100 off the table here not only gives you self-confidence, but also gives you the feeling, okay, hey, the strategy works, there's substance behind it. And that's why it definitely makes sense to reduce 25 to 50% of your position here so that you're properly secured. That's why I'm going to demonstrate the whole thing for you here now. Of course, it's also to give you live examples of how you can handle such a position. So you go here to amount, click on 50%, and then you can click on close here, and half of the position will be reduced accordingly. In this case, that's $133 that we take out at this point. Yes, that's basically the net profit that's secured right away. Then we just click on confirm, and the position is only half as large as before. But what remains here, which is a huge advantage, is the entry point. Yes, that's a very, very big advantage because it gives us a lot of options to adjust the trade afterwards. Now we can just let the trade run without any stress. We will never incur any losses with this trade again. On one hand, we've secured ourselves with the stop loss, and on the other hand, we've already taken some chips off the table. Now, for example, we even have the option to add to our position again if another potential setup should arise. Now, just briefly on the topic of take profit, which I want to show you purely for demonstration purposes. As I just mentioned, if you have a good entry, let the position run for now. That's why, with take profit, you also have the option to click on it and then change the take profit. For example, by saying, hey, I only want to close half of the position, for example, 50% of the position at the price of 120,000 US dollars. Depending on what you set here using the gear icon, you'll also see what the respective percentage is that you're taking accordingly. In my case now, I want to take profits here, basically secure profits, take some chips off the table at around 120,000 US dollars. For those who have been paying close attention, you definitely know that there's still some liquidity at 120,000 US dollars, and I know it's not much. Yes, that's not really all that remarkable, at least on a 3-day basis. But still, one thing I want to secure is the upper edge of the range. It could very well happen that, since market makers can also siphon off liquidity here, make a quick move in, and then do something like this, I definitely want to be protected against such moves, so I want to take some profits here. But I still want to show you that if you catch good entries, you can definitely let the position run as well. So if we take a look at the whole thing, there might even be a kind of triangle forming here, which in this case is a type of bull flag. And if such a bull flag breaks out to the upside, it's possible that we've actually caught an entry here where we can let the trade run partially all the way up to 125,000, 130,000 US dollars. As I said, it doesn't have to happen that way, but in any case, we have the opportunity to scale up the trade afterwards and ride along with the trade during the bull run. This is definitely a possibility. Yes, you definitely have to be careful there. Above all, you absolutely must not get too greedy in this situation. And just to demonstrate this principle to you, that you shouldn't get too greedy, I have already taken 50% of the profits now, so that you can really see and understand the urgency of taking profits. That is extremely, extremely important. That's why I will show again here that you take out 50% at 120,000 US dollars. We click on confirm once, and then we can see at this point that the long position is being closed, but in this case only by 50% because the take profit amount is set at 0.0312 Bitcoin. That's basically half of our trade. Then we click on confirm here once, and we can see here as well that everything was successfully triggered, and we will definitely take profits again at 120,000 US dollars so that we are definitely secured there as well. That's the current plan for this trade, and we'll just let the rest run for now. Apart from that, what is still open is our short position. Our short position is in place in case Bitcoin spikes, absorbs liquidity, and then comes back down again. So this is definitely how you can approach it. That's all for now regarding the live trade. I think you've definitely gotten a concrete insight here. I think that's enough for now at this point. I might give you another update, but it was important to me to show you live how to manage a trade afterwards. At the moment, everything looks pretty good in the short term. In this case, we've just had a hammer candle form on the 15-minute chart with a nice wick to the downside. So I can easily imagine that the take profit will definitely be hit again, so we're definitely on the safe side here. And that's how I personally approach day trading or swing trading. As I said, it's a bit of a mix. Sometimes the take profit might be hit later this evening. If that's the case, it was a relatively short session, but it could also be that the whole thing drags on and takes longer. Alright guys, I'm checking in a day later. It's now Wednesday afternoon. As I said, just so you have a sense of the timeline here, we did the overview on Sunday evening. We prepared ourselves together with the liquidity heat map and looked at what makes sense. Then yesterday, on Tuesday, we took our first profits and also adjusted our trade. In this case, we moved our stop loss into positive territory. As I said, just a quick reminder, this is where we entered, the position was opened. We've already taken profits, plus the stop loss is in the positive, and what's more, we've actually hit our take profit perfectly again. We can scroll down here to the trade history, and there we can see that we took out 136 US dollars at that point, and that was yesterday on Tuesday. I already showed you that, so feel free to rewind and check. Plus, our stop loss was perfectly triggered at 120,100 US dollars. In this case, our take profit was reached, 120,103 US dollars. In this case, we pulled out another 124 US dollars. That was, if we take a look at the chart, at 120,100. So basically, our take profit was hit here, just so you're aware. In this case, I was asleep, or rather, it happened in the evening when we spiked in here, and that's a very, very typical behavior. And I think based on this, you can really understand how I personally approach my trades and what the purpose of our take profit was here. As I said, it's marked here once again. In this case, our take profit was reached here because liquidity was identified at this point. I also need to update the whole thing once more. This also gives you a brief insight into the topic of liquidity. Let's take a look at the whole thing, preferably on a 3-day basis. As I said, now shown here, updated on a 3-day basis, you can see perfectly here that this liquidity cluster was tapped. At this point, the market makers poked in once, and that's exactly the move I want to take advantage of in my own trade. And that's why we took out 136 US dollars here on Tuesday, and now thanks to our take profit, another 124 US dollars. As I said, what's actually the case now is that our position is still open, still 30% in profit, still 75 US dollars in profit. And then, of course, the question arises, what can you do now with this position? There are now several options. You can simply let it run. Theoretically, you can keep adding margin on individual dips. So that's also a tip I can give you. You could theoretically open new limit orders again, open new long positions in this cluster, and that's exactly the huge advantage we have here. As soon as Bitcoin dips back in, you could theoretically compound again, as it's called. So compounding means, as I said, adding more margin later, positioning yourself again with new long positions, and you can do this an unlimited number of times. Yes, and you can keep doing this until a breakout happens, until we break downwards or upwards, and then, so to speak, this structure is left behind. And I can also tell you one thing, if you do this range trading, these swing trades, sooner or later a stop loss will definitely be triggered or a trade will go negative. It's important to be clear about that. Obviously, not every trade ends up in profit because sooner or later the range will be broken, and as soon as a range is left, a trade will go wrong. It's important to be clear about that. Yes, and in this case, I could theoretically keep doing this endlessly. As I said, you can do compounding here, and in this case, short positions are also opened in case Bitcoin sweeps liquidity again, so to speak. But at this point, I want to wrap up this entire setup so that we can draw a line under it for this video course. Theoretically, I could keep giving you updates for days on how I add margin, how I take profits, how the whole thing works. But I think by now you really have a very detailed understanding of how you can approach this. And now I want to address one last thing. As I said, please don't take this as a complete example, because I don't always do it this way. Especially when you're in a range, it's still somewhat suboptimal, I'd say. But what you can do, so to speak, later on, if a breakout happens, if things are looking really good for Bitcoin, you can increase the leverage afterwards. Then you can, so to speak, skim off margin from your own position. And I want to demonstrate this for you live as an example, so you really get a concrete insight here. How does this whole process of scaling up individual trades work? How can I increase the leverage afterwards and, so to speak, secure myself with the margin in another way? In this case, we can, so to speak, pull out margin here, $250 from the trade, but still let the trade run. So now I'll show you a method you can use to do this. Currently, we're in this position with a leverage of 15. We have a margin of 254 US dollars. Here you can see the current profit, and down here you can see the profits that have already been secured. And as I said, since our stop loss is in the positive, we're generally protected anyway. I'd say we're in a very good position right now. What we can do now is, if we click on the margin here, we have the option to reduce the margin. Yes, reduce maximum is now showing here as 76 US dollars. That's, let's say, the maximum amount we can currently pull out of the margin, basically to do a kind of de-risking here. But now I'll show you another option, namely increasing the leverage. There are actually several ways to increase the leverage. One way, of course, is simply to add more margin. We could theoretically add another $100 to the trade here. For example, we could just set the leverage to 50 as an example, and then theoretically open another long position with a market order, which would then increase our total leverage on the overall position and thus also require more margin. But what would happen then, logically, and this is extremely important to understand, especially for beginners, is that if we currently have a price of 118,500 US dollars, we are entering a new trade here with more margin. Here we can see our original position, meaning our original entry is currently at 116,000 US dollars. What happens if we now add more margin with a higher leverage? Logically, first, our liquidation price, and second, our overall entry will be shifted upwards. And it's important to note that when you add more margin, everything is logically recalculated, meaning the entry from here, the entry time, is offset against the other entry time. This means that our overall entry, our total entry point at which the trade breaks even, will logically increase. If you want to avoid this, I'll now show you another method that I also like to use from time to time. So now I'll show you the other option. And this other option consists of reducing the margin. As mentioned, we now have the option here to change the leverage at this point, which is now available. As I said, the original leverage with which the trade was opened is 15. Now we'll go ahead and click confirm. Now, just as a reference here, it's very important to see what happens when you increase the leverage to really understand the difference. Currently, the leverage is 15. The position was originally opened with a leverage of 15. That's why we see 30% profit here. Now let's see what happens when you increase the leverage. As mentioned, in this case, for example, with 50, it's important to note that nothing changes with the margin. Nothing changes with our entry, obviously. Yes, the only thing that happens is that the estimated liquidation price changes, which makes sense. So it's important to keep in mind that we naturally have less buffer then, plus the percentages here increase accordingly, but nothing changes in the unrealized P&L either. Yes, so that's important to understand. But what has changed, and I'll quickly show you the reference value here, is that we're going back to a leverage of 15. Yes, so that's really important to note because I would say that's often where many mistakes happen on the one hand, or many people don't quite understand what actually happens here when you increase the leverage. If we click here on margin, for example, we can see that with a leverage of 15, we have the option to reduce a maximum of 76 US dollars. But what we can do is increase the leverage, for example, just for demonstration purposes right now. We select a leverage of 50 and click confirm, and then here's what we can do. We go to the margin, and now, once it loads, we can see that we can withdraw 239 US dollars in margin, and that's exactly what we're going to do here now. As I said, this isn't something I would do personally, but at this point I just want to show what possibilities exist. We're taking out 239 and can reduce the margin here. That means we're now withdrawing the capital from the trade that we originally invested. Click confirm, and then you can see what happened here. And now we can definitely make an interesting observation. The funny thing about this is, just imagine this for a moment. We've now secured everything from this trade. So we've locked in solid profits. We still have profit that's currently running, plus we've removed the entire margin. We only have 15 US dollars in margin in this trade, and yet the trade is still running. So what has happened now? Of course, a very important observation. The estimated liquidation price is now almost exactly at our entry price. Yes, so you really have to keep that clearly in mind. We will be liquidated at 116,128, and the entry price is at 116,113. So practically, it's almost exactly the same level. And you can also see that here on the chart, the liquidation price is now basically at the entry price. And this is now, let's say, the flip side, the counterpart that we have to accept. On the one hand, we've now completely hedged ourselves. We only have 15 US dollars in margin at the moment. That's, I would say, the big advantage, that we've hedged ourselves. We haven't put up any more margin. On the other hand, of course, our liquidation price has shifted upward, which also means that, in theory, we could now operate completely without a stop loss. Yes, we could just remove the stop loss now because at the end of the day, not much can really happen to our trade anymore. So, as I said, that's just one option now, to remove the stop loss. It's not mandatory, but you could theoretically do it because we've hedged ourselves. We have virtually no margin left in this trade. So I would say that's one possible approach. You just let the trade run now, since you've essentially protected yourself accordingly. But there's another option now. We can take exactly the same margin that we just pulled out of the trade and put it back in. We can now increase the margin, but with a higher leverage. And you'll see in a moment what happens to our position size when we do that. So we can now take these $239 US, and open a new isolated long position with 50x leverage. We click on it, open the long position, and here's what we'll definitely see. We click on confirm. What happens now is of course obvious. I already explained that earlier. Now our entry price here has shifted significantly upward. We can see now that the entry price has shot up from here from 116,000 US dollars to 117,800 US dollars. That's just something that happens, I'd say. But what we have now, thanks to the 50x leverage, is a position size that's 0.1 Bitcoin. Our current position totals 14,400 US dollars. And that's really quite significant when you think about the margin we're using for this trade and the potential this trade now has. Of course, it's very important to note, afterwards you have to adjust the trade because otherwise, theoretically, you could end up losing your entire margin again. Logically, the liquidation price in this case is at 116,000 US dollars. Our stop loss is currently set just above that. And now it's important to keep in mind that we've significantly increased our entry price. This means that if we want to secure ourselves with this trade, we now have to, and are now obliged to, move the stop loss into positive territory. And I'll show you now how you can actually do that. We're now moving the stop loss into positive territory above our entry price so that this trade is secured. With this trade, we can never go into the negative again. In any case, with this stop loss, we're secured so that if Bitcoin should pull back again, the trade will close in profit. But now let's talk about an important point. We now have the opportunity to stay in this trade with a total of 14,400 US dollars. We have a 50x leverage in place, and a 50x leverage is, generally speaking, very risky because things can obviously move extremely quickly in either direction. But the big advantage is if we get lucky, so to speak, and as I said, this is purely for demonstration purposes for the video. If I were doing this privately, I wouldn't have gone to such extremes. But there's one thing I want to demonstrate right now, namely, if Bitcoin were to go up by just 1%, for example, the impact on our trade would be enormous. So you have to imagine the trade is extremely volatile right now. Yes, things could very quickly move toward liquidation, meaning we could get stopped out of our position. On the other hand, of course, we also have the opportunity that if Bitcoin goes up by 1% here, so to speak, then the potential gains we can achieve are enormous. Because if Bitcoin goes up by just 1%, you can calculate that with a position size of 14,400 US dollars, we would make about 140 to 150 US dollars in profit that we could take here. So basically we have a gigantic position size for relatively little margin and theoretically have the potential to pull out quite a bit. Of course, it's extremely risky. Definitely be careful, and such aggressive scaling is usually only done in stages. You might go up from, say, 15x leverage to 25x leverage and keep moving your stop loss higher as Bitcoin, let's say, continues to rise. And normally, I can tell you one thing. Usually, you only do this kind of scaling when a breakout occurs. And then that's why I said at the beginning this was purely for demonstration purposes, just to show you how, so to speak, you can increase the leverage afterwards. As I said, normally, when you're in a range, you don't do this yet. You don't scale up the leverage at that point. You usually only do this once a breakout has actually happened, once there's confirmation. And if, for example, Bitcoin is at 124,000 US dollars here, then you can afterwards increase the leverage, so to speak, and then it's not quite as extreme and not quite as tight with the liquidation price or the entry point because, for example, we have our entry here, and then things are much more relaxed also regarding the stop loss and the buffer we have below us. Because one thing that absolutely has to be mentioned here, and it's very obvious, if Bitcoin drops even slightly here, our position will be liquidated immediately. And that, of course, is the big disadvantage of using 50 times leverage. You get stopped out right away if things are too tight. That's why, at this point, I want to give you another important piece of information before I wrap up this part of the live trading. It was purely for demonstration purposes to increase the leverage within the range like this. Normally, you only do this after the breakout has happened. That's important to mention. I only use the 50 times leverage here as an example so you can get a sense of how much the entry price actually moves up, just so you're aware of that. Now, in this case, nothing can really go wrong anymore. Yes, in the worst case, we'll just get stopped out in profit here. Even then, it would still be a very successful trade at this point, with a total profit of almost 250 US dollars that we were able to take here. And theoretically, in this case, there's still potential for the trade to shoot upwards. But at this point, I'd like to end the live trading for the day. As I said, you've been given several scalping strategies and you've now really seen every possible approach you can take. Theoretically, our short positions are still open. Yes, our limit order here for a potential short is still in place. Just a quick explanation here as a summary because there's quite a bit of liquidity above us. So we can take a look at that, and if the market makers push in there again, you can take advantage of that opportunity. The same applies down here as well. So another important note, personally, I'm going to set new limit orders here privately just to take advantage of a potential move by the market makers. And that would have actually been the plan anyway if I hadn't recorded this live trading session for you now for the video course. Then I would have just let the position run because the entry was already very, very comfortable here. And then you can basically do compounding. And compounding means that you place new orders below the last low of the previous entry. So this is how I would have proceeded privately. I would now open new long positions here, gradually increasing the position so that you basically take this range trading to the maximum. Or another option you have here, the more often Bitcoin dips in here, the more often you do compounding, the larger your long position becomes, the better your entry gets over time, and the more potential you have for the next breakout. Because of course, as your position grows within the structure. Yes, the larger your position becomes by the end of the structure, the better it is for the breakout, because then you'll be in an incredibly strong position with a really great position that has been compounded again and again before the breakout actually happens. That's basically the plan. And if you want to experiment a little, then it's definitely also an option to increase your leverage afterwards by first withdrawing margin. Yes, that's, let's say, one way to do it. And then the margin that was withdrawn is put back in exactly with the leverage you want to have. And then you also have a relatively large position with relatively little capital. As I said, the position is 14,000 US dollars in size with just $200 margin. That's definitely very convenient in this case. Possibly the trade might even work out, but at this point I just want to end the live trading here because I've said everything I wanted to say. If you have any questions, of course, you are always welcome to join the free Telegram group. I've linked everything in the video description, as I mentioned. Feel free to check it out. As I said, just as a reminder, anyone who has an account on Bitunix can send me their UID via Telegram message. You can find it in the top right corner. If you go to your account here, every user has a UID, and you can definitely send that to me on Telegram, and then you'll be added to the free Telegram group. There you can also ask any questions you might have. I'll keep you updated there. You'll also get all the trading PDFs and so on there. As I said, at this point, it's really worth it to create an account here. You get $400 completely free with a deposit of 2,000 US dollars. This is an incredibly good opportunity, especially at the beginning when you can use the bonus here without risk for certain trades. For example, like in my case, to scale up a trade, it's obviously a fantastic option if you use the bonus first and not your own money, so to speak, but rather the bonus is used initially. It's definitely a very good opportunity. As I said, everything is linked in the video description. At this point, the live trading for day trading will now be concluded. Alright folks, now we continue with 7.7 position trading. Extremely relevant for the crypto market. Of course, it always depends on which market phase we are currently in. Now it's about how to trade entire bull markets, how to trade entire bear markets, and how to get an overall picture of the entire market. We'll take a look at the cycle theory a bit. I'll definitely share some important information about that as well, including a bit from my personal experience on what you can actually use here, because that's, in my opinion, the big advantage of being in the crypto market and not, for example, in the Forex market. In the case of the crypto market, we have clear cycles that as traders and also as investors, we can obviously take advantage of, and that's why we're now going to talk about this point a bit more. Precision trading means making only a few trades, but they have a big impact because these are often positions that are significantly larger and are held for much longer, over several weeks, sometimes even several months. In this case, position traders operate on long-term market cycles, focusing on fundamental accumulation zones and emotional extremes, especially during geopolitical events, such as when wars break out or when major news hits the market. For example, during panic selling, you can open individual positions and consider the overarching macro structure. What are the general monetary policy conditions like? Are we currently seeing interest rate cuts? Is there quantitative tightening, quantitative easing, or QT in place? I don't want to go too much into detail here, because theoretically I could record a whole separate video course on macroeconomics and cycles in general, but I still want to touch on it briefly so that you don't make any structural mistakes, because it's always important to keep the bigger picture in mind. We'll get to an important chart about this in a moment. Position trading isn't about short-term movements, but about timing entire market phases. And this is extremely important because why does position trading even work? You're not trading the noise, but rather the phase shifts. You make use of mass psychology and also fundamentals, in other words, fundamental data. You're not dependent on intra or day trading noise, and it's especially powerful when you combine it with on-chain data or macro news, or in general, as already mentioned, geopolitical events or monetary policy changes, etc. So there are quite a few things nowadays that can influence the market. We've also seen it recently with Trump, where sometimes a single tweet from him can trigger significant moves in the market. That's why we're going to talk about a few points here. So let's take a look at how this all works and how you can take advantage of it. There are several options now. Don't let yourself get too intimidated by all the charts and all the possibilities out there. In theory, you can also find such charts on Twitter, on X, etc. In this case, I'm using the tool Into the Cryptoverse. In this case, it is a paid tool, but I'll also show you in a moment, just so we've covered it, how you could theoretically recreate all of this yourself. If you later use TradingView, and as I said, TradingView is completely free. Yes, depending on your preference, you can pay for it if you don't want ads, but it's definitely much cheaper. And I would recommend anyway, if you don't want ads and if you use TradingView frequently, definitely go for the basic package. In my case, I think I actually have the premium package. Exactly, so you don't need the premium package, the plus package is enough. Yes, at the end of the day, it's your decision, but that's all I wanted to say about that. I just want to quickly show you how you can theoretically set something like this up yourself in the chart. It's best to open a new layout, name it something like log chart, or in this case, Bitcoin log. I'll explain to you in a moment what that's all about, specifically the logarithmic representation of Bitcoin. So what you can do here is click on this button right here. Here, you can now choose how Bitcoin should be displayed in the chart. You can select regular, percentage index to 100, or logarithmic. And yes, for us in this case, it's only relevant that we want the logarithmic representation, the logarithmic calculation of Bitcoin, to be shown here in the chart. And then you'll already see that quite a bit changes here. We're now switching to the weekly view, and you'll see how Bitcoin looks different. When displayed logarithmically, you really get a much better overview. Now, just very briefly as a reference value, so you can also visualize the difference once more. By the way, you can also right-click here, and then you'll see regular, and it looks completely different. So, in regular mode, you can see everything is compressed together. Now, I have to zoom in again first. In regular mode, this is what it looks like, basically the standard way of displaying it. Here in this case, to better identify the cycles, definitely use logarithmic. Just click on it once and then you'll see the display mode. And in this case, it's actually practically the exact same thing that's being shown here, just built manually, and theoretically, you could recreate each individual chart yourself here. So let's click on this here, and then you can also choose here, in this case, the face cam is a bit annoying. I'll move it down to the bottom left now. So here you have the option. If you click on this, there's an option for a curve, and you can set it up like this, and then you can basically recreate the logarithmic representation, the logarithmic regression yourself. Of course, it's not quite as precise. That's why I would recommend that you use the proper tools here, in this case from Into the Cryptoverse. But this way, you at least get a sense of a logarithmic representation, how you can view Bitcoin over the years. And you'll definitely notice that Bitcoin has clear reference points, that Bitcoin essentially always follows a clear pattern throughout the individual cycles. We basically had a bull market here, then a bear market, then a bit of a pre-halving phase, a consolidation range, bull market, that's this parabolic upswing, bear market, then a bit of a preparation phase, bull market, then again a bear market, and now in this case it's stretching out a bit more in this cycle. This one is also lasting a bit longer now, but you can clearly see that we're back in a bull market here, and probably another parabolic upswing is coming. And now we're going to talk a bit about how you can actually measure all of this. In this case, it's already presented a bit better because here we have a clear logarithmic regression with a fair value band included. Here we basically have a reference value. That's the fair value band, and with it we can roughly estimate whether Bitcoin is currently overvalued, undervalued, or within the fair value range. Most of the time, especially when Bitcoin enters this overheated zone, meaning it's no longer fairly valued and is above the fair value band, it's often the case that this also triggers an altcoin season where you can trade altcoins much more effectively again and the Bitcoin dominance drops sharply. This in turn leads to an altcoin season, but that's a whole topic in itself. Yes, I think the loyal viewers among you already know what I'm talking about here anyway. Otherwise, feel free to check out other YouTube videos. But that's all for now on the general topic of logarithmic regression and how all of this affects us as traders, as cycle traders, as position traders is simply the following. For us as traders, it's very important to know what the bigger picture is. And that's something I've already mentioned in the previous sections, that you have the opportunity to set up certain trades, for example, with low leverage. For example, when you're at bear market levels, you have the opportunity to open a Bitcoin trade with, say, 2x or 3x leverage, which allows you to comfortably leverage your own Bitcoin spot position even further. Let's say we enter the next bear market at, I don't know exactly, but just as an estimate, at 70 or 80,000 US dollars, that's the next bear market. Then, in theory, I can use 2x leverage to increase my spot position, meaning I can go into Bitcoin with double the size. Of course, you have to consider whether Bitcoin could theoretically drop back down to say 40,000 US dollars. Of course, you have to assess things like that, but if you keep increasing your position during the bear market and add more margin, that's also a way to effectively lower your entry point by continually adding more capital, whether with 2x or 3x leverage. This gives you the opportunity, even if you were a bit early in the bear market, even if you already opened positions when Bitcoin was at 20,000 US dollars, or maybe even at 25,000, it's not that bad as long as you're relatively close to the bottom of the bear market, because you can always add more margin to your individual positions. I can keep adding more margin again and again, and sooner or later I'll have added more margin right at the absolute bottom, and then I actually have the chance to catch a trade from the absolute bear market bottom, for example with 2x or 3x leverage, and can basically ride the entire way from bottom to top. Of course, that's also a bit of a dream scenario. It sounds a lot easier in theory than it is in practice. I can promise you that. I just want to mention this again, but I still want to show you that it's important to always keep the bigger picture in mind. For example, to never build up overly large short positions or to compound short positions too much, especially in the middle of a bull run. So you have to be careful never to swim against the current, because there's an important saying that applies here: the trend is your friend until the very end. Yeah, it even rhymes, of course. It's easy to remember, but it's extremely important. The trend is your friend until the very end. Only when we get clear on-chain signals, when there's really a bull market top in place, and then, let's say, new lows start to form, at that point you can really assume, okay, we're in a bear market, and then over time you can start taking short positions or shorting the bear market itself. And that's a whole topic in itself, I'd say. What I wanted to mention here: always take a step back and look at the bigger picture. Where is Bitcoin at right now? Are we in a bull market? Are we in a bear market? And depending on that, you need to manage your positions accordingly, because one thing I can tell you, you will be punished very, very, very harshly if you keep trying to open short positions right in the middle of a parabolic upswing, right in the middle of a real bull run. I would definitely be extremely cautious about that, and that, I would say, is the big advantage of Bitcoin, of cycle trading. Once you've understood, roughly speaking, how Bitcoin behaves, you have the opportunity to keep opening long positions, and when individual breakouts occur, you can scale up your position afterwards. You can increase the leverage, you can, for example, compound over time, and that's obviously really, really awesome if you catch entries here, get in at these points, and then keep increasing your position, which you can then carry along for months. So these are, of course, also really great opportunities. A lot of others do this as well. Yeah, maybe you've seen it with other YouTubers or in general, and that's why I wanted to show here how to best approach this. I don't want to say much more about it at this point, because theoretically I could talk for another 2 hours about on-chain indicators, other tools, and how you can interpret things like this, how you can even identify bull or bear markets. So there are several ways to do this, but I think this gives you a good overview. Definitely always use the logarithmic display mode. Be sure to pay attention to when does it get critical. You should absolutely never take on major compounding or big risks in areas that are already overheated, because at some point it will become dangerous. And that's why it's always very good to look at the big picture from a kind of bird's eye view, so you have everything clearly laid out again. That's it for chapter 7.7 and position trading. We're definitely going to continue now with the 8th chapter. Alright folks, we're almost there. We're moving on to chapter number 8, risk management and planning. A very, very, very important chapter, and I ask you once again, even though we're already at the very end, to take the time and listen carefully. I'll try to keep it as brief as possible, because I know that this chapter in particular is relatively theoretical. It might also be a bit dry, it might not be quite as exciting as watching live trading, but it's still extremely important that you operate with a clean system, that you really have clear, established rules. And that's why it's so important to take a closer look here, specifically at 8.1. Why do 90% of traders lose in the first place? 90% of traders don't lose in the long run necessarily because of incorrect analysis, but because they don't have a system, which is what they often do wrong. They trade without a clear stop-loss order, take on positions that are far too large, and chase after the market. Please remember at this point chapter 2 about the market makers and in general the principle regarding retail traders who are practically always systematically washed out. Then they don't have a clear risk limit. Also very important to know, and they also don't know when to stop, and what we're definitely going to learn now is how to calculate the risk per trade precisely. Then point number 2, how to plan a clean stop loss and take profit ratio, how to incorporate mental checkpoints into your own strategy, and how to clearly think like a risk manager and not like a gambler. That's also important. And now we'll move straight to the next slide about position size calculation, risk per trade. This is one of the most important slides. It's crucial to mention again, because this is where people often make a central mistake, especially many beginners who say, yeah, I'll just start with $500. I'll just load $500 and see what happens. Just see what comes out of it. But that's a very big mistake, because often the entire system is missing, and usually what happens is that individual position sizes are much too large. And for me personally, it's extremely important that you don't blow up your trading account right after the first week or anything like that, that you don't end up trading emotionally or making structural mistakes. We've already discussed quite a lot, and I think you definitely know which direction this is all heading, but still, it's important to me to highlight once again in a separate chapter. Now, in this case, chapter 8, which rules you should pay attention to. Which rules absolutely really must be set in your own trading strategy. And that's why we need a clear system. How much am I allowed to lose at most on this trade? How large can my position even be in the first place? And that's why we'll take a look at all of this and then also directly in practice. Feel free to take a screenshot or download all the PDFs. As I said, I've linked everything for free in the Telegram group for everyone who has an account on Bitunix. Just send me your UID on Telegram. That way, you'll definitely be in the know. Everything is also explained again in the video description. There you can definitely get a reference value for what to do with scalping strategies, day trading strategies, and swing trading strategies. And it's extremely important, let me put it in my own words again, depending on how large your trading account is, you need to calculate how much you can lose per trade at most. Now let me give you an example. Let's say you have $10,000 in your trading account. This is a simple calculation at this point. $10,000, you are allowed to lose a maximum of 1% of your trading account. That means you must never lose more than $100 per trade. That's why you always have to set your stop loss so that you don't lose more than 100 USDT if your trading account is 10,000 US dollars. So that's extremely important, especially for example with scalping it should actually be even less because here you have a higher volume of individual trades. So please aim for around 0.5 to 1%. You could even theoretically go for less at the beginning. So less is more, especially as a beginner. A typical stop loss would be 0.2 to 0.3%. By the way, we also discussed this during live trading. Of course, that depends entirely on which strategy you have, how the individual parameters are set, and whether you're trading on the 1-minute chart, the 3-minute chart, or the 5-minute chart. You need to base it on that. Personally, I've seen it quite often. I trade with a 0.2% stop loss and a 0.4 to 0.6% take profit. That's very typical, very common. As I said, that's generally the range. Then, when it comes to day trading or swing trading, as mentioned, you can also combine both, depending on which time frame you're on. I would say you can lose up to a maximum of 2% per trade as a practical limit. And in this case, the typical stop loss is up to 2, sometimes 3%. It really depends on where the liquidity is. I hope you were paying close attention to this, and you definitely saw where I personally always set the stop loss, or rather, I always based it on the liquidity heat maps, making sure to leave enough room in case there's a spike caused by the market makers. I think you've definitely already been able to learn quite a bit from that. So this gives you a rough overview of the general key figures. Of course, in practice, things are always a bit different. You always have to take another look at where it really makes sense structurally to set the stop loss. But please make sure to follow the rule that you never risk more than 2% per individual trade, and 2% is already set quite high. And, as mentioned, this is always calculated based on the total size of your trading account. It's better to start small. You can always scale up your position size later on. You saw it in the live trading as well. You can increase the leverage, you can withdraw margin, you can theoretically add more funds, you can compound. There are definitely still so many options available, so it doesn't make sense to take on too much risk right at the beginning, just so you're aware. Always adjust your risk to the current stop loss, not in a blanket way. It's always extremely important to keep those calculations in mind. Your position size is crucial, not whether you win, but whether you survive when you lose. And unfortunately, that's the harsh truth. It's often even more important just to survive in the market at all, rather than already thinking about making profits. Because I would say, for 90% of people, the main mistake is that they burn through their capital, and then in the end, they have no opportunities left because they simply have no capital available anymore. That's why it's always extremely important to make sure you don't lose money. It's better to start off relatively slowly. It's better to make slow and halting progress at first than to blow up your trading account or anything like that. You really have to be careful about that, because once you've lost money, it's extremely difficult to get back to the break-even point. That's always important to keep in mind as well. Here's a quick calculation. If you lose 10% of your trading account, you have to gain more than 10% from the new starting point just to get back to break-even. If you lose 10% out of $100, you're left with $90, and then you have to gain more than 10% just to get back to the original $100. So it's important to keep that in mind, to really pay attention to it, and it's better to act a bit too cautiously. Now let's move on to the next slide, 8.3, Stop Loss, Take Profit, and Understanding Risk Reward. Stop loss means invalidation. The stop loss should be placed where your setup is invalidated, not just $50 US below. So that's extremely important because a lot of people just say, okay, exactly 1% or something like that. And that's exactly why I did the live trading for you first, because there you definitely saw that I'm not always super strict. Of course, with some scalping strategies, I also always base it on how the individual percentages look. For example, I have a rule there. 0.2 is the stop loss, 0.4, 0.6 is the take profit. But especially with swing trading, especially with day trading, you notice that I'm never completely strict with exactly 1% or exactly a 1 to 2 risk-reward ratio. Instead, what I like to do in those cases is adjust the trade afterwards. I look at where is the liquidation heat map, what makes sense, what is my actual thesis, why did I enter the trade, why did I even place my stop loss here or there. You need clear reasons for that, maybe based on the liquidity heat map, or when it comes to scalping, I set the stop loss or the take profit at the middle band of the Bollinger Bands in that case. You always have to look closely, where does it actually make sense? Because at the end of the day, it doesn't do you any good if, for example, you set your stop loss at exactly 0.5%, but it's maybe just above the last swing low, then you'll most likely get stopped out, because the market makers will sweep it one more time. You really need to make sure you leave enough room, and you always have to do your calculations accordingly so that you never risk more than 2% per individual trade. Everything always has to be in proportion, everything has to fit, and that's why it's always important that you have a clear setup, know exactly where something is invalidated, and what the actual reasoning is for the trade and for the stop loss. You should base your setup on that, and not just randomly set it $50 below or something like that. A lot of beginners do that too. Of course, that makes things easier for yourself. But I can tell you one thing, anyone who sets their stop loss like that, just $50 below, I already know without having any further information about the person or the trader. I just know that this person has no system, no clear invalidation, and at the end of the day, no structural understanding and no reason for why they even entered the trade in the first place. You absolutely always have to be strict about this. No, I'll tighten it up or I'll give it more room without a plan. I did do it during live trading. I'll tighten the stop loss here or I'll give it more room, but I had a plan. At the end of the day, I knew exactly where is the liquidity, what is likely regarding the market makers, where could there be another spike to grab liquidity from the stop loss orders. You always have to work with clear reasoning, especially in the beginning. Of course, over time, you'll develop a kind of intuition for trading, or rather, you'll immediately know where it makes sense to place the stop loss, but you always need to have reasons. Quickly check yourself again. Why am I moving the stop loss now? Or why am I giving it a bit more room, etc. You always have to check everything, be able to justify everything, for example by using the liquidity heat map. That is extremely important. Always ask yourself before every trade, where would my trade logically be wrong? Yes, and it's extremely important to have structural reasons for your actions and to know exactly why you're doing what you're doing. It's just really important to keep yourself in check and to always ask yourself exactly these questions. Otherwise, take profit should be a structural target, a logically attainable area for take profit, for example from a liquidity cluster, as already mentioned, a structure break high or low, etc., so that you always have clear justifications. Don't just rely on magical numbers, don't just set your take profit at 100,000 US dollars or something like that. I often see this with many beginners as well, that they use magical numbers, or some people set it exactly at 110,000 US dollars or some other rounded number, but definitely be careful with that. Never ever do something like that, just picking some magical number. There always has to be a justification. Then, previous highs and lows are of course important reference points, volume peaks, and Fibonacci levels are also very relevant. So you can always cross-check, you can always draw a Fibonacci level. Where is the golden pocket located? Where is the 0.618 level, etc.? So it definitely makes sense to cross-check yourself like that, I would say. Especially with Fibonacci levels, it's relatively easy to draw them, even as a beginner, swing low to swing high, or swing high to swing low, and then you can immediately see where important areas are. So you can always do that, just as a little tip here. Otherwise, let's continue with 8.4, expected value and hit rate. It's also important to have calculated something like this for yourself over time. I've even prepared a special formula for you here because it's actually quite important to really know exactly what the expected value is. So here's a brief explanation. The expected value tells you how much you earn or lose on average per trade over a series of many trades. The formula looks as follows. I know this might seem pretty complicated or very theoretical at first, but it's still good and important to have heard it. Especially once you've executed more trades, you can definitely draw some conclusions from your own positions. The expected value is the hit rate multiplied by the average risk-reward ratio. Yes, and then in this case, you subtract once more, 1 minus the hit rate times 1. You just have to calculate that once. If necessary, you can use ChatGPT for this step. You could even, in theory, send your trading history to ChatGPT, and then ChatGPT can calculate everything for you. I've actually done that myself with many scalping strategies. This way, you can monitor yourself and keep statistics on your individual trades quite easily because you don't have to sit there with a calculator and work things out yourself. Just give the data to ChatGPT and you'll immediately have a nice overview, and you can also get feedback at that point. As I said, RR stands for risk reward ratio, and the loss side is weighted once, 1 RR risk per trade. As I said, run a calculation like this through ChatGPT and you'll quickly find out whether your trading strategy is profitable or not. And that's how I personally test, or rather backtest, scalping strategies as well. Here's a general explanation once again. I don't want to go into too much detail at this point. As I said, I just wanted to list everything here for the sake of completeness. Now we're coming to the very end of Chapter 8, the 5 golden rules of your trading system. As I said, this is just a very general and overarching overview. But these are, in my opinion, the most important things, especially for beginners. Maximum risk per trade, 1 to 3%, or actually 1 to 2%. In this case, I've increased it to 3% because sometimes, especially with position trading, you can take on a bit more risk. I also sometimes have longer positions open with a 2x or 3x leverage, where I can tolerate a bit more risk, but it's always extremely important that everything is kept in proportion. Even if you have the perfect setup or whatever, please stick to the rules. Every trade always needs a stop loss and take profit, yes. No trade without invalidation, no trade without a target. Extremely important. Always be aware in advance, where do I want to exit? How do I protect myself with my stop loss? Never just enter a trade randomly and then think afterwards, so where should I set my take profit? What am I even doing? Because then you're in the trade completely without a plan or any reasoning, and something like that always ends up dangerous and very badly. And now, point number 3. After 3 losing trades, I'm saying this from personal experience, definitely take a trading break, because what often happens is that you want to quickly make up for your losses, and I know this from my own experience. When you're frustrated, you think, I don't want to end the day on a negative note. I definitely don't want to end up with a negative result in my trading history today, and that's why it's extremely important to make a clear stop, to really say, okay, that's it for today. Tomorrow I'll continue again. And that's exactly how I actually handle it myself. Sometimes, even when I'm making really good profits, I tell myself at a certain point, okay, that's enough for now. Because of course it can also go exactly the other way. You can become completely greedy, start feeling overconfident and think, okay, today is going incredibly well. Then you do another trade, and in the end, you ruin everything for yourself by the end of the day. That's why you need to have clear rules. Only take an entry when the setup is fully met. No, well, it might work, but you have a clear system. Yes, even with scalping strategies, be extremely strict. Yes, especially when it comes to protecting yourself with the RSI, really pay attention to that. Definitely be very strict with the numbers as well, so that you never enter a trade half-heartedly when there isn't a clear setup. I'm definitely speaking from personal experience here. Often you sit in front of the chart and you want to be productive. You think, okay, now I want to trade. Now it's time to start. But if there isn't a clear setup, it's often the case, especially as a beginner, that you desperately try to interpret something into the chart just so you feel justified in taking the trade. But that's extremely dangerous. It's better to do nothing at all. Yes, I would say that a trading day where you haven't made a single trade is still a better day than a trading day where you made 3 or 4 bad trades just because you wanted to do something. So that's extremely dangerous in trading. Often less is more, and often the best thing you can do is simply observe and not take any trades at all. There's also a saying in English, no position is also a position. Yes, if you're just observing, you're still positioned. Yes, if you, let's say, have everything in view, then it's perfectly fine to say, okay, hey, today I'm just observing, today I'm not taking any trades. It's completely fine to have days like that. So it's extremely important that you don't force yourself to find a setup or overinterpret things. Have a clear system. And as I said, that's the solution to so many problems beginners face. You need to have a clear system, clear rules. That's what I want to say. It's the most important thing I want you to take away from today's video course. Point number 5, only trade during planned sessions. I've written here, no random trading during breakfast or anything like that. And don't think, I'll just do 1 or 2 trades during my lunch break or something. That usually ends badly. Have a clear setup, have a clear plan. Look at where the most liquidity is available. As we've discussed, it's usually very quiet on weekends. On the weekend, you can position yourself calmly for the coming week. And if, for example, you're scalping, then make sure to check which sessions are available. Because often, for example in Germany, at 3:30 p.m. there's more liquidity, since that's when the stock exchange is open, etc. So you definitely need to pay attention to what makes sense. Where do we have clear volatility? Where might there be better trading setups than, say, somewhere in between in the middle of the night or whatever? So definitely pay attention to that as well. In principle, these issues shouldn't be seen too strictly because the crypto market is open 24/7, but even so, there are definitely clear times in the crypto market when there's more liquidity and more volatility than at other times. That's why you definitely need to pay attention to that as well. That's all for chapter number 8. And with that, I would actually like to wrap up the entire video course at this point. We've reached the end. First of all, a big congratulations to you as the viewer who took the time to really watch everything from A to Z. and hopefully also worked through everything in a structured and thorough way from start to finish. Of course, it's also important, I would say, to actually engage with all the content, to use it as a kind of tool, not just to consume it passively, but to really start putting it into practice now, to try out the different trading strategies, and to get a personal sense of what it's really like to be in a position with real money. And especially what it's like to have to deal with your own emotions. These are definitely also very, very important experiences and crucial parameters that need to be present in order to truly make progress and foster growth, because on the one hand, you have the theory. There, everything often sounds very simple, or if you've watched me, maybe it also seemed like everything was running perfectly or something like that. But it's extremely important to actually put things into practice, to make mistakes, and to clearly observe for yourself what happens when a trade goes against you or when you incur losses. So that's really something I want to pass on to you at this point. Of course, always be cautious in general. Don't just go all in right away or anything like that. Work your way up, step by step. Start out with small positions, especially in scalping, or generally whenever you're entering new positions. Definitely keep yourself in check, especially when it comes to other YouTubers who are always saying, now it's starting, now is the explosion and the once-in-a-lifetime opportunity or whatever. I can definitely reassure you there will be more than enough opportunities in this crypto bull run in 2025, 2026, so make sure to stay relaxed. I think with this video course, you've definitely been given all the tools you need. It was an incredible pleasure for me to record all of this for you. You can take my word for it. I don't know why, but especially when I'm really providing value or preparing a lot of structured content for you in these video courses, it actually brought me even more joy than making individual YouTube videos, at least in part, because that's often the case. In YouTube videos, on the one hand, I want to keep things brief. Of course, I want to give you as much information as possible in the shortest amount of time, but especially now in a video course like this, it was particularly enjoyable for me because I could finally share everything I wanted to pass on. No matter how long the video course ends up being, often in YouTube videos, I try to keep it under 30 minutes just to stay in line with YouTube standards, but especially in a video course like this, it was really nice to be able to take my time. And of course, I hope that with this video course, I was able to help some of you out. I was able to help some of you shed some light on things and definitely give you a solid foundation for potentially earning passive income for a skill that can keep bringing you monthly cash flow. In my opinion, this is one of the best opportunities out there, especially now during the bull run when there are so many possibilities, even with altcoins and with trades that you can scale up. So I really think this is one of the best times to start trading. As I said, I hope I was able to provide a lot of value. Of course, feel free to leave your feedback in the comments. I also don't want to make the ending here too long. If you enjoyed the video course, feel free to leave a like, subscribe, write a nice comment, and also share this video with others, friends out there who may have listened to the wrong people or who might also be interested in this topic. I would definitely appreciate it and it would support me a lot. Otherwise, everything is linked in the video description, including the free Telegram group where all the PDFs are prepared and available for you. As I said, you just need to create an account on Bitunix. Send me your UID, in other words, your account reference number. Send it to me privately on Telegram. I've also explained everything again in the video description, and then you'll definitely be added here completely free of charge. There, you'll definitely receive all the materials from the entire video course. Of course, you'll also be kept up to date on potential trade setups, which will also give you further insight into my strategy. I'll also be regularly providing you with updates there, and otherwise, as I said, I sincerely thank you for your attention. Feel free to like, subscribe, and comment, and with that, I'd say we'll see each other again in the next video.